Hi guys, what's up? I hope everybody is doing good and everybody has kick-started your preparations. So as part of your preparation and to make it easy, I am bringing the most awaited strategic management marathon. The previous marathon that I have released had amazing responses across a couple of platforms that we have posted that on. So we have seen how people were able to engage with that video and at every stage in strategic management's completion I've seen a lot of comments and we keep the tradition going so that it boosts your preparation and keeps your motivation high. So this time I'm going to make the marathon more interesting by covering the entire content of strategic management from two sources. As you all are aware that a few days before we have released a knowledge pack for strategic management, which is a combination of the text of strategic management, MCQs, and also the past exam questions, a complete knowledge pack for the strategic management. So using that material, I am going to conduct this revision and also, of course, my very own handwritten notes, which has been widely circulated across the last 1 year. And I'm so glad to see many people carrying it and they, like they've taken color printouts of that and they show me with such happy faces. And the kind of response that I've had is amazing, which is also the reason why, despite the content in the previous marathon still being absolutely same, I am doing one more marathon. But this time, like I said, I want to make it more worthy of your time by getting a more precise view of the topic and not just my handwritten notes. So it's going to be a double-edged story. And as you know, we have about 5 topics here in strategic management, and we have split that into nicely about 5 stages of strategic management. So let me just quickly take you to the index down there. Introduction to the strategic management: what is strategy, what is management, what is strategic management as a whole, and then we talk about the benefits, the limitations. So that stretch of things that we'll cover with the basics, which many people ignore, but having seen the past exam questions, you should have understood that those questions on benefits and limitations of strategic management have come so many times that it has now become a must and should for reading. And then we have the entire story of strategic intent, vision, mission, goals and objectives, and values. So we will talk about all of that. And of course, when we do stage two, which is about strategic analysis, which has been split into external environment and internal environment, which is then followed by stage three, where we have strategic choices. Corporate level strategies are there about stability, expansion, retrenchment, and combination. And also, we have the last chapter covering up 2 stages about implementation and evaluation. Now, before I move further into the marathon, I always have a tradition of making a quick input about certain important things on the marathon, because I just don't want people to use this as a tool to escape studies. So I have a piece of wisdom to be given here. So quickly, let me bring that on your screen. Strategic management is a 50 marks paper. You know that very well. 15 marks of MCQs with some case-based scenarios nowadays, fetching you 2 marks on each multiple choice question, along with the 35 marks of description, where you have a choice about 10 marks. I have already previously made a preparation strategy video for strategic management, and we have very clearly jotted down the chapter wise weightage for each of the chapter, and we have very clearly observed that every chapter, including chapter 1 to 5, chapter 1 is literally 40% of the size of chapter 5, but chapter 1 comes for 12 marks and chapter 5 comes for 14 marks. So all I'm saying is make sure that you give equal importance. We are releasing the marathon very, very, very advanced, right? Some of you have already tangled onto the previous one. So all I'm saying is one round of good revision should be done before you come to this. Marathon is not a substitute for your formal preparation. It is just a guide, right? And I've mentioned this many times because many people today are resorting to shortcuts, which is exactly why, despite the increase in the number of resources, right, you have separate colored materials nowadays. You have MCQ separate material, case based questions separately, past exam question compilation separately. Still, why is there a challenge for a student to pass with so much convenience around? Is because people are resorting to shortcuts. I am also going to make a video on that soon, very detailed explanation of what needs to be done to change the pattern of understanding. So please mark on my point number one is one revision to be done, and then come to the one full good length of revision to be done. If you have not yet done the preparation properly, you don't have conceptual clarity, please do ensure that you quickly make sure that you get that via quick crash course, fast track, whatever names that are available now. But get that logic, because as I said, don't get flattered only by seeing somebody else's comment saying that I passed because of your marathon. They leave that, and definitely I have high respect for them because they have left that comment, but you don't know what they did before the marathon. Yes, our marathons, I'm doing this for about 14 years now, and our marathons are, like even when the YouTube explosion is not there, my marathon is there, right? So my initial 1 hour marathon on strategic management has, gone into lakhs of views. The point is that people are always entangled these kind of videos which give them, that rush. Yes, I like that. At the same time, please, in all of your interest, ensure that you do your first round of good revision or preparation, then use this as a guide. Two, don't blindly do this because it's not going to make a sense. The Obviously the material that is there is available in our resources. We can find the link in the description to get that. Also, we will give you a link on the handwritten notes, which you can obviously download. So alongside that, it is a great practice to keep a handwritten. Of course, whatever I am writing, you can get a PDF of that and you can keep it in the phone to, like nowadays you like scrolling very much, right? So you can always scroll through that colored material, which is very eye catchy. Also, I suggest handwritten notes because that brings a sense. Like otherwise, people are, lying flat on the bed and watching the marathon, right? Like putting the phone like this and watching, right? Just like I'm shouting and that goes into their ears, which is still workable for many people. But all I'm saying is, if it works for you, good. But please keep a notes, sit straight, sit in a proper study space, and then do this. And if you're doing this marathon for the first time, if you're already used to me and like my culture of teaching, then you can possibly try 1.25 or 1.5x because I do understand you have all the other subjects to do. But I suggest if it's your first listening, you can always go on the normal speed. And once you've taken care of all these 3 points, then like this further revisions can go at 1.25 or 1.5. I have no objections on that. Don't try to watch the entire marathon at one go. I mean, like that also has been in there in our comments box in the previous marathons. So people said in one go I finished a 9 hour marathon and I'm done. Very rarely one or people do that, but I hope everybody understands the idea of doing things split and watch. The best thing to do. Don't go with everything at one go because no matter again, I suggest you to watch this marathon in convenient number of parts. I'm not even giving the number because you know what you're convenient with. And I just have 1 more minute left for my 10-minute introduction. And that minute I want to spend on presentation. There is no secret presentation technique here. So please stick to these two golden rules. Write the answer in points. Don't write unwanted content. Limit the answer to what is asked. Done. Of course, I'm going to show you how to write an answer with write in points means how do we write, and limit at a length means what should we do. By taking examples of previous exam questions, a video is soon going to follow where I will be explaining the presentation strategy. Like I did preparation strategy, I'll also do presentation strategy going forward. So that's all with all the words of wisdom, and my scheduled time of 10 minutes on the introduction is done. So let us get going for a great round of marathon. And I would like to start with the basic definitions of strategy and management. So let us quickly move on to discussing what exactly is strategy and what exactly is management. To start with that, I'm getting you the first thing on screen is the introduction topic number one, chapter number one. So as you can see on the top, I always keep saying concentrate. So concentrate very well here. Let's start by discussing the concept of management. So what exactly is management? Now you know that management is used in a couple of contexts. So definition A of management is what is the first one to see, which refers to a key group of people in the organization. So as much as I can, yeah, fit in there. Yes, you can see so much. So management refers to a key group of individuals. Now you know who's a key group, right? Key group are those people who are responsible for decision making, for rather say overseeing an organization's affairs. So management refers to the key group of people. Today you call them as the corporate suit, or in more corporate terms they call the C suit, right? C suit are the set of people. I mean, definitely not something that you should be aware of because you're not in the corporate stream, but if you are, you'll be hearing this word a lot. I want to convince the C suit. So C suit are a set of people who are the key group of the organization. You call them the corporate level, you call them the C suit, you call them the strategic level, you call them the strategy masters by whatsoever name. So key group of individuals in the organization, and these are the guys who actually set what we call as vision going forward, right? These role of these people, what is the main role of these people? They act as the chief organ who are ensuring that the organization is absolutely purposeful and productive. Now productivity is a word associated with efficiency. So you know that these are the set of people who also bring the 5 M's together. Now you know what the resources are, right? Men, material, money, machinery, and market. The word used there is about integration. Integrate means to bring together. So if you are integrating men, material, money, machinery, and machinery here is technology, right? Whether you use physical machinery or anything else, right? When we talk about machinery, it is about the technology. Though they don't generally mention about market here, unless you don't really see a market for your product, these things don't work. So obviously these 5 M's, and I think we have discussed this enough in the basics, that the resources are scarce, they are limited. That is why there is a subject called economics, how to use the scarce productive resources in the most efficient and effective manner. You can see the word that is right on screen there, optimal utilization. I've explained this in very detail so many times to people in foundation. uh, I also fortunately or unfortunately teach economics at foundation level. So we know the resource scarcity has been, I of course deal larger part of macroeconomics, but of course since it's part of the economics, we know that economics is talking about scarcity. Lionel Robbins definition. So he says that the resources are limited, and we know from the basics that wants are unlimited. So it's the same thing for the organization. The organization has so many things to achieve, but the resources are limited. So we need somebody, a key group of people to come together to first acquire these resources. I want to give you 3 words here: acquire, use, dispose. Acquire the resources, use them properly, and finally dispose them in the most possible, the best possible manner, so that the organization can make the most of it. Then unification. Uni means one. All of you know this. I don't have to repeat that word. The management is about creating a unified system, unified as a whole, so that you can utilize the resources by utilizing the diverse set of resources in a very effective manner. The survival and success of an organization heavily depend on the how good the management is, the competence and character of the management. Alongside that, everything that the management does is also something they have a watchful eye on the environment, which facilitates organizational change and adaptation for an effective interaction the external environment. External environment, this word external environment, we talked about it as it to be dynamic. Now, when you know that external environment is dynamic, you look for, you know, what are those dynamic changes that are happening and how can we get hold of those. So that is what the first part of management deals with, key group of individuals in the organization. Second part, the second context or definition A was this. Now moving on to context B, which is the other definition of management, it talks about set of interrelated functions. And I'm pretty sure all of you know what the 5 interrelated functions are: planning, organizing, directing, staffing, and controlling, which is about taking corrective action. For each word, there is a meaning clearly given. Planning is about deciding the future course of an action. Organizing is about designing the organization structure. And since I'm doing this marathon after your syllabus is over, so I want you to relate back to what you're talking. When I teach in the class, we teach chapter 1, you are not done with chapter 5. So you don't know what we're talking about. But now that you have already done chapter 5, you should know that organization structure, leadership, staffing, putting the right person in the right place, all these comes in chapter 5. Remember Edson Spencer, he told that, now you are able to relate the broader picture. When I say Edson Spencer, he says merit of the idea carries more weight than the place it came from. And also there is Chandler's circle, which says whenever you change a strategy, organization structure may not work. Are you able to relate to all of that? So all of those aspects are managerial aspects where management has to play the role. Planning, which is deciding a future course of an action. Organizing, which is more about when you say setting up a structure or a framework, we discuss in chapter 5. So is directing or leadership, guiding and motivating. Staffing is putting the right person in the right place. And most importantly, the most important job of a leader is accepting when something goes wrong and taking corrective action. So monitoring and ensuring that goals are met through corrective action. That is exactly what a leader should do without. Sir, what does management do? If you see the scope of their function, they determine the goals for the organization structure. Goals for the organization. They also design the organizational structure. Now, this is exactly where you see that there are about 8 structures that we see in the 5th chapter. Then talk about allocating tasks and resources and setting up control systems, which are also discussed in the 5th chapter. So action stage of the management is what we see there, and this is what the management is meant to do. But if you understand clearly, management is more of an influence process to gain command over a phenomena. Huh? Management is a influence process for what? To make things happen, backed by power, competent knowledge, and resources. It involves gaining command over. Gaining command means what? Oh, you have to hold on that situation, a phenomena, whatever is happening in the market. You have to gather the hold on it and inducing and directing people in a specific or a certain way. This is all something that the management has to do. So this is the the broad concept of management. And now quickly, if I have to take you to what we have already done about that and kept, right? We already have in the chart that we have made, which can be brought there. The segment 1 of strategic management dealing. Management is a two things in simple way: set of interrelated functions and key group in the organization. So planning, organizing, staffing, leading, and controlling is what management is all about. That brings us to our next topic, which is called as strategy. Either ways, right? Like, I don't want you to rush back and forth. That is why I told you we're using a couple of resources. I want a smooth flow of every topic, which is exactly why I didn't really bother about telling you which book to follow or what to do. You keep both the materials or both the sources are available to you, or even if you just simply plug in your earphones and start listening to this, you should be in a position to make notes and you should be able to finish. That's our idea, right? Coming to the second topic, which is the concept of strategy. Management done. Let's move to strategy. What are we talking in strategy? Two very powerful definitions of strategy. Strategy is a long range blueprint of an organization. What is it? A long range blueprint of an organization's what? Three things: decide image, direction, and destination. So let's kind of revalidate the sentence. When we say long range blueprint, what are we talking about? So if I just have to take you back to the story of what strategy is, let me show you some important points about it. Strategy is about the day, like it's a game plan. huh? Strategy refers to the way a business decides to counteract on the external forces while pursuing its vision, mission, and ultimate objectives. And when you say the word external forces, we are referring to environment. And strategy is something that helps you in pursuing the vision, mission, and objectives. If you constantly keep listening to these terms, vision, mission, objectives, aren't they part of strategic intent? And the establishment of strategic intent is only the stage one of strategic management, right? So strategy in other simple terms is nothing but a game plan that helps businesses to take a market position, attract and satisfy the customers, to compete successfully and achieve an organizational success. In simple terms, let's take two definitions home. I always prefer the basic definition of strategy. That's why I started up. And also I prefer William F. Glueck's definition. These two have to go into your notes if you're right now taking notes of what strategy is. Strategy is a long range blueprint of an organization's desired image. What is it you want to be? How you want to go there, the direction, and ultimately reach where the destination. Strategy, in simple terms, is a long range blueprint for an organization's desired image, direction, and destination. It answers three questions on what it wants to be, what it wants to do, and how it wants to do it. Alongside that, we're also talking about destination of where it wants to go. What is that? Where does it ultimately want to go? Then William F. Glueck has given a beautiful definition with three words which glorify the same concept. So William F. Glueck doesn't come out and tell something new. What does he say? Hey, strategy is a plan. He's also telling that only. What is he saying? Strategy is a plan. But he added three beautiful words to that to say strategy is a unified, comprehensive, and an integrated plan. Plan only, but what sort of a plan? Unified, comprehensive, and an integrated plan designed to achieve the basic objectives of business. Now, though basic objectives of business are not discussed in detail in this syllabus, I'm pretty sure every student of economics from the past, you have already understood what are the five basic objectives of business: survival, stability, growth, efficiency, and profitability. Are they recognized as the five effective? That is why when we write or mark these things in class, every detail you can see being marked here, because so that when we recollect that point, you should not even make a switch like what could this have been and what is this and all of that. Just go by clearly understanding. Acha. So you know what that SSGP stand for? What is it? Survival, stability, growth, efficiency, and of course, we're talking about profitability as an outcome. To those students who have heard my classes, at this point of time, we would have discussed the Usain Bolt example on how he has conquered the 100 meters. So for the first time, if you resonate to that, I want you to just start with this time, not going up till stage 1 to 8. Just start at this point of time. You can start commenting that you understood strategy and management, because if you resonate to what Usain Bolt's example is, survival, stability, growth, efficiency, and profitability, which means if you survive, stabilize, increase your speed, and run the fast and the fastest with a lot of efficiency, you will get the gold medal by yourself, which is the ultimate profit for which you have run the race. So if you acknowledge that, right, so that is where you completed understanding management and strategy. But at this point of time, I would also like to mention one of the most important traits of strategy. That is, we have a strategy, so we will send people from management home. No. A very, very important star point is strategy is not a substitute for a sound, alert, and responsible management, or in simple terms, strategy is not a substitute for good management. You have the best of the strategy in place. You have the best of the strategy in place. Still, you need good managers to advocate it. You need good set of people to take it forward. Why? Because there can be unanticipated situations. The best example for that was a pandemic. I want to just read out that line from the material which says strategy is not a substitute for good management. It should be flexible. Flexible means what? Changeable with time. Strategy can't be rigid, and you can't be rigid saying that, hey, I'll follow strategy like this only, I won't make change. So you have to be a little flexible in making your strategy. Pragmatic, which means practical in your mind. If you're saying, hey, I will be like this only, and you are, very rigid about it, and it doesn't matter, sir, it can be less practical, but I have to win. No, that you'll never win. Okay, so going by that logic, one has to understand that strategies have to be flexible and pragmatic so that you can handle emergencies, so that you can handle what? Emergencies, and also certain unforeseen circumstances. Like a pandemic could be a great example. Okay, so that is one very important star point. Another very, very, very important star point which we have discussed here is what? Which many people in the first to go in the classes will give a wrong answer is this. At which level strategy is made? Corporate level, everybody will shout. I hope all of you who are listening to me now, you know that strategy is made at all levels, right? Strategy is made at what? All levels. Why strategy is made at all level? Because at corporate level, they make big strategies that span across the entire company. That is a topic that is there, right? After doing this, we generally go to that before even looking at strategic behavior. So I will obviously hold it here. I'll take it to the topic because corporate level, divisional and functional levels, all these three levels make strategies. While corporate level makes it for the whole organization, divisional level makes it for that particular SBU or the product. Functional level will make it for business functions. And I hope all of you are very clear about what the 5 business functions are. Finance, marketing, HR, production, inventory management. All these are considered as the 5 most important functions of a business. And of course, the sixth one, if you generally know what I say at this point of time, those are 5 fingers which make a fist. Sir, then what about R&D? R&D is like Ritik Roshan's hand. He has 6 fingers, right? So like that, some people like Ritik Roshan have, some people don't. So exactly like in some businesses do R&D, some businesses don't, right? So that is the best way to remember that R&D is a discretionary expense. Now, if I don't want to spend on R&D, only 5 fingers in. Together, make a fist, have a business. No, sir, we're like the Ritik Roshan sixth finger. We also have that. Very good. But not again, just to let you know that everybody is not interested in R&D because some people, despite having the money to do R&D, they don't do. They directly buy technology because that seems convenient and easy for them to do it. Understood? So, with that, we understand the basic definition of strategy. So, guys, I think I'm, I know what I'm doing. So, first 10 minutes of my introduction went on basics and introduction. The next 9.5, 10 minutes went on management. Now, the next set of 8, 9 minutes went on strategy. Now, I'm going to move to the 3 levels that are there in the organization. Quickly, I will take you through that. What are the levels involved in the organization? And don't worry, we are not missing out on what we are seeing. One of the most important 3-star topic, proactive, reactive. We will come back to that, which is called strategy behavior, but in a moment. Okay, but before that, I would want you to do 2 things here. One, take a look at the summary of what this is. Strategy is a long range blueprint, William F. Glueck's definition, basic objectives of business, everything summed up in a simple chart and a detailed explanation, right? Next revision should be half the time of this marathon. So that time when you see only this handwritten notes, say for example, it takes X amount of hours to do the marathon, it should be X by 2 or even lesser and faster if you are very good in revising. So this should be your cue. And I'm using the other full material also so that just to let you know, it's just a new way of doing the marathon. Otherwise, I used to previously do the marathon only with this. And I used to literally handwrite it during the, marathon. But now that we have it and nothing changes the discussion, we have more time for discussion, and so that we will spend productively even looking parts of the main material so that like I said, at the end of this marathon you should really feel complete. Right, on that note, my first half an hour has been very productive. If that is the same with you, go edit the comment to strategy and management. Done. So that's your first 30-minute comment that I want you to leave. Management and strategy, two things are done. Now let's move on to levels of the organization, which I would obviously want all of you to know very thoroughly. So moving to that, strategic levels in the organization. So just look at the picture here. You know that there are three levels: the corporate level, also known as the top level, which is also called as the strategic level, right? You can as well call this as the strategic level. CEO, board of directors, senior executives, and other people are there at this level. At the business level, you have each individual business spanning up, like say, for example, division A, division B. One is about dealing bakery products, the other one is dealing soaps, the other one is dealing fruits and vegetables. Somebody you can take like probably an ITC, or probably somebody you can even in the likes of Hindustan Unilever, Procter and Gamble. All these guys have division oriented aspects. Of course, some of them with lot more products have SBU oriented structures, but this is a less diversified, simple looking hierarchical structure: corporate, business, functional. So a corporate head office followed by three divisions. That is why I said less diversified. And then all functions. Who are there at functional level? All functions are there: finance, marketing, HR, production, and logistics, which is also called inventory management, by the way. Now R&D, I specifically underline that, and I want to highlight it now because, as I just told you, you know what I just told, right, about Ritik Roshan. So R&D is a ancillary function. R&D is nothing but a discretionary aspect. R&D is a discretionary aspect. You want to do it, do it. You don't want to do it, don't do it. Alright, no sir, we have surplus funds. Chalo, you can do R&D. No sir, we'll use surplus funds and directly buy. Okay, absolutely fantastic. You can obviously go and directly buy the technology that is available. Okay, so at level 1 or corporate level managers, and at level 2 are business level managers, at level 3 are functional level managers. Let's also take a look at each of their roles, guys. Corporate level, business level, and functional level. Corporate level is the role to oversee the development of the whole organization. See, that gives us a chance to see the right words here. Whole organization. It includes defining the mission and goals. That is the other purpose here. Defining what is what? Mission and goals, which means they give the direction as to where you are going. What business are we in? If you remember, because of course we will revise very soon, but Peter Drucker and Theodore Levitt, they asked 11 questions on what business are we in. So in answering that, the corporate level should be bothered about what businesses it should be in. That is a direction. And as you know that the resources are scarce, so doing something funny will not last longer. You have to have proper allocation of resources, and allocating resources among different businesses in an optimal manner is also something what the corporate level does. And they will form strategies, formulating and implementing strategies that span across the individual businesses. If you look at what the business level does, their point is very clear. While corporate level, that is CEO and the gang, the C-suite, they do all of this. While the business level people translate, that is the keyword to take home there. Translate what into what? Direction and intent coming from the corporate level into concrete strategies for each individual business. So for each individual business, what is workable, these guys will translate. Because everything what the corporate level talks, no, the other guys can't understand them so easily. Like, because at the functional level, they are more bothered about outcomes and outputs. They're more bothered about outcomes and outputs rather than about words or fancy policies. No, they are not bothered about all of that. They are more bothered about what you see as the okay, what is my task? How do I do it? So the business level acts as a bridge between what and what? The business level acts as a bridge between the corporate level and the functional level. Then corporate level managers are concerned with whole organization, corporate whole organization, while business level people are concerned only with specific to that particular business. They are not guys who deal with the entire business. They only deal with that specific aspect. Okay. And then moving on to the last level, which is the functional level, whose role is very, very important, because now you saw 6 business functions, and people at functional level are the ones who actually do the work. These are the guys who actually do the entire work. These guys take all the struggle, right? You just, I want you to see this in the whole space, right? Just check that out. Functional level people, they are responsible for specific business function. I marked number 6 there for a reason, because just now we saw what those 6 are. Each of these guys are individually responsible. That is why they use the word for their sphere of responsibility. Sphere means their circle, their boundary. What are they within? Okay, a functional manager's sphere of responsibility, that is their circle of responsibility, is not for 10 activities, is confined to, which means it is limited to, confined is generally limited to one organizational activity, whereas general managers, they bother about the whole company or a division. So general manager's role is much wider, while this guy who's at the functional level bothers only about their area. They develop functional strategies in their area. When they say their area, it is only about which of those 6 areas they are linked. Plus, one of the most important things a functional manager does is give feedback to the other levels. Because if functional level doesn't give the right feedback, who actually knows what happens on the production stream? Who actually knows how long will it take to produce something? Who actually knows what is a ground reality in the factory? These guys. So these are the ones who actually provide the realistic inputs for the people in the business level, who further pass it on to the corporate level. Because I think at this point of time we should recollect an example that we discussed, that people go around and they give commitments at the corporate level. They are going out to clients and giving commitments. Array client, will finish this in 10 days, we'll finish this in 15 days. But without asking your own team members, how can you go and give you know commitments like that? Then there is always a something called as a interdepartmental bickering, a fight. Corporate level people will tell, ask functional level people to work more. Functional level people will come and tell hello, ask the corporate level people only to come and work. No, you are fighting on name game. You do, you are this, you are that. These guys job is very clear. They provide leadership. They are not the ones to wear the suits and work in the factory. I'm not demeaning the job here. I'm saying everybody knows their sphere of responsibility. That is why functional level guys should provide information that makes it possible for business and corporate levels to make realistic and attainable strategies. Otherwise, you'll be standing on earth but making decisions on moon. You understand what I'm saying? And functional level people are the most important ones, because they, whatever they do, they tell their ideas. This again is there in the 5th chapter, and I hope I recollected it some time back. Edson Spencer told very clearly, Array, don't go by the title. Huh? Don't see that guy might have not gone to school. That guy might not have a formal degree. But he is the one who works day in and day out in the operational level. He knows the ground reality. So don't bother about who he is. Bother about his idea. Edson Spencer's statement I'm recollecting. I like this statement so much. I always go by that in a personal life also. Very nice statement to take it. Don't bother about who the other person is. If you like their idea, take it. Who are you? Why are you telling? What is your qualification? Don't always, it is not strategic management. I think for all those who attended my strategic management classes, in the very first class, I will tell you that strategic management is a way of life. Every topic in this book is applicable to you and me. That is why so much heart is there for, so much part of my heart is with the subject, right? In the past, I've seen people comment saying that, I don't know how come this is a favorite subject only for faculties and not for students. Like if you go back, check a couple of videos of mine in old strategy management, somebody will write, how is this only a favorite subject for you? Why is it not favorite subject for student? Because from a student perspective, you have not applied the full-fledged understanding of the subject in your life. But I'm telling you, there are so many people who have come back to me in their journey of being a chartered accountant, they'll come back and tell me, sir, what all points we've seen in books so many times we've encountered, right? Very recently, somebody was reading a book on atomic habits, which makes a mention of Kurt Levin's change process. So that guy took a photo of that and sent me and said, sir, you remember we talked about this in the class and you gave us an example and you said big authors use this in their reference. And Atomic Habits is one of the book that has sold million copies, or I mean millions of copies, and everybody says that it's a great book, but they are fundamentals of management only. So the point that I'm trying to drive through there is basically these are all ways of life. And I like the statement for that reason only. Don't bother about who is giving it. Take it. Tesla's one of the great reforms were brought by one of the shop floor level employee. The weight of nuts and bolts were higher. Once, not necessarily only in Tesla. In many automobile companies, great designs in cars have come not because great automobile engineers have worked on them. Right? People who assemble in the assembly line, no, they have given great ideas. Once a guy in the assembly line, he told they were making race cars. Array, weight of nuts and bolts are higher than usual. That is why the car is not reaching the top speed that you are wishing for. Change the nuts and bolts and see, it will fly. And they did. And eventually that car went on to win a race. So who gave the idea? A daily wage worker gave the idea. And you could have ridiculed his idea by saying, hey, you are a daily wage worker, shut your mouth. But that's not what dignity of labor means. Merit of the idea. They generate the most important ideas. So small point, but a life lesson out of that. Right? Always listen. You want to apply somebody's idea or not apply, different story. Always have a ear. Listen what they are telling. Then come back to, the reality and understand, okay, if this is the case, it works for us, do it. Otherwise, silently ignore, but you need not demean them and ask, who are you? Understood? So, functional level in an organization is a favorite place to be. All great managers, you take Elon Musk, he would have spent days in the factory sleeping there only with a bit. So many YouTube videos are there showing him working in the factory. Mukesh Ambani, in the early days of his stint with Reliance, his dad and Dhirubhai Ambani put him in their Jamnagar factory. Ray, go and learn, because nobody can become a great CEO without knowing the ground realities. Steve Jobs, right, who has been very instrumental in today's what the so-called Apple brand is. He failed multiple times, right? So what functional, if you the more you work in functional level, the best you know about your own entity. They become the major strategies. A small idea now becomes the major strategy for the company later, right? I know I've taken a little more than what it needs for that point in extra, but that is, I mean, that's also the value addition I want to bring to you guys through this marathon. Okay, not just doing it for the sake of some exam. Of course, we would want to do it. And at this point of time, I would definitely want you to be focused only on the exam. But there is a day when you should come back to look at the subject much broader than that. And then you don't have to appreciate, like why I brought you through this. You appreciate the subject. Management in itself is an amazing subject, right? And lastly, these guys are responsible for what? Implementation of a strategy, their execution, right? So in doing this, we have two approaches. I think all of you know. Corporate level will tell, business level will understand and pass it on to functional level. A very traditional approach. It is called the top-down approach. Top calling it, and coming down. And then there is whatever I told you now, a feeding back mechanism, right? So the functional level will tell their feedback to the business level, which will be fed back to the corporate level, and that will help them make a new strategy. That is the FBC this time. This is going a backward integration. I mean, like backward style of story, which is called the bottom up approach. So there are two approaches to the management story. One is the top down approach and bottom up approach. Top down is where decisions are made solely by the leadership and passed on to the others, while bottom up is something where all teams are given a chance to participate. There they can voice out their opinions, right? And voicing out an opinion is not something that everybody would be given a chance for, because some people, they be like, all of you shut your mouth, it's my decision, I will tell you do. And sometimes it is good also in places like startup. If you let 10 people tell 10 things, you will not do even one thing. So sometimes it is better to follow top down. But in a well settled environment where you need opinions or understanding, you can always go for the bottom up approach. And now that you know that three levels are there, let me sum up this discussion by discussing one of the recently asked exam questions as to what is the relationship between these three levels. Corporate, business, and functional level, all three, are they related? Of course they are related. But how can they be related? They can be related vertically, right? They can be related vertically like this. They can be related horizontally like this. They can also be related vertically and horizontally, which makes it a grid or a matrix. So three ways of how it can be related. One, vertically. Two is horizontally. And three is about matrix, which is also nothing but called as a grid, right? So vertically, I hope everybody knows, because we saw the picture sometime back only. The flow was neat and clean. We saw there, right? There, we just discussed about how the corporate, business, and functional level are a clear hierarchical vertical flow. Second one is horizontal. A startup can use this. And if you've heard me right now, this line could fetch you 2 marks, because they asked in the past in the MCQs. The horizontal relationship is suitable for whom? Startups. Why? Because all have equal role to participate. In startup, you can't attribute somebody to be you are more important, they are less important. All of them are contributing, right? So that horizontal line of a structure is kind of a good relation to follow in newly established entities like startups. Some places where the resources are scarce, where you need a vertical line of authority to manage your functions, and you also need a horizontal line of authority to manage your product as a whole. So you will have product managers managing horizontally, and you have functional managers managing vertically, which I believe you know from the fifth chapter as a matrix structure, and that relation is called the matrix relation. Guys, one more time I'm reminding, by default I've assumed that all of you have done the subject properly and done one round of revision. So that is what allows me to take things for granted, which is why I'm giving you references to chapter 5. If you're a newbie, not knowing anything about strategic management, but just want to clear the exam by listening to this, good luck. God bless you. Right? For now, I can only tell that. And then there are vertical, horizontal, and matrix relationships, which have been discussed. Right? So on that note, that is the third topic that I would discuss after management, strategy, and the levels and the relationships, because now we have to go back to understand strategies behavior. But before we do that, let me just quickly see if we have all this jotted into our handwritten notes, bringing that back for you. Yes, of course, we have discussed all of it. Strategy is not a substitute for sound, alert, and responsible management. Strategy making takes place at corporate level, business level, and functional level, and the nature of relationship works at functional, divisional, horizontal, and matrix. I think that goes without saying for everything. Now, I'm coming back to this discussion here on the nature of strategy. This time, let's keep things simple. Of course, strategy is a blend means a mix, right? Strategy is a blend of what? It's a mix of two things. Actions that you do deliberately. Actions that you do deliberately, which are called as proactive actions, which are called as proactive. And then actions that we do in response to the changes in environment, which are called as reactive. No strategy is 100% proactive or 100% reactive. And I urge students not to write both. What is strategy? Proactive, reactive, both. A strategy cannot be proactive and reactive at the same time. It is a blend of, mix of, partly proactive and partly reactive. Now, if you have sometimes in MCQs a weird question as answer A proactive, answer B reactive, answer C A and B, D none, then hold your heart and just tick C, because are you told it is proactive and reactive, can't be. They gave that option, so go for it. But otherwise, in practical sense, I hope everybody understands what I'm saying here. In practical sense, proactive and reactive, it can't be at the same time. So yes, some strategies are proactive, where the organization by itself initiates the strategy and then implements it. while partly reactive strategies are those which occur in response to the changes in the environment. Okay, so on that note, that concludes our discussion on what we call as strategy as a whole. I hope we didn't miss anything. So let me just bring you back to the story. This, guys, whatever material you have with you should do the job. So the switching between the handwritten notes and the other notes should not be something of a concern to you, understood? And like I said, if you really want to follow with me, there are free resources, so you can just download and hop around, right? No sir, I have other materials, I've been doing them till now. Yeah, of course you can continue, because all the content is absolutely same. If you want to give this piece of advice to people, go take a lead and put in the comments, use any material and follow the flow. You should be able to do it. Go tell something like that, so people believe in what I am talking about, because more than they believing me, they believe you guys and your comments. So right at that point, I want you to go and leave a second comment, because you're 50 minutes plus into the marathon, and I hope you'd be now convinced. Say, levels of organization done, strategy and management done, levels of organization done. Two things. Now let's go ahead with um, you know the strategic intent to start with. But before we do that, the third topic that we're going to discuss is a strategic management, the whole subject that we have. Let's get to that. Okay, so I still have a minute left on this one. Partly proactive, partly reactive. Proactive is planned strategy, reactive is adaptive reactions. While the strategy is, when you see it here, strategy partly is deliberate and proactive, while certain times we cannot, because everything can't be fully anticipated. If you can anticipate everything, you will be called as god. Why will you be called as strategist? So yes, of course, there is a situation where people would not know about what is happening, and there is no rule also, no, that we should know everything. So sometimes you may not know, and because of which you have to give a adaptive response into the story. So therefore, the conclusion here, I want to read this line particularly before we go to strategic management, that crafting a strategy, you can see this line here, crafting a strategy involves stitching together. Now please don't talk about craft or stitching here, it is an analogy. I've joked about this back in class so many times. Stitching together means it's a exercise, that is why they use the word craft there, right? Can you read that sentence along with me? Crafting a strategy therefore involves stitching together a proactive or an intended strategy, and then also adding up to the adapting pieces of successful reactions of what the company does. Can you just take one more look at it and call it done? Done. So with that, we wrap up all the basics that are needed, which will help us to now move on to the most important topic of this chapter, called strategic management. In loud, clear voices, we have revised this in classes so much, that so much so that huge sound that you guys make in class resonates in my ears even now. Strategic management is a managerial process of, we shouted it so loudly so many times. So one more time in your own space, you can, of course, not shout this time. You can revise it for yourself. What is the definition of strategic management? Strategic management is a managerial process of developing a vision, setting objectives, crafting a strategy, implementing that strategy, and obviously making corrective adjustments, which is called control, whenever needed. There is not necessity that you have to do this all the time, but when you need it, you got to do it. And this very understanding of strategic management, I want you to understand that we do two things here: monitoring and evaluating external opportunities and threats. That is one part of that, right? And the second part of that story talks about designing strategies for your own survival and growth based on strength and weaknesses. So, which later, towards the end of the third chapter, we are going to do what is called the SWOT analysis. SWOT will be a sum of all this analysis, and that is exactly why we are doing two chapters. on strategic analysis, which is such an important stage in strategic management. And why do we do strategic management? Because it delivers superior value to customers, gives you superior returns to investors, and guarantees a superior performance when compared to others. And you can do a better job, superior performance than the others, your own employees, suppliers, government, and of course, as a responsible entity to the society also, you can give back in a great manner. And what can come up in the exam, what has come up in the exam is strategic management's definition, along with which they can ask you overall objectives, which already there's a star marked on that. Two objectives are there for strategic management, both of which are very simple. One is to create a competitive advantage, which is something that is there with you, very unique, valued by your customers. And of course, the other one is about guiding through. The environment is stable or dynamic? The environment is infinitely dynamic. We know that it is going to change so much. In such a changing environment, how will you navigate peacefully? How will you navigate peacefully? How will you go from one place to the other? If you have Google Maps, you can go from one place to the other. Strategic management is your Google Maps for the business. It will help you neatly navigate and go through that whole story, right? So, strategic management is a managerial process. Let me bring something on your screen now, which gives you an easy idea. Strategic management is a managerial process of these five things. And please remember, strategic management is not a solution provider, it is a framework. I think those of you who heard me before, you are recollecting these words. Huh? Strategic management is not a solution provider. Strategic management is not a bundle of tricks. Strategic management is not something that you can blindly do by following something. It just gives you a framework. What does it give you? A framework. The 5-step framework. You use it to your advantage, you will make the most of it. If you're unable to make the most of it, then it's up to you. So, and as you see, two objectives there. It helps you create competitive advantage and to guide the company through all the changes that take place in the environment, because environment is absolutely dynamic in nature, right? So that is what is strategic management and what are the objectives. I want you to, of course, this is where we've targeted the topic of strategic management to end at the first hour, in which we are absolutely inching towards the close of that first hour and we are being absolutely spot on. So I want all of you to, at this point of time, do this topic along with me, strategic management's benefits and limitations. And then I would like you guys to take a quick pause. I don't even want to call it a break because we'll be approaching an hour there. Take a quick pause and then run through all of what we have done quickly, so that normally, at this point I suggest you to do that, because uh, somewhere you get carried away, and maybe this is the time allocated for strategic management in today's preparation schedule of yours. So 1 hour is great. You revised enough content, and like I said, by the time we finish this marathon, you would have complete hands-on grip on strategic management. That's not your headache. It's my, I won't say guarantee, but that's my way of putting this thing, because maybe many of you are doing this marathon for the first time, but you know how many times I've done this. I've lost count on it. My like today, one of the ways to understand is you can just check the number of views that people have left on this multiple platforms, multiple places. In fact, if I do this live, right, the kind of satisfaction that I get in my live classes when we do this is spellbound. But I always used to think like that only in live this used to be great. But for the comments that I read and the involvement that people show, this like the medium of presenting it on YouTube also is amazing. So if you felt the same, we can, you can as well always at any given point of time share that feedback. Right now, I want to end your first hours of discussion with two very important questions, both of which have been in the exam so many times. So take a deep look of both those. The first one talks about what are the benefits of strategic management. The other half talks about limitations. Limitations are asked so many times in the exam, such an easy question, right? What is strategic management? Helps an organization be proactive, enhances the life or longevity of the organization. It is also a corporate defense mechanism. What is it? A corporate defense mechanism. You remember the example that I tell here, right? No matter you might be a Bahubali, you can take the sword and go to the battlefield. But if you are not ready to defend something coming from the other side, even if you are Bahubali, you will die. Because maybe you can wield the sword great, but that is why no matter how great of a warrior you are, you'll always carry a shield. I know, sir. I don't want any bulletproof vest or something like that. I'll go like that, and I am a great shooter. Before you shoot, they'll kill you. So there is a line, clear line of difference between bravery and foolishness, right? Sometimes that line is missing because bravery, if used or channelized without a logic, will be absolute foolishness. You will die even before you could do something great to the society. So strategic management is a corporate defense mechanism. It's also like a shield, right? So instead of telling you just what to do, it also can tell you about what not to do and hold up. Plus, the point number 4 is a very, very important point because, as I just told you, strategic management is not a bundle of tricks. Strategic management is a framework. So it provides a framework or all the future opportunities and understanding. It also helps you develop two very important things, which I believe we have already discussed in the later chapters: core competencies and competitive advantage. Remember that? So coming to that, two words, I'm underlining them again: core competencies and competitive advantage. But now that you know the full syllabus, you know that they both are discussed in greater detail later. Unique strengths, and then we talk about competitive advantage coming as an outcome, an earned or an achieved advantage. Strategic management helps you get that. And you already see in the levels discussion, we read one point. When functional level feeds back all the information to corporate level, the corporate level will be able to make realistic objectives and goals. Yes, strategic management provides you that framework. Strategic management helps you work with that. Strategic management is the ultimate story of how you can have realistic goals, followed by it also talks about how it can prepare the organization for facing the future by acting as a pathfinder. Because as I told you right now, Google Maps, this entire story is about how to help you navigate. Strategic management will help you in figuring out what it is and how it is and how you can go by that. What it is, how it is, and how you can go by that. Without navigating like this, there is no way how you can go. So therefore, it is very clear in your understanding that strategic management should be helping an organization. It is not a solution provider. Having said all the benefits, let us take a very quick look at whether all these benefits are been taken care. Yes, so the same benefits have been discussed under these paragraphs, alongside which we also talk about some limitations. Let's talk about four of these limitations. One, the first one talks about a complex and turbulent environment. No matter how good you are in doing your work, environment is complex and turbulent. There are so many, there are so many aspects of the environment which tell you that environment is very complex, environment is very fast changing. So therefore it is difficult for people to understand the environment in complete sense. Maybe you can understand the environment easily in parts, but understanding it in complete sense will be a challenge. Please mark this limitation carefully. Environment is highly complex and turbulent is not the limitation. That is a characteristic of environment. Environment is highly complex and turbulent is just the characteristic of environment. Because it is complex and turbulent, you are unable to understand it in full sense. That is the limitation. Plus, this entire process of following and doing a strategic management is time consuming process. Expert strategic planners need to be involved, so it is a costly process. And more importantly, strategic management is an open book concept. It is available to everybody. You are reading strategic management in this book, no? Like that. Any businessman can read strategic management. It's an easy thing to do. So, you know what you will do by doing strategic management. Sometimes we don't know that also. But when I don't know what I will do only, how can I estimate my competitor's response? You're asking, sir, what will the competitor do next? Array, what will you do next? So strategic management doesn't tell you about what competitors will do. It only focus on you. So obviously there's a limitation in difficult to estimate the competitive responses. Okay, competitors' responses, there is a slight amount of difficulty in trying to understand and get them. So guys, that is what the benefits and limitations of strategic management are. So guys, the first hours of discussion which talked about management, strategy, levels of organization and the interrelationship between the levels, and strategic management, and the entire concept of strategic management, objectives, benefits and limitations. That now, like I said, alerts me to give you a quick pause. Please take a minute and pause the video, ensure that you go through everything that we have discussed thus far, and then resume the marathon. All right guys, on that note, I hope you have taken that minute of a pause and you're coming back. Let's bring this on screen right now. What you see are something that I have been teaching for about 14 years now. The 5 stages of strategic management, the phases involved in doing this. Stage 1, stage 2, stage 3 are the stages on paper, in mind kind of stories. Stage 1, stage 2, stage 3. Intent is in your mind, analysis is done on paper, while crafting a strategy is also an on paper exercise. And when we talk about inaction, the aspects are about implementation and control. So let's step into the real world of strategic management. uh, it is not any illusion, it is not bundle of tricks, it's not magic. I've already said that. It is a purely beautifully designed framework. I have to tell you this, and who taught me this was somebody when I was doing my advanced diploma in strategic management from CIMA UK. So this is a back then I was very enthusiastic about doing that. So that's why I don't share much about it in terms of putting number of degrees doesn't make you look great. So the point is the fact that strategic management can be studied in various parts, like how today many of the students study strategic management in the form of important questions. So I've never been somebody who's a fan of that, because when there is such a wonderful process, right, which you can right away see there, why do you want to go about finding important questions when you know what importance the topic carries? So I've always been a big fan of the flow involved in the subject. Many people fail to recognize because they study this in the form of chapter 1, chapter 2, chapter 3, topic 1, topic 2, topic 3. No, not like that. Beautifully crafted 5 different stages of strategic management, which is about calling it as developing the strategic intent, where you have words like vision, mission, objectives, and goals, followed by an overarching framework of what we call as values. Then we have to do a deep rooted strategic analysis of the external and internal aspects, where in the external world you have opportunities, threats, and in the internal aspects you have strength, weaknesses, which when we at a final stage combine them into strength, weakness, opportunity and threat analysis, called as the SWOT analysis. By now you already understood that crafting a strategy is an exercise done at all the levels that are there in the organization, about corporate level, business level and functional level. And stage 4 is about implementation of the strategy. Now when you have a strategy on paper, sometimes on paper strategies look amazing, on paper strategies are really great, but when you put them into action you get to know the real truth of whether they are really working or they just sound great. So today, one of the big reasons why many startups fail is that only because it's very illusionary. On paper, it looks like an amazing strategy. Come on, we are going to capture the market, kill the market. It is going to be fantastic. We would always think that, right? But at the end of the day, if you look at the ground reality, sometimes what may sound fantastic on paper may not translate into reality. That's why many startups remain startups. 10 years later to their establishment, although they're still calling themselves a startup. Why? Because hunger is there, fire is there, action is not working, implementationary aspects. Same way, talk about taking corrective action. Those people who are not open to taking criticism, right? This is also one of the life lessons that I learned very early in my life. People will tell you things no matter what you do, right? You be the best in business. Anybody. I don't want to take uh, names individually, but I can take some names individually because if like they have no harm. Like say I can take Sachin Tendulkar. He's not going to come and do anything. But if I take somebody else's name known to the CA fraternity, they'll be like, "Arey, you are telling others this." That. Anyway, like I said, whatever others talk about me, I have no ears to that. People in this country scold everybody. They scold Sachin Tendulkar. They scold Virat Kohli. They'll be like, when somebody gets out, they'll be like, "Arey, you should have played the shot better." Then you go and play, no? We easily can comment, right? We are watching a game on TV. You can always give feedback. Oh, wow. Shot is fantastic. Very nice. To that extent, you enjoyed the game. Fair enough. He should have played like this. The movie director could have taken the movie like this. So, in criticism, there is something called constructive criticism and destructive criticism. Your criticism should add value. So, today, if somebody asks me opinion 9 out of 10 times, to be honest, 10 out of 10 times, I refrain from giving an opinion because my opinion has to have nothing to do with what your actions are. The last stage is like that control. It's about taking corrective action. A business that is not open to taking corrective action can pack up because things will go wrong. That is a part of a natural process. Things, when we attempt new things, when we try to do great things, things will go wrong. Not every time you will have a successful strategy on hand and say, yes, we have everything clear. So things will go wrong. And control is not necessary in first stage, second stage. You can go back to the root and maybe correct your vision itself. So the corrective action part is one of the most important, and it's called the core of strategic management. Many people think analysis is the core of strategic management because a great analysis can help you do something great. Some people think, no, sir, not all that vision, mission, objectives, and goals. No, they are great. The more clearly you have an understanding of them, they will take you further. Then some people say, no, sir, no matter what is their strategy that you put on paper is amazing. And leaving all this, one group of people are always telling, array, no matter what you do on formulation aspects, implementation is a real game. And if you ask me or any strategist who has understood the process of strategic management, they will tell you the truth. And the truth goes to say that control is the core of strategic management process. And those people who learn to take feedback, take corrective action, they will never fail the process. They'll fail where? They'll fail in the exam. They will fail in their attempt to gain customers. They will fail in the attempt to do something. They'll fail in the attempt to launch a product. You may not find the response that you should supposed to get for a product. Everything can go wrong. Anything can fail. But they'll not fail in the entire process. They'll not fail in their life. Why? Because they are always ready to correct and adapt. The day you say, I know, I'm not talking about a situation where you're talking about of ego. I'm talking in the sole position of saying that I know how to do what I'm doing. Very good. You know, but the process will teach you more. So that is why strategic management is one amazing process. And starting now, like I said, the initial amount of time that we invested on the basics of strategic management has been taken care. I've taken another 10-15 minutes to explain you this. So somewhere around 1 hour 15 minutes time we have spent in coming to this level to understand what strategic management has to offer to you. Now in the next segment of our discussion, I'm going to pick up stage one. So by now you should have left two comments or probably three comments, right? One for strategy and management, one for the levels in the organization, and three for the strategic management process. I don't think you should leave one more because now you've understood all the phases. The next comment you should leave is after this segment is over, calling it as stage one is done. So let's begin stage one, where we are going to develop a strategic intent. See what is stage one has to offer to you. Stage one is talking about the story of strategic intent, a deep rooted study of vision, mission, objectives, and goals. Right? So, let me just bring back the story to you. Of course, the shorter version on the chart is already there. We will just, before going to read each one of them, I want a couple of points to be highlighted from here. Strategic intent contains four aspects: vision, mission, goals and objectives always go together, and then we have values. So let's start with number one, which is called the vision. Now vision is such a beautiful thing, that is a roadmap for company's future. What is vision? A roadmap for company's future, which provides specifics about five things. If you see, I've marked 1 to 5. A strategic vision is a roadmap for company's future, providing specifics about what sort of a technology are you going to use in future, what sort of technology will you be using in future. Two, the which sort of customers you will be willing to serve in future. Huh? The kind of technology that you're going to use, the customer who you are actually focusing on. Know your customer, very important. Not just the Aadhaar details and PAN details, not the KYC that banks do. Knowing what they need, knowing who they are, how can they be held on to, winning buyers patronage, all that is there in that. What geography and what products will you be dealing in future, right? Will you continue in the existing geography? Will you want to go to another place? Huh? The geography, where are you willing to be? And products, two things combined into the third one. What geography, what product. Okay, so strategic vision is a roadmap of company's future, providing specifics about technology, customer focus, geographic and product markets. So what markets are to be pursued, the capabilities it plans to develop. What sort of capabilities are you planning to develop? And ultimately, very important point in the story is the kind of company you are willing to create. What kind of a company are you willing to create? Are you willing to create a great company? Are you willing to create another sort of a company? What sort of a company are you willing to create? So my company should be the role model for other companies, and you have to create, that is a vision. To create the kind of company that you're willing to create. Somebody's vision is like, I want to create the most corrupt company on earth. Huh? Or I want to create the most honest, trusted. You can have any vision, right? So anyway, jokes apart, you can, what kind of company are you willing to create? The five keywords: technology, customer focus, geographic and product markets, the capabilities it plans to develop, which later translate into core competencies, and the kind of company you are willing to create. So those are the five basic points about vision, right? Then the very important question that has featured in the exam many times is about the essentials of the vision. To make a vision, what are the essentials? If you look at that here, four very important words are there, very easy. In the recent times, they've asked this question many times, right? What are the essentials of making a strategic vision? One, think creatively. Please understand, think creatively doesn't mean I should think in such a way that nobody thought like that till today. Not necessary. Think naturally. You don't have to break your head in thinking in such a way that, sir, nobody thought, you see how I will think. Not necessary. You think in such a way that, the overall story works. That's all. You don't have to break your head and think differently, think creatively, think innovatively, and think leaps and bounds beyond what the existing idea. If you think in a new way, that is also creative. So developing vision requires creative thinking. Creative thinking, again, I'm saying, not you can still take somebody's idea. Sorry, it will be copying. No, you're not copying. What you're doing is, coping with the idea and thinking it creatively. Swiggy did that. They copied Food Panda's idea. Food Panda was the pioneer in food delivery business. When the world didn't believe food delivery, Food Panda started it. Execution was horrible. Swiggy corrected every problem that was there in Food Panda. Swiggy today is a multi-billion dollar organization. They thought creatively. Right decision making, smart decision making is the very important insight of entrepreneurship. So second one, exercise intelligent entrepreneurship. Mountain Dew huh, comes with the tagline, डर के आगे जीत है. What do you mean by डर के आगे जीत है? That means if you cross that fear, there is victory. Mountain Dew comes with the tagline, डर के आगे जीत है. You seen that advertisement? People jump off the cliff. Then the guy takes a mountain bike, goes and jumps. Now, if you and I try to perform that stunt, I don't know if you're a stunt man, I am not. So if I try to perform that stunt, right, I will obviously go and fall, break my leg, which eventually I thought don't have to do the stunt. A couple of years back, I broke my ankle just in front of me for doing nothing. I was standing and the bike fell on my leg. So if your time is bad, anything can happen. Point being, if you are daredevil and channelize all that daredevil in you in a wrong direction, it is not going to bring victory. So I will take off risk. If you wield your swords and go, you will get killed. I told you already. Risk also you take. Channelize the risk in right direction. Blindly taking risk is not what we need. Sir, I am all strong, sir. I will go dar ke aage, nothing will be there. You will die. So Mountain Dew is in the ad, they'll show dar ke aage jeete. How will you overcome that fear? And if not channelized, where will it go? So please understand. Vision requires intelligent entrepreneurship, risk taking ability, channelized in the right direction. Then, writing the vision. Don't tell something in the air. A clearly articulated, well articulated strategic vision should generate enthusiasm. When people read that vision, they should be like, wow, that's the vision. That is what we're looking at. Very good. So when employees read, they should be like, good, I'm working for this sort of an organization. Wow, an organization that has this sort of vision. Amazing. I like to come to workplace daily. I like to work for this organization. I feel proud about telling it to known people, relatives, friends that, hey, look, I'm an employee of A Limited. I'm an employee of B Limited. When they say employee of A Limited, wow, A Limited is such a big company. That's, depends on what their vision is. They want to achieve there. Now, just somebody comes and introduces, I'm working for Reliance. Now, they may be working in a very basic functional level position, but still be like, wow, our immediate thought will be going like, working like Reliance. So that means, are you working with Mr. Ambani? He may not even have seen Mr. Ambani there, but the brand that it creates, because Reliance's vision is so big that when you see, it enhances that, feeling that, wow, Reliance is this. It generates enthusiasm in people. And most importantly, vision is like a pathway. It shows you a clearly illuminated pathway, not just like anybody is going anywhere. A clear direction. Vision statement clearly illuminates the future direction. So, four essentials. Fourth one is answering the question as to where are we going. Done. So that is the story about the very first word of strategic intent, which is called as a vision statement. Let's come back here to look back whether we've taken care of everything. Yes, vision and essentials of vision have been taken care of. Let's move on to the second aspect, which is mission, which is more bothered at the business levels. And you know very well that mission talks more about the present business scope. It's not about what, and all of you who know this example that we relate this back to your own self. And if any of you are hearing me for the first time, I will give you this example one more time. It doesn't take long. So those people who know it, it's a very appreciative example about your own self. You doing CA is your vision. Today you're doing CA Inter, which is the mission, not Mission Impossible. No Tom Cruise in the story. Mission CA Inter, successful mission. Why? because you're doing it with all heart. Mission CA Foundation, over. That mission is over. So mission is present business scope. Today your business scope, that is what you're busy with, is inter. One mission over, doing another mission. When this will be over, you will take another mission called articleship. You will take another mission later called as CA final. So all missions are done. You will keep getting one step closer to your vision and ultimately achieve the ultimate vision of becoming chartered accountant. But to fulfill this mission, you need to break this mission into goals and objectives. Institute is saying, hello, clear group 1, group 2, they're all the goals. 40, 50, 60, 70, 80 numbers are there. Performance targets, which are in the likes of objectives. Okay, we'll come one by one. So mission talks about what? The present business scope of telling what business are we in and what do we do. These two broad answers. And alongside this is a topic, two very important questions are there. I will take you back to the main material just to see everybody can understand. These two are very possible exam questions as to why should an organization have a mission. 7 points are there which justify, because every time you see anything and everything, mission serves as a focal point. Remember, this is the keyword. Mission serves as what? A focal point from where, from why are you doing whatever you are doing today. Answer will be CA Inter with respect to your studies. Your personal life, you may do anything, right? I'm not questioning your personal life for what you're doing. I'm saying whatever you do with respect to this particular aspect of CA, any answer. Why did you wake up and come to class? Because I'm doing CA Inter. Why are you watching this marathon now? Because I have CA Inter exam. Everywhere you read anything, CA Inter, because that's your present business scope. Focal point. No matter how many 100 questions will roam around and come back, focal point will be CA Inter. Understood? That is our first point. Then, to understand what is our mission, two people, very popular management fundamentalist. One Mr. Peter Drucker, called the father of management, and the other one Theodore Levitt. They put up 11 questions, and I hope all of you know what those 11 questions are. I will just take a moment to take you through both those. What are the 7 points that justify why should we have a mission, and also, why should we answer these 11 questions. See, this is the best part of this marathon, that in the past I used to just deal that, but now that some additional value compared to the past is this, where you can just go to this material and brush to what those are, right? Let's just see here very quickly as to why the organization should have a mission. It ensures unanimity of a purpose, that everybody gives a unanimous purpose. One, unanimity. It tells you, yes, I'm doing this. Mission tells you where should you put more resources, where should you put less resources. So resource allocation, it provides you a basis or a standard for distributing resources. Then for using resources, it provides you the right motivation, sets the tone, or it's called the organization climate, which also is called the culture. Remember the layers? Atmosphere, stratosphere, toposphere, like that, the layers. So this is the surrounding of yours. What is your atmosphere? It sets that tone. Sets the tone for business operations, and it fosters a business-like atmosphere. It also acts as a very good focal point for employees. I told you, right? From wherever the employees raise the question, hello, what are we doing? Right? Then it serves as a focal point. It helps employees translate their goals into actionable tasks, where that is when you will be able to assign objectives and performance targets to it to make it real. And the very important thing is, this mission sets specifies the organizational purposes, and not only just specifies some random thing, it also translates them or turns them into measurable goals. So you can clearly see how 7 points are giving you a very valid reason as to why should an organization have a mission. Then I hope you can go through all these 7 points one more time. You have already done it. Please do it one more time. Let's now go to that piece where we will talk about Peter Drucker's 11 questions. Peter Drucker and Theodore Levitt have asked 11 questions. What is our mission and what business are we in? You'll be lucky if this comes directly in the exam. Like experts of Peter Drucker and Theodore Levitt, Peter Drucker and Theodore Levitt, both of them have asked you to ask 11 questions. First one, what is your mission? That is, what is your present scope? 2 and 3 sum together, they are asking, what is our ultimate purpose and what do we want to become? At the end of the day, what is it you want to become? So 2 and 3 put together will answer your vision. 4 is a very interesting point. I would have explained in detail in class. What kind of a growth do we seek? Why everybody is not happy with incremental step-by-step growth. Some people want to achieve something very quickly. That is like a radical growth is what they are looking at. So what kind of a growth do we seek? Get an answer for that. Then comes very important question. What business are we in? Which is nothing but the business definition. So if you go to Shark Tank, they will now ask you a first question. Hey, what's your business? So in the first 30 seconds, you should be able to convince all those people sitting on the other side. Hey, you call them venture capitalists, private equity specialists. Nowadays, we call them sharks. Sharks that live outside the water. Huh? So those sharks sitting there, you have to convince them. And because you might have a great business plan, but if they are not convinced with your business definition, they won't even listen to your plan. In the first 30 seconds, they'll listen and they'll be like, hey, okay, not interested. To put it in those people who watch Shark Tank, I am out. Huh? Why do they say I'm out? Because they don't want to be, they're not interested in the idea. So you should know the context of your business. If somebody asks you a simple question, hey, what is your business? You should be able to explain it in the broadest possible connotation. That means in the broadest context. Do we understand our business correctly? Forget about others. Do you understand your business correctly? First, we examine that. So 5 and 6 both are talking about business definition in the broadest possible connotation. Then Peter Drucker told to ask one fantastic question. Array, leave everything. Tell whom do you intend to serve? Who is your target market? Without knowing who your target market is, if you roam here and there, nothing is going to work. Who is your target market? Whom do you intend to serve ultimately? What human need do you intend to serve? Human needs are classified into necessities, comforts, and luxuries, right? So, which of this human need you have to fulfill? What brings us to this particular business? A very important point that I tell so many times, people don't understand this for a simple reason that why you came to business. My wish, sir, I want money, I want profit. Array, no, what brought you to this business? You want something from business. That's not what we are asking. What brought you to this? I went and asked one software engineer who started a company. I asked him, Array, why you are doing this? I studied this only, sir. I know to write code only, sir. What do you want me to do? So your education can bring you to business. Then I asked one of my friend, Array, why are you doing this? From great grandfather time, they're doing this business. Family can bring you to a particular business. What brought you to a particular business? Have you come because of family? Have you come because of education? I didn't write there, but have you come because of passion? A lot of people in my class generally tell that's our passion, passion. So for your additional, we'll add that also. You can come to a particular business because of your passion towards it. And then very important question, in what business would you be like to be in future? And what is the nature of business? Because both 10 and 11 both are asking about, will you continue the same business or will you diversify? And I think now you guys know the term diversification because you would have read it in the 4th chapter. Would you want to continue in the same business or you want to stretch your wings to others? So these are the two very important questions at the mission level, both of which have been asked in the exam so many times. So do not forget to revise one more round on both these. Coming back to our last branch, which talks about, last but one branch, which talks about objectives and goals. Objectives are performance targets, and objectives are to be very clearly expressed. That is, they're closed-ended attributes. While goals are like rolling a dice, future state or an outcome. You remember rolling a dice, tossing a coin, rolling a dice, picking a card. All these are probability, like a future state or an outcome. If you go to a casino, you will see one, round with several colors, numbers marked. It's called a roulette, right? So if you throw a ball into that, people bet on multiple things. The ball will stop on this number. The ball will stop on this number in this color. The ball will stop only on this color. So somebody will bet only color. Somebody will bet only number. There is one guy who puts all his money on, it will stop on this number in this color. He wins the biggest money from that, right? So like that, it's a future state or an outcome. We don't know. We want to achieve that. I want to get that goal. Goals are open-ended attributes. Now, please understand, there's a debate here. If you find some other book which says no, it is the opposite. Don't argue, because there are so many management fundamentalists who don't differentiate between objectives and goals. So instead of fighting which one is open, which one is closed, some people they go on further to say objectives and goals itself can be used interchangeably. That's amazing, no? If both of them can be told interchangeably. So that is also a argument that goes on. But anyway, like I said, we will stick to what you're doing. Now that you know objectives are performance targets and are closed ended, goals are future states or outcomes. Your group 1 and group 2, you can't change the combination, you can't change the pattern, because that is what institute decided. But within them, okay, 40, 50, 60, how much ever performance targets you want, you can achieve them. So marks that you want to achieve as part of this course, they are your objectives, your performance target. But institute says, look, you have to get 150 out of 300 for each group. That achieving 150 out of 300, though it translates into numbers, clearing group 1 and group 2 are your goals. To clear group 1 and group 2, what numbers you set up, they are called your objectives. CA vision, currently CA inter mission, group 1, group 2, my goals, marks that are in numbers, performance targets. You don't have to go and search anything outside. That is exactly what we have in our very, very simple course of what we are doing in action. Understood? Don't have to search examples outside. That beautifully you can start the stage 1 of strategic management. Now, till here, if all these are there, it's amazing. But before I go to the last one, I want to tell you what comes in the exam. There are two possible questions that come in the exam, which are talking about the characteristics of objectives. And what are we talking when we say about objectives? Are we talking about those objectives which are short term in nature or long term in nature? Let's talk about those, right? I will just take you through a couple of points that I would want to, because at this point, I just want you to understand those also. So quickly, let me take you to the characteristics of the objectives. See there. It has to define the organization's relationship with environment. Objectives should facilitate mission and purpose. Objectives should provide a basis for strategic decision making. Objectives should be set as benchmarks, standard. Hey, this is my objective. How much did I achieve? What is that I did? You should be able to measure them in a position like that. They all then comes 5 points: concrete and specific, relate to a time frame, measurable and controllable, challenging, and one objective should correlate with it. These 5 points are very valuable characteristics of objectives. You cannot take them out of objectives, and without them there are no objectives. Okay, then one objective should correlate with another, and most importantly, if you have 10 rupees in your pocket, make sure that your objectives are within the achievement of 10 rupees or 100 or 1000, whatever. Objective should always be set within the constraints or boundaries. If you have 10 rupees and you plan for 100, you will be left with disappointments. Understood? So this is a straight question in the exam, 3 stars to that. Sir, please tell me, if I have established objectives, what benefits will I get? Objectives will give you direction, enable synergy, aid or help in evaluation. Wherever gaps are there, you can find them. Which objective fulfill first, which objective fulfill next? Establish priorities, reduce the element of uncertainty, minimize the conflicts, because which one should I do, that this all the drama will not be there. Minimize those conflicts, stimulate the effort, and more importantly, aid or help in resource allocation, where you're putting more resources and where you're putting less resources, and what is the job design for people to do. Always we have two things in job design: job title, job description. What is the job that they are going to offer to you, and what is the description that you are going to have about it. So guys, that is what is our major understanding about the very first like the part of the discussion in objectives. Then in objectives, another important question is there as to whether you need short term or long term objectives. Obviously we all understand we need both. Short term objectives are quarterly or annual in nature, while long term objectives are anywhere ranging between 3 to 5 years, right? 3 to 5 years, even 2 to 5 years also is considered a long term. Which one do we need? Short term or long term? You need both short term and long term objectives. Like if you look at a list of long term objectives is a start question. It's a question in the exam. Long term objectives in these 7 areas are profitability, two P's, profitability and productivity. Then CEAT, CEET. Achieving a competitive position can be your, long term objective. Having good employee relations and employee development, 2E is very important. Employees should grow, their career should develop. Similarly, employee relations should work well. Then talk about achieving a technological leadership. You should be a technological leader. And lastly, when life is moving smooth, also give back something to the society. CSR or public responsibility. When you start business, you need not be doing charity or public responsibility. In the long run, if you do, it's good enough. Understood? So these 7 straight question in the exam so many times. Profitability, productivity, competitive position, employee development, employee relations, technological leadership, and lastly, CSR or PR, public responsibility. Usually they take 2 to 5 years, as you can see. Now, one last thing to debate or discuss here is about, should short-term and long-term objectives coincide? Now, answers are very simple. Short-term and long-term objectives can coincide. Short-term and long-term objectives can be different. I'll give you an example. 15% growth in first year, 15% growth in second year, 15% growth in third year will give you an average growth rate of 15% across 3 years. So if your long-term objective in 3 years is to achieve 15% average growth rate, then every year you achieve 15, 15, 15, where short-term objectives are 15%, long-term objective also is average 15%. Short-term and long-term are identical in nature. While sometimes we can have conflicting or differing objectives. When short-term and long-term objectives, year 1, 10% target, year 2, short-term target, 15%, year 3, short-term target, 20%. Again, you can achieve an average of 15% across 3 years. So short-term and long-term objectives, when you compare, either they can be identical in nature or they can be differing in nature. But the ultimate idea is short-term and long-term both are needed. And that brings me to the last part of our very first stage called as values. Last part of first stage is what? Values. Now, values is a overarching framework, as you can see there. Integrity, trust, accountability, humility, innovation, diversity. In fact, there are so many more values. They said common values are these. So many more values are there. And if you read Ratan Tata's quote on values, he says, you have to self-impose. I think in audit also you've studied this enough. Nobody wants to follow ethics by themselves. That is why ethics are given as part of the law and say, hello, as a professional, you have to follow these professional ethics. Ethics are not a matter that they have to be forced. My ethics should come from within. Like that, value should come from within. Sir, at which level value should be there? At corporate level, because they form vision, should values be there? At business level, because they form mission, value should be there. Or functional level, I want you to also note that, or if at all you already know it very well. When you talk about the whole strategic intent narrative, right? If you can see here, vision is there at corporate level, while mission is there at business level, and goals and objectives are there at functional level. The best part of this whole story is values are there at all 3 levels. Understood? Values are there at all levels. Values, they guide the behavior. What is the importance of values? It's a small question that we asked in the exam. Values shape up how employees will think and act in a situation of ethical dilemma. Good, bad, what to do, what not to do. In such a situation, it will help you. Values, okay, this is not something that I'm supposed to do. Let me not do it. It like values will guide your behavior. If you have good values, it will guide your behavior towards good. If you have bad values, it will guide your behavior like that. And values create a shared purpose, a sense of shared purpose. I am not living only for myself. I'm living here as a unit, as an entity, for the entity. If the bosses in the organization are corrupt, employees generally will look up to them and like, all my bosses are corrupt, so I will also be corrupt. That is what we don't want to see in an organization. Our employees should reflect the values that we follow. It should resonate. The word right there is employees who values resonate. So that is the last piece of that discussion down there. Values are important at all levels, and that is why values are considered to be omnipresent. So guys, that brings me to the end of stage one. And if you have been with me till here, absolutely go ahead and put in the comment section. Go edit your comment now. You've already put 3 complete. Stage 1 completed. Put that comment down there. Our 1 hour 45 minutes of effort has been absolutely productive. And it's time for you guys to take a break, because as I told you, when you finish one stage, it definitely mandates a break. And when I tell you like this, because we have an ultimate facility today to put things on pause, do whatever you want to, this is a time where I would like you to pause, so that it gives me an opportunity also to pause, and we will resume back right away, because all I'm going to do is to go ahead and continue the marathon. So you will be soon be able to catch up on the next stage, because stage one once is done, we are now going to move on to stage two on strategic analysis. But before we get to strategic analysis, I would like you guys to take a very quick short break and come back to do what we are calling as stage two on strategic analysis. All right, guys. So on that note, I hope you have been prepared to go through everything here. Let us now move on to talk about what exactly we are going to do in the stage two of strategic management. So I hope everybody's clear with stage one. Let's kickstart stage two, what is called as strategic analysis. Now, in the context of what we have discussed as per the definition of strategic management, strategic analysis is that process which is to be done because of the very reason that you see there. A good strategy, if you want to frame a good strategy, you cannot frame that good strategy by opinions, instincts, or thoughts. You can't ask others, like, hey, can you tell me a good strategy? What should we do about it? We are not going to ask anybody like that. Sir, I feel, I strongly sense this will work. My 7th and 17th sense are telling that this will work. Those things really won't work when it comes to strategy making. A good strategy cannot be formulated. Good strategy cannot be formulated by good thoughts, intuitions, opinions, asking somebody and all. Sir, if you then ask me how to form it, it has to be always formulated through what is called a deep rooted analysis. What is it called? A deep rooted analysis. What are you analyzing? So as part of strategic analysis, we are analyzing the internal environment, where we have two things called the strength and weakness, while in the external environment, we have something called as opportunities and threats. So now that you know that strength, weakness, opportunity, and threat, all these have to be analyzed. Four of these put together will be at the end of the whole analysis. That is, we do the whole of second chapter to know various things about the external environment. So before even we start discussing the external environment analysis, we will also discuss about the next topic, what business environment is, what goes into making a business environment. We will discuss that. And then of course, we will talk about certain important concepts in the macro and micro environment. What are there in the macro environment? The pestle factors. And we will then talk about individual factors like products, the immediate periphery. Immediate periphery means your micro environment with all the 5 forces that Michael Porter described. We will discuss product and its life cycle, Michael Porter's 5 forces model. We'll also talk about the Michael Porter's value chain analysis. We will also talk about the concept of experience curve to understand certain aspects. Then we will talk about our competitors. So what we are going to do effectively throughout stage 2 part 1. So what you're right now seeing is stage 2, right? In that, as per our syllabus, first they discussed about external environment. There's no rule that you have to do external first and internal next. In our syllabus, it is like that. Then part 2 of the story will be about doing a internal analysis, and that is exactly what we are going to stay focused on in doing. in this whole series of aspects. Now, before even we do these analysis, there is something that you would have to know about strategic analysis. That is, there are three very important issues to consider about strategic analysis. Now, before we even do that, what exactly is this concept? And I want you to understand this, since I explained you this part one and part two about how internal external environment are. I want you to see a flow of certain aspects. Like, it is a basic thing that there are a couple of things in the internal environment that we analyze, and then there are also about three things that we analyze in the macro perspective. Let me just bring that to you and show you. So right now, when you do strategic analysis of the external environment, this framework becomes a very important thing, right? The firm's internal environment, which is there here, which talk about strength and weaknesses, and whoever are the firm's stakeholders, wherein we talk about who are the key players, who are you supposed to just keep informed, who are those people who need to be given low priority. There is a topic called Mendelow's matrix that help you have a greater clarity and understanding on that. And when it comes to the other three names that you see there, right, this one right here, we can see the names: industry shaping competitive forces. The industry shaping competitive forces are those whichever I told you right now. What are our products? Who are our competitors? What is your market? Who's your customer? What is the broader perspective? All those points will be covered in the industry shaping competitive forces. It's more to do with immediate external environment and what are our competitive forces within the same industry. Then we'll talk about macro factors. These one: political, economic, socio-cultural, technological. All these are macro in nature. Now, what you need to understand is, though they are macro in nature, I mean, we are going to talk about, right, my bad on the spelling, macro in nature. And what you need to understand is there are two levels. These macro factors at the domestic level, and these macro factors at the international level, which is also something called as globalization, right? So we will, a very extensive chapter, this one, chapter number 2, covers all of these parts. So first part, we will start discussing what is strategic analysis quickly, then business environment, then micro and macro environmental understanding, then macro environmental factors, and then all the individual micro environmental factors in greater detail, like what products, customers, competitors. Then we will move to the next chapter where we talk about firm, its stakeholders, Mendelow's matrix, industry drivers that affect us. Once we are done with all these topics, whatever we discussed in chapter 2, whatever we discussed in chapter 3, we'll make a bundle of everything of this and put that into a SWOT analysis to complete this story. And that is when you will be commenting next saying that we have done stage 2, right? So if you have not left the stage 1 done comment, please go do that and then come back and continue to listen the long story in stage 2. And we will then in stage 2, meanwhile between stage 1 and stage 2, I'm also going to give you two or three more milestones, right? We'll see at various points where we can go ahead and say conquered. Obviously one would be the five forces model. That's a very important juncture. There you can say one, and then probably towards the end we can do one more, right? So let us go ahead with this framework. I hope everybody understood what we are up to in the entire stage of strategic analysis. Let's, before even begin external, let us concentrate on the few aspects as to what are we going to analyze. Strategic analysis is as I just told you, strategy formulation requires more than intuition, opinion, and instincts. You can't just go by some deep instincts. My seventh sense said, 17th sense said, so I will do this, I will do that. It will not work like that. There is always a possibility that, you know, your intuitions can sometimes go wrong. Yeah, a lot of times our intuitions help us, but there are always possibilities that, that too in business kind of an environment, it is not always practical to blindly believe on instincts alone, or because competitor did I will do. It is like just because somebody has a tattoo on their hands, you burnt your hand to look like that. So it's a very risky thing to do because somebody in the environment did. Maybe they did because it works for them. For us it might not be the real case. Okay, so therefore strategy formulation requires more than intuition, opinion, and instincts. It must be based thoroughly on a analysis of the external and internal resources. So this process of doing strategic analysis is called as environmental scanning. Just like how we have MRI for the brain and CT scan for the chest, heart, and all of that, internal working of the human body. If you want to see and study the internal working of a human body, we do something called as scanning, right? Now, whether you do this scanning formally or informally, use a process, don't use a process, all these are something that one has to take into consideration. A continuous activity, which is called as environmental scanning. You're watching it deeply to figure out, where what can be done. A continuous activity done formally or informally to gather meaningful information is called as environmental scanning. And then probably you can do some informal aspects, like my competitor launched a YouTube video, or they launched some Instagram reels announcing new products. So by watching news, social media, there is also a chance that we can know about our moves of competitors. So that also you can do through informal techniques, which can prepare you for the better. And this entire concept of strategic analysis is a very detailed methodical process which is used to make resource investments. Resource investments are nothing but where are you putting your time, where are you putting your energies into. 5 M's we talked about: men, material, money, machinery, and market, right? Where are you putting these 5 M's? Huh? How are you going to evaluate your business plans? How do you stay ahead of competition? And in doing this, two important situational considerations are arising, which is exactly what we're talking about as industry and competitive conditions, which are external in nature, strength and weaknesses, which are internal in nature. While there is no necessity that you have to do one analysis after the other, first external, there's internal, there is no rule like that. Very important point. You can do anything first and next. Sir, in fact, we want to do both parallelly. Can we do so? Absolutely, you can do both of them parallelly. There is no compulsion that you have to do them, in this particular manner only. There is no rule like that. So, therefore, what we are going to now do is an exercise which has no sequence. In fact, if you see practically, there will always be two departments, and these two department people will be, working around always to see exactly what we will be. Both of them parallelly will work. Some are working on internal factors, some are working on external factors. But there will be one final strategic team which will sit and collate and consolidate all this into a broader SWOT analysis that they will do at a later point of time. Okay. Importance of accurate diagnosis. When you're doing this kind of analytical sequence, it starts with appraisal of external and internal environments. You then evaluate various strategic alternatives, which is what we're going to do in chapter number 4, which is called as strategic choice. And finally, choose a strategy. So within external, internal, there is no order. So can I write that line saying starts with appraisal of internal, external? Of course you can. Again, in our syllabus, external chapter is first and internal is next. If you do internal first and external next, there is no harm. After doing that, choose a right strategy, implement it. And then you know what to do. Once you choose a strategy, then the story goes to the step 4 and 5, implementation and control. Now, very important point is about accurate diagnosis. The more accurate the diagnosis, the medical word. Normally, if you see the stream of medicine or something like that, right? Medical stream is very, like focused in using this term called as the diagnosis. Why are we really bothered about diagnosis? Now, if you see what diagnosis accurately makes sense is because see the whole logic, as you see, it works around certain things. And if you are not aware of what that logic is, then you will be roaming around here and there without knowing what you're doing. Long-term direction won't be there. Just like how doctors will not be able to give you the correct medication if they don't know, the right problem. So that is why diagnostic center is it called for diagnosis. Your blood tests or your scans are done for that reason only, to find out the root cause of the problem so that they can address that. Helps managers set a long-term direction to define objectives. So this accurate diagnosis is important for you to create a long-term direction and then create a winning strategy. So without understanding the external and internal factors, strategy may fail, may fail. Or some people may go blind at it. No, they may not do. Yeah, they may not. But yeah, still, that is why they said may fail. You can be successful also, but it's like no guarantee. Yeah. Without understanding external and internal factors, strategy may fail to build a competitive advantage. Sir, but I will do strategic analysis. Will everything work well? Now you know that I've been telling you this many times already. That if a concept is somewhat good, there are always possibilities that some limitations will be there. No matter how good or fantastic that any topic is, these inherently will have some limitations. Why? Because when a good concept is always coming with many points, those points work under certain circumstances only. So when they are not met, generally you will find every topic will have some limitations. I've been joking about this, so when everything will be going very smooth. Suddenly one word will come. However, nonsense generally starts with the word however. And you know what it says? Everything will be going said. However, these things are not. So like that, in the concept of strategic analysis, we have a couple of very important limitations. The first one says, strategic analysis, when you do it, gives you so many options in the analysis, but it does not tell you which one to choose. It does not tell you which one to choose. And in choice making, you may make a mistake because analysis is not a activity that gives you solution, right? It provides innovative option, but does not indicate which one to choose. Does not indicate which one to choose. So many options may come which are overlapping, confusing, difficult, and that could prove to be a challenge sometimes. Plus, analysis can be a time-consuming activity. Some people believe that a waste of time, sir, all these analysis and all. Directly, let's jump into action. So sometimes analysis can obviously be time-consuming because the largest time-consuming part, no doubt, is implementation. But equally, another time-consuming part of the entire strategic management process is analysis. But again, it's a double-edged weapon. The better you do the analysis, the greater you can execute also. With that, it brings me to the last part of the discussion in strategic analysis, which is a very, very important consideration because this has been an exam question so many times. So, in this leg of our doing, after the first chapter is done, this is the last topic in the strategic analysis called as the issues. This question has been asked in the exam so many times. The 3 issues to consider for strategic analysis. 1. Strategy evolves over a period of time. Strategy evolution will happen over a period of time. Strategy is nothing but a series or numerous small decisions taken over a long period or extended period of time. Strategy is a series of small decisions made over a long period of time. And there's no second thought about it. It evolves as the outcomes become clearer and get updated with new insights. I think all of you know. One time when we make a perfect strategy, there's nothing called a perfect strategy as such, right? Things keep changing. So a radical strategy change occurs when management is always aiming for accelerating the growth, to speed up the growth. Remember, strategy evolves over a period of time. 2. If anybody asks you a question, which one is important? External analysis important or internal analysis important? A reasonable balance. Okay. Though they gave the word balance, I would like to emphasize that that balance also should be reasonable. A reasonable balance of external and internal factors, both external and internal factors should be there. Strategic decisions must balance opportunities, influences, and constraints. Everything. Opportunities, influences, constraints. Now that you already know this, entering a new market is called market development from Ansoff Matrix. You know that. It may be driven by an opportunity, but while entering that market, you may also be constrained by presence of a large competitor. In that market that you're newly trying to enter, a competitor might already be sitting who can, like spoil all your plans. So therefore, it is important for you to understand both external and internal factors and strike a reasonable balance between both. I don't care about others, sir. I only care about me. That's a very good personal life strategy. But in business, it doesn't work. You have to bother about competitors. You have to bother about their actions. You also need to say what they do well. I mean, like what they do well and what they don't do well. That is something really important, which will give you a control on what you are slated to do further. The third important issue to consider in strategic analysis is the presence of risk. Risk is an inherent part and parcel, and I want all of you to understand that risk is classified based on two aspects. Risk is classified based on sources, risk is classified based on source, and risk is classified based on time, two aspects. Source means where does it come from, time means short term or long term. So before we discuss that, there is a risk in strategic analysis because environment is dynamic, things are changing, all these competitors, globalization, technological changes, all they pose a kind of a risk. That to at what degree? A varying degree. When you say varying degree, it means it changes according from time to time. And degree here is a measure. See, you cannot measure it in quantitative terms. So that is why they're saying varying degree. At any given degree, there could be a risk that it comes. Now, when will it come? It can come in the short term, it can come in the long term. Where can the risk come from? Risk can sometimes come from outside the organization, from the external environment. Sometimes the very risk can come from within the organization. Like, for example, you take this one, external risk. So basically, there are four categories: external risk, internal risk, short term risk, long term risk. Now, when you make a four box, which I just want to show you here quickly. Short term, long term, external, internal. So, four: short term internal, short term external, long term internal, long term external. Four specific categories of strategic risk will ultimately form part of the story, right? Let us talk about external risk, which occurs due to inconsistencies between the organization strategy and external forces. When external environment forces change, like for example, the change in government policy, change in political, economic, or demographic environments, political, economic, or even the demographic environment, if there's any change, then we're talking about internal risks which arise from forces within the organization. Our own employees, see, I gave you the example HR. Our own employees are not adapting. Suddenly, our own employees are creating a problem. Key managerial person resign. All this could become, suddenly they can become a risk in terms of you don't know what to do. So, therefore, the purpose of the analysis at the end of the day, you still know it, is what? Help you to identify opportunities, threats, strength, weakness, which in other words, this entire purpose of analysis is to make sure that we do in simple terms SWOT, we are able to plot this or not. And as I told you, risks are categorized based on what? Short time, long time, and errors in interpreting environment is the short time external risk. Organizational capacity is the, unable to cope with the changes is the internal short time. When you see external long time is about obsolescence of a technology, and while long term internal risks are about you are not developing your internal capacities and preferences as required. So all this could turn out to be the risk factor. Done. So that is exactly the set of 3 points that we have in terms of the strategic analysis discussion, issues in strategic analysis discussion. So with that, the final picture of what we do in strategic analysis is right now there in front of you. The framework in external analysis, that is across the entire second chapter, we will be seeing all this: customer analysis, competitor analysis, market analysis, the overall macro factors. All these here are the macro factors. You analyze all of them under the bracket of external analysis. We will analyze our own performance, which is about profitability, sales, customer satisfaction, quality, cost, all of those under the internal analysis. Then determinants. Determinants are numbers and metrics, indicative your past and current strategies. More qualitative in nature, these ones. Past and current strategies, strategic problems, capabilities, constraints, strength, weakness, more of which are what you are or who you are. The determinants analysis, they are called. Okay. So we are going to do this in chapter number 2. and some part of that is also discussed and extended to chapter number 3. At the end of all of this, you should be able to prepare a SWOT analysis. And then what should you do later, which basically is the story of chapter number 4. Actually, this entire thing that you see here, this is part of chapter 4 discussion, which is about strategic choice. With all the knowledge that you get through analysis, you should go for strategy identification. Then from the identified strategies, select the strategy which is a very good strategy. Whatever is a good strategy, select that from the above list, implement that, and then review those strategies to see. This is something that everybody who knows strategic management should understand. Identify various alternatives, select that strategy, implement that, and review that strategy. This is what happens from time to time. Okay, so let me just take you through to our previous depiction. Issues are there, all 3 points. Strategy evolves over a period of time. Both internal, external environment balance should be there, and the concept of risk is inherent part and parcel of the business. That has been discussed. The framework of strategic analysis discusses all of these points, so that also has been summarized. And of course, we will discuss micro and macro environments. So on that note, you can consider the discussion of strategic analysis to be done. So if you want to take a quick look at what we have discussed under stage 2, the whole introduction of strategic analysis, then we can now move on to discussing what exactly is the definition of business environment. What are we actually talking about it? Where do we stand with respect to business environment? All these are some of the points that we are going to discuss and deal with in detail. You can put me on pause for a minute and just brush up with what we discussed in strategic analysis, and then we can resume the discussion on the second part of the chapter called business environment. All right, I hope you have gone through that. So let us get back to the discussion on business environment. Now, in terms of discussing about business environment, I think there is something which can make up to the exam here, which is about what are the benefits of doing this business environmental analysis. So first, before I discuss anything, I would want you to understand what you see there on screen about business environment, which is a slight simple discussion. The business environment is complex, highly dynamic, and also constantly and continuously evolving in nature. We know this, right? Now, alongside this understanding, I would want you to know very clearly, those of you who heard me in classes, you know this part. We will come back to that point. Business environment talks about all the external influences which affect the business. That's its basic definition. So you know what a business environment is. Anything that surrounds. So for you to understand this clearly, I always use this picture right here, right? Moving up this one a little bit, you can see the macro and micro environment. Now, if you see here, there is a firm in the center, right? This firm that is there in the center, it is having strength and weaknesses inside that. So inside this firm, what we have circled here, there is strength and weakness, okay, which we can't see basically. Strength, weakness. Immediately what is surrounded, this closer circle, what you see, no, this is the micro environment. While we can move this word here, the larger circle that you see outside, no, that is the macro environment. So micro environment is the circle that is closer to the business, while macro environment is larger. What many people think, the immediate periphery surrounding the firm is internal, the other one is external. No. If you slightly focus on what this entire understanding is, it is a very, very simple depiction. And I want people to know strength and weaknesses are not visible when you see. They are something that a firm have, and unless you deeply analyze as to what those are, you will not be able to see what those are, right? So you have to do a little piece of understanding on what those are by doing the analysis, and then only you will be able to know what those are. Understood? Take a more clearer look at this. So what I'm mentioning there is this firm has strength and weaknesses which we can't exactly see or depict. the strength and weakness. But in the broader perspective of understanding, many people think, whatever is visible, that is the strength and weakness. No, that is not the internal environment. That is the micro environment, which is in the immediate periphery to the business. Okay. So thereby, the inner circle has all the micro environmental aspects, while the outer circle has all the macro environmental aspects. Now, before we go to this analysis here, which gives you a very neat, clear view of what we do in business environment, which I will take you through in detail, I want all of you to have a quick understanding of this question, because this can directly come in the exam. Why are we doing business environmental analysis? Okay, so let me just take you through that on this side. What are the benefits? I've already put a star to that question. They can always come back on that. Benefits of environmental interaction, right? 5 benefits are there. One, it will help you to. So I hope everybody knows the definition of business environment. One more time. It refers to all the external factors that affect business decisions, plans, and operations, which also helps you determine the interaction with the environment. The interaction with the environment helps you determine what sort of opportunities you have, what sort of threats are there, and more than anything, we are talking about what could be our competitors' actions. So these are all the points that we have seen down there. And then when we talk about benefits, right, this is a possible question that can make it to the exam. One, help you determine the opportunities and threats. It gives you a direction for growth. 5 simple points, guys. Helps you determine opportunities and threats. Gives you a direction for growth. Helps you do what is called continuous learning, which encourages managers to update their knowledge and skills on what is happening in the environment. And very important point, which is again a hidden, but the secret of success for many business is how they build an image surrounding the understanding. Businesses can respond to environmental needs by creating a positive image. So, like, say, for example, a pandemic is going on. Every company can't be a very shrewd and say, we'll operate like this now also. So, sometimes, give it back to the society. That kind of attitude has to come and work, right? So, that is what the image building part of it is. And of course, we will at a later point of time in this chapter continue to do what is called as a competitive landscape, which will help you about meeting the competition. Meeting competition talks about analyzing competitors' strategies, analyzing or analyzes the competitors' strategies, enables businesses to adopt something effectively. So, these are the benefits of environmental interaction. This could directly make it to the exam. This could directly make it to the exam. So, therefore, determine the opportunities and threats, put up the direction for growth. Continuous learning is necessary. Image building can happen. And for meeting competition, you can always analyze your competitors through a competitive landscape, which at the end of this chapter, we will be doing. Okay. And on that note, if somebody asks you why should you do strategic analysis, the need for strategic analysis is very clear. Strategic analysis evaluates the internal external environment to ensure competitive advantage and also sustain a high performance for survival and growth, right? So I think all of you have clear understanding of these 3 words, though they are not really part of your syllabus. I've emphasized on them many times. Businesses should always have something called as strategic responses. Sir, I don't want response, sir, I want to keep quiet. Keeping quiet is also a reaction. So silence to the environment, proceeding with caution, or dynamically doing something, all of this will mean that your action towards environment has some response. So 3 strategic responses are there, which talk about least resistance, proceeding with caution, and the dynamic response. So businesses must continuously assess, respond, and adapt. Assess, respond, and adapt to the opportunities and threats so that you can have growth and success. This is the idea. And strategic decisions are very crucial for the business success. And the corporate level, which is there sitting at the top level, they play a key role in formulating and improving the strategies. Everybody, one more time, you know that the environment is dynamic and unpredictable. Therefore, constant efforts are needed to improve. So that is the role of strategic decision making. Strategy people are involved in doing this so that you can get a clear understanding of what is going on in the environment, which is so dynamic and unpredictable, and what are some things that you and I can do about this to make the story better. Okay, so considering that, we will now discuss micro and macro environment, a very simple yet a very important analysis, right? Instead of trying to buy heart something, try and understand the logic behind what is micro and what is macro. So if you see what exactly is the micro environment, immediate factors which are there in the environment, immediate factors which are there, they are called the micro environment, while larger external forces which have a significant impact, larger external forces which significantly impact the business, and more importantly, they are beyond the direct control, beyond the direct control of the entity, and that is why they are something called as macro. Micro factors, I'm not saying micro factors are completely something which is in your control. No, nothing like that. Even sometimes the actions of people in the micro environment, you may not be able to completely hold a tab on them. But yeah, definitely it is much better than the macro environment. Like for example, this government, you have the least amount of control on government policy. You have the least amount of hold on demographic aspects. So I am now going to discuss with you micro and macro factors. For macro factors, there is a detailed discussion in this topic all at one place, which are titled as the elements of macro environment. But micro environmental aspects, whatever are there, they are discussed in greater detail. Like there's a separate topic on customers, separate topic on competitors. Going forward in the next chapter, we have a topic called strategy group mapping to identify who your real competitors are. So micro factors, which include even your business as a product, your forces that immediately impact through five forces, like that. There are so many aspects where micro environmental aspects are re-emphasized. For now, just to have a quick conclusion about who the micro environmental factors are: employees, customers, the methods of raising finance, your two financial management topics of debt and equity. Suppliers are there in the immediate periphery, the local community, the surrounding in which the firm operates, and the competitors who directly impact you on a daily basis, the direct competition. All these people are termed as our micro environment, while the macro environment, as the name goes by, consists of external factors beyond the firm's control. So we don't have a real hold or control on those aspects which are considered to be macro in nature. I hope you are well aware of these two terms. Being students of economics, micro means small and macro means big or large. Before I discuss the elements of macro environment individually, where we have demographic, political, economic, socio-cultural, technological, and legal factors, I would like to quickly show you the whole depiction of this entire discussion in a simpler frame, which gives you a more detailed understanding, bringing that, yes, exactly. See there, the business environment you can see has been split into micro and macro. While micro is titled as the immediate periphery, macro discuss all the broader forces that are there in the environment. So micro talks about customers. I wrote everything. It is a shortcut to remember cosmic, COSMIC. Customers, the organization, suppliers, market, intermediaries who are there, competitors who are there, all these people make up to our micro environment. While in the broader context of macro, the study of population and its characteristics, study of population and its characteristics are in the likes of demography, political, economic, socio-cultural aspects. Well, when you talk about economic, We generally talk about GDP, uh, consumer index, price index, inflation. They're all the factors that are there. Technological factors, which talk about what is the current technology in use. Legal, which talk about the laws and regulations in the country. And one of the very important, hidden, silent, but very important is the socio-cultural aspect, which gives you a brief about traditions, values, beliefs, and customs of the people. So let us have an overview of all these points, just quickly running through all of those. You don't have to by heart, but any of these can at any given point of time become questions in the exam. So demography or population, what is there about demography or population? To start with, let us get to the very first factor of demographic environment. Coming back here, it talks about the characteristics of population. That is what the demographic environment is. Considers factors like race, education, asset position, house ownership, job position, and what sort of degree of education is there, which region are you in. So demographic data, whatever we are studying, is very vital. Vital means important for businesses and economists to analyze the potential and trends. Say, for example, in India, we have a lot of youth population. So, what can we do with the youth population? Where can we put the youth population to the right use? And that is what the demographic study is relevant to India. India's younger population is a larger proportion, which attract all the multinational companies which come here. So we have Bangalore, Hyderabad, all these as IT hubs for the world, right? So just like how we have Silicon Valley in the US, we have Bangalore, Hyderabad becoming the IT hubs. Chennai, Hyderabad, Gurgaon, Noida, all these places have become the BPO hubs, right? So anyway, I mean, widespread companies are there everywhere. But like I said, why is it? Because in India, the younger potential, the younger talent is available so much for doing all of these. So at the onset, what is the question to be asked? The key question to be asked for business are, what demographic trends are relevant to me? What demographic trends will affect the market size? What represent opportunity? What represent a threat? Too much population. So a lot of population is there for us to do business. Looks like a very good opportunity, but there is also a situation where that same thing can also be a threat. There is so much that you can't cover, and because of which it is looking like a big challenge. So therefore, those companies which are seeking to make an understanding, again, sometimes you can't sell products which are anti-cultural, right? In a particular place you went and that place does not have the culture to use that product, consume that product, or eat that product. There you can't forcefully put them to use that product. That will not definitely work. So therefore, we'd be talking about four very important factors in population size: geographic dispersion, the age distribution, ethnic mix. Ethnicity means the origin, where do these come from, and more importantly, income distribution. And since you're students of economics, you know very well that this unequal distribution of income, which is leading to rich people staying in certain places, middle income group staying in certain places, and the lower income group staying in some other places. Now, accordingly, depending on income and geography, you can again schedule where to put your business. So, changing demographic patterns, if you are able to identify them well, things would become way more simpler or easy. That is what the first story of demographic environment is. I hope that sums the purpose. Let us move on to the next one swiftly, which is talking about socio-cultural. Now, I want you to understand very clearly, while socio-cultural talks about traditions, values, beliefs, literacy levels, ethical standards, how the society is split. You know this word from audit, stratified sampling. Same way, stratification, a process of dividing a heterogeneous into subhomogeneous. So how people are scattered socially, social stratification, and are they staying together? Are they staying apart? Cohesiveness, which is about togetherness. So all these factors come under socio-cultural environment. Traditions, values, beliefs, huh? And very important point in this is, sir, now only we studied about population. Then again, what is the difference between population and socio-cultural? See, demographics talk about population as a whole. They don't talk about individuals and their behaviors. Socio-cultural talk about society, individuals, their behavior. This is the big difference, and I want all of you to know it. What is the difference between socio-cultural and demographics? If you see that, while socio-cultural is very clear in terms of individualistic, the focus on behavior and belief system of a population rather than the entire characteristics of population. Individual aspects of each part in the population is saying. If you study the overall population, it is called demographics. Under that, for each individual, what is the culture, belief, value, tradition of individuals? If you see, that is what will be something to do with the demographic versus socio-cultural difference. And generally, if a group of people are there in a society, core beliefs tend to generally be persistent. Everybody might believe the same thing. And since they are deeply rooted, a culture is very, very difficult to change. You can't go somebody and, hey, what you're following is all outdated, change it. Try saying something like that to your grandparent. They'll be like, hey, shut up. We have been doing this for 50 years. Socio-cultural aspects have such power that if you have been doing something wrong for 100 years, but because you've been doing something wrong for 100 years, and it's a valid, accepted custom. So there's no right or wrong in culture. Culture is about somebody's practice, right? So that is how this can have a impact. Understood? So that is what the second factor, socio-cultural. Swiftly moving on to the third one, which is called economic, which refers to the overall economic situation. All of you are students of economics in foundation. So you know what the economic conditions are, which talk about the supply, cost, quantity, availability of resources. Lionel Robbins, the whole theory of scarcity told that, resources are limited. So studying and understanding the economic environment of a business becomes a very important thing. And studying and understanding the economic situation of a place or a country will let you know the real income. You remember purchasing power. Whether people in this area do really have the purchasing power to buy our product. If they don't have, then you are just wasting time. So that is exactly what you have to see there. And then we also talk about what we call as the economic environments factors. What are the factors? GDP, per capita income, total population you take, per capita as a national income divided by total population. Do you remember things from foundation there? GDP, NFIA, net factor incomes, GNP at market price, then NNP at market price. Then we adjust it for indirect taxes and subsidies. So we'll get the NNP at factor cost. NNP, net national product at factor cost, is called national income. When divided by the total population gives you per capita income. So GDP, per capita income, capital market strength. IPOs is the primary market. Secondary market is called the stock market. So both these, what is the strength of a capital market? Interest rates in a country, inflation, the situation of inflation in a country. All these are very, very important because high interest rates are not very conducive for business. High interest rates are not a very conducive thing for business because some businesses won't get easy credit, right? So that is a challenge which may limit the buyer's ability to buy. So availability of credit will help customers also buy more. Availability of credit will help businessmen also do business. Bottom line, understand the state of an economy, whether it is performing well or it's poorly performing. First three factors, demographic, socio-cultural, economic. Then comes the political and legal environment of a country, which is very important in terms of understanding the flow of events in a country, whether the country will prosper, because the political agendas should not be something that will stop the growth of the country. Country's real growth is in the governance. So which political party is ruling? What laws and regulations are they bringing? The ideas of political parties called political ideology. Now, if political parties are forming government based on alliances, and suddenly if alliance partners terminate, government will collapse. That is not a very conducive or likely situation, right? So what is the political state of a country? Political development, political stability, law and order situation. I would not want to do business in a place where the law and order is not intact. So I would generally like to do business in a place where everything is conducive and like, okay, this is a good place to do business. I would like to do business in such place. So what are the government policies, taxes, duties, all of that we will have to consider, because high taxation is a challenge. No taxation sometimes, boosts businesses. So it depends, like what we are doing. And even duties, must see, majority people can't operate without tariffs and duties. I think you studied those also in foundation and economics. Tariff and duties are important. That is also a roadmap for country's growth and success. So whether a country is allowing FDI, FPI, all these presents, so whether the country is a conducive place to do business, whether the political and legal environment of a country are conducive enough to do business, laws with respect to patents, copyrights, intellectual property, labor laws, forex laws. I think for all of those, one word is called a sound legal system. So one, political stability should be there, sound legal system should be there. If both these are there, then it attracts a business to do business. And the last of macro factors is called a technological environment, where technology is a very, very crucial factor, right, in today's world of how people communicate. The way we do business today has drastically changed, right? Instagram has become a business platform rather than a photo sharing platform, right? Facebook has Facebook Marketplace. So today, even we're not leaving the social media. Large scale meetings are happening on Zoom. So today, the way we communicate, way we do business, everything has changed. So yes, of course, there is a huge impact of technology on business. It reduces the paperwork. You can schedule payments, coordinate your inventories effectively. You can uplift the concepts of just in time, because right now online ordering is possible. Everything that was once a dream is today very easily possible. And the best part about technology is they remove all the boundaries. They shrink time and distance. They shrink the time and distance, reducing cost and gaining competitive advantage. So if they ask you only what is technological environment and how does it impact the business, you just write this and take your marks home. There are very rare chances that they will ask you everything from you know the concept of macro environment, right? All the elements of macro environment they may not ask, but what they can ask and what they have asked is the summary of all of these in the form of what you call as, okay, yeah, the last point in technology says today technology is creating a lot of opportunities and threats. Yes, absolutely. Old technologies become obsolete and new technologies provide new business opportunities, like AI and machine learning. They're as much encouraging as much threatening they are. So nowadays we have robotic process automation, RPA is being used in audit. It is amazing to see all of that. And this particular piece, which I would like you guys to do always, is the PESEL analysis, which is a tool which combines all of this. The PESEL framework, earlier used to known as PEST framework, which is nothing but the same components what we just discussed: political, economic, socio-cultural, technological, and legal environments. The components of that. So please do the the key factors topic very clearly, because they can ask you to write this in the exam, and this has been multiple times asked. PESTEL analysis and what exactly are. Everything in a PESTEL analysis has been already discussed: political, economic, social, cultural, technological, legal. This last line you see, environmental factors. Additionally, I would like to add that what are the environmental impacts on industries like tourism, farming, and insurance. And climate change awareness is creating new markets and somewhat destroying the existing ones. So this is an additional point. If they ask you pestle analysis in the exam, which they have done multiple times, so that is exactly why I want you to put a star to the topic and see it in full, to run through that as a revision of what we discussed across the last 20 minutes. So in this session, we have done two topics, guys, as of now, wherein we talked about the entire story of strategic analysis, and then when we have discussed about business environment and the micro macro factors that it has, and the summation of these topics which are in the likes of a pestle analysis. I would like to give you a break, but before which I would like to do a small topic which talks about what we call as globalization, because hardly there is anything internationalization or globalization. So I would want you to guys to go through all these points in the uh, vessel analysis, and we will do this last piece of internationalization of business, and then I suggest you take a break from the marathon where we've done 3 topics of in the second chapters, first set of 3 topics: strategic analysis, business environment, and now, as I showed you in the beginning, the first page of this chapter has a flow diagram, right? We are understanding the internal factors, the firm and its stakeholders, but that we will do in the next chapter. Then there are 3 points which talk about industry factors, domestic macro factors, international macro factors. So now we are going to do that last piece in here: internationalization of business, which is about going beyond the boundaries of the domestic country. So what about internationalization? If you see what exactly is the story of internationalization, it is going beyond the boundaries of the home country. And I would like to obviously also discuss with you the facts as to why should we go global, which is a very, very important question that can come in the exam. So let's get started with this. Internationalization has become a dominant commercial trend over the recent decades. Every business would not want to limit themselves anymore to the domestic country. They would want to take their businesses to new markets, achieve greater earnings, access to cheaper resources. All of this should be made possible. But the big question is why? Why should we do internationalization? Do you really have any benefits of doing internationalization? Yes, it helps you get economies of scale. Ah, I didn't explain this word throughout the session, so since it's coming the first time, it will come many times further in the syllabus. But for now, yes, economies of scale mean what? The benefits of producing in large scale. The benefits of large scale production is called as economies of scale. Rather than producing in limited scale, if you produce in a larger scale, it's always better. And also extends the lifespan of various products. So the strategic management process is similar. Whatever you have been doing at the domestic level, now you will just stretch it into global level. So the role of international aspect is very simple. You will identify opportunities and threats only, but not locally anymore. You will do it for global markets. Same thing what I discussed in or before, environmental scanning. This time your environment has changed from domestic to global. Environmental scanning at the international level is what we are talking about. A critical tool for identifying various global opportunities and threats. And 3 things which are common for a global entity. 2 stars the topic or the characteristics of global business. Yeah, 3 characteristics are there: that global entities are linked by common ownership, they have common pool of resources like the money, material, machinery, manpower, all that they can switch between one place to the other. Now, like I have some good employees in India, I can send them to US. I have some good employees in US, I can send them to India. Like that, I can mix and match. I can use a little piece of money here, there. So common pool of resources, and more importantly, all these guys who call themselves a global business and work under one aspect, they have or respond to a common strategy. They respond to what? A common strategy. So 3 characteristics of global business that could quickly spark to be a question in the exam. It's a conglomerate, that is a combination of multiple units with common ownership, have a common pool of resource, and have a common strategy. 3 words that are common. Moving on to a question that has come in the exam is, while developing internationally, what will you focus on? Many people thought this is a small paragraph with no relevance. It made to the exam. So while you're developing internationally, what is your focus? International development is expensive and challenging. So therefore, moving in a very thorough and structured manner is necessary. Blindly, I'll go international means you will spend a lot of money on expansion and then fail. So if you want to avoid that, understand what you're doing and then go for it. Evaluate the global opportunities and threats. Describe the scope of your firm's global commercial operations. Sir, our firm's global operations are like this. Very workable. We can do it like this. Well, good. Go for it. Sir, as the firm, we can't go for global level operations. Then don't go. Because blindly walking into a road that you have not walked before is not something that anybody is suggesting you to do here. So taking that into consideration, create the firm's global business objectives. Till now, you've been talking on the regular business objectives. Now, you create the firm's global business objectives. And finally, develop corporate strategies which span for the business, that is for whole organization at a global level. This 4-point question has made it to the exam, guys. So while developing internationally, doesn't it look similar like what we have done in the past? Same thing, but only thing with a little more focus on what we are doing. So evaluate global opportunities, see whether the scope of this firm globally will be able to clearly define what they will do globally. Create a firm's global business objective and develop the corporate strategy for the whole organization now globally. The last question that is there under globalization is a very, very important thing, which is very possible of coming in the exam as to why businesses go global. It's a 9-point answer, and I would like to slightly shrink in here to show you all the 9 points at once. The first 3 are ambition driven. Businesses go global because they feel there is a need to grow. They feel there is a need to grow. Then, shrinking of distance, time, and space. Like today, we have the best of communication, faster transportation, financial flow. Just by clicking buttons, money can move easier and faster. So, reason number 2 why you can go global is because time and distance have shrunk. And the third one, domestic markets are no longer enough for you to recover your entire money. So when that is not enough to recover, you look for obviously outside your current periphery. And therefore, ambition wise, you are driven to go global. This 9-point answer, I don't know. I'm praying that it should come in the exam and all of you should get 5 out of 5. So later, just remember this. If at all this comes in the exam in the upcoming attempt, you come back to this space and I'm not a predictor though. I am just somehow, it's a strong feel that is. So whichever attempt you watch this, and in that attempt, if it comes, just come back and comment after all this is done. Anyway, right now, the second set of 3 points they're talking about opportunity. Why do businesses go global? Because there is an opportunity, they will go global. If you go global, you have access to new resources. Transportation cost will come down. Foreign market will grow for your product. Why not? When 3 opportunities are there, why will I not go for it? Access to resources, reducing transportation cost, and growing foreign markets. Aren't they amazing and enough for me to grow? 3 ambition driven points, 3 opportunity driven points. Then let's just talk about 3 legal reasons as to why you can go global. 1, the number of services have risen so much. Rise in the number of services and economic integration. Today, service sector contributes. Service sector is the largest sector in the world right now. And why not? When rising services have happened, why not contribute? The last but 1.8 one, everybody knows this, called as liberalization, lower trade barriers, has always been one of the big reasons why we can go beyond the boundaries of our country. And you can join hands. Maybe when you did this first time, it was a little piece to understand what strategic alliances are. But now I'm hoping you did that topic called strategic alliance, so you know that there is some time you can join or join hands with people who we can have temporary arrangements with, and those are the people who are called your strategic alliances. So 3 legal reasons. That is, 1, you can increase the number of services. The rise in services has helped you provide more. Trade barriers are low, liberalization is there, so why not go global? And lastly, if you join hands with global allies, which is like you can look forward into the future of growing your firm big. So 9 solid points as to why your business should go global. Let me just give you a full view of that. And also at this point of time, I can give you a view of whatever we have summarized for globalization as such. And that also I can bring it to you via this. And guys, I think we are done with our first hour of the second chapter. So I think between stage 1 and stage 2's completion, as I told you, there are some milestones where you can leave comments. So if you have watched everything till now, you would have left a comment for strategy and management. you would have left called strategic management and stage one's completion. Right now, you can leave a comment saying gone global. That means we have gone up till globalization. We are not going global. Just, you know, I'm pushing you to do something funny, nothing more than that. So go to the comment section, and if you've done till this topic, go leave a comment called as gone global, and then take a look of this globalization topic being split into three branches to end this discussion as to what is globalization, what are the characteristics of a global company, and the 9 reasons that we discussed for going global. This also, I think you can see clearly now as why we can go global. So on that note, guys, I would want you to definitely take a break here at this point of time on globalization, and then we will come back because we have in the next session, we have something very interesting to come: product, its characteristics and product life cycle, followed by value chain analysis, followed by Michael Porter's 5 forces model, and then the other part of competitive and key success factor discussion. So the next half of this chapter has very interesting topics in the likes of products, 5 forces, experience curve, competitive landscape, key success factors. So let's get up to that, and I would like you guys to take a moment of pause, take a break, and come back to watch the next part of the marathon. All right, guys, I hope you have taken that break and you are back. Let us now move on to discussing the next topic. As I told you, this piece has a very interesting discussion about products, product life cycle, and other aspects. So let me just take you through that as well here. Moving on to the next part of the discussion: product life cycle. First, we will see the base idea of what the concept of product is. Now, generally, people think product has to do only with goods and services. This part has been clearly explained to you in the class as well. Products in the modern times, it's not only about the goods or services, but it is also about the experiences that people crave to have in nowadays. So products are about three things. So I want you to understand this concept as 3, 4, 5. Three things that make up to the product, 4 stages of the life cycle, as you can see, and then also the 5 characteristics that you are seeing here right next to those set points. Now, what are the 3 things that make up to product? Keeping it that simple to start with, when you talk about a product, products basically are either goods which are physical in nature, or nowadays we can deliver goods virtually also, like a software is a good delivered virtually, ebook, e-classes, all of those, some goods which can be delivered virtually, that is not in tangible form. Then comes services, banking. Starting with banking, one of the most easiest services. So you know the long list of services in India, being one of the leaders in service sector right now: IT enabled services, tourism services, mediation services, intermediary services. So many services is one of the largest sector right now. Now, what is a good? What is a service? Everybody's clear. What is this experience? So sometimes you pay for a commodity not to figure out, what exactly that commodity it is, or what just is the commodity in terms of its physicality. No, the usage of it. Going to a first day, first show movie. You're not paying 500 rupees extra for the movie, because movie will come, you can watch it that day evening also, next day also, 1 week later also, later on OTT also. First day, first show, you are paying for the experience. So like that, nowadays there are a lot of aspects where people are craving for an experience and paying for it. So that's what comes in handy here. So experience is the other kind of feel that you get out of the product. And every product has 5 characteristics. How many characteristics? We have 5 characteristics. If you see what those are, every product either is tangible or intangible. Every product is either tangible or intangible. Then every product has a price. Every product delivers some customer satisfaction, right? Every product is core or central to the business. And most importantly, every product has a useful life. After that particular time, that product will stop being anymore useful. So let us now look at some of the points which we are supposed to understand. Businesses obviously sell products. Now you can see here, it might be a good or service, being clearly mentioned, good or service. It can either be a physical good or a service. Now, all those points that we have talked about, or an experience to have a understand. Five characteristics, and this has been one of the exam questions that has been repeated multiple times. So just a small topic like product and product life cycle has been asked multiple times in the exam. So why not make the most of it? Products are either tangible or intangible, right? Products are either tangible or intangible. Tangible are physical, intangible or non-physical, right? Sometimes, mostly, generally in the nature of services like telecom and banking. Price. All of you are students of economics. You understand price is a composite expression. It is the cost involved in making the product plus other overheads plus a margin for the producer, right? And also, most importantly, it is reflected by the interaction of supply and demand forces. We know that price, cost, quality, demand, dynamics, everything mixed up. I am a student of economics, so I don't have to really explain that. But every product comes with a crucial factor called satisfaction. All the products will have some features. Now, the feature can be about color, the feature can be anything that can satisfy the necessity or the need of the customer. It satisfies customer needs. What does it satisfy? Customer needs. And it also optimizes features which will enhance the user experience in delivering what is called value satisfaction, which in other terms we discuss later as customer value. So, products deliver some kind of satisfaction. Every business to be successful should have a product which is central or core of the business. Products are nothing but the core of their business. And lastly, every product will have a usable life. You can use it for 6 months, 1 year, 5 years, 10 years, but someday products will be done. They must be replaced after that time. So, five very simple points. One more time. Let me repeat. In fact, I can show you the summary one more time here. Yes, products are tangible or intangible. It has a price. It has to deliver satisfaction. It is pivotal for the business. You can even pivotal means important, or you can even call it as the core. Okay, and every product has a useful life. One of the most easiest concepts in this entire textbook is the product's life cycle, that we understand that every product has about 4 stages it has to go through. Product life cycle is an S-shaped curve. I mean, you don't really see it to be an S-shape, but yeah, they call it an S-shaped curve because it has to come down and again go up. It look like an S, which depicts 4 successive stages of the product. And what are those? Introduction, growth, maturity, and decline. Introduction is a stage where the product has been right now newly introduced into the market, where the growth rate is not really high because you're still waiting for product's acceptability. But yeah, the product definitely has some kind of a future there. It sees, like, okay, there is something to do with the market understanding or the introducing and the market launch, some basic marketing campaigns, all that will be going on, followed by growth. What do you mean by the growth stage? Where there is a rapid market acceptance, right? And maturity is when the product has reached the peak, and then decline is the stage where the demand for the products fall down because people started to choose other products. Can we just cross check all the 4 terms here? Introduction is a slow sales growth, right? Growth stage, we have a rapid market acceptance. In the maturity stage, there is a slowdown in the growth rate and this market stabilizes. And obviously, because your product has reached maturity, there is a tough competition leading to declining profits. And ultimately, in the decline stage, there's a sharp decline both in the sales and the profits. Sharp decline in sales and profit because new products are replacing the existing one. In all 4 stages of a product life cycle, you can't obviously consider the same strategy, which is why it is important to know in which stage your product is. So PLC helps businesses in diagnosing portfolios and identify in which stage their products or businesses are, so that they can give a right treatment accordingly. 4 stages: introduction, growth, maturity, and decline. So if your product is an introduction stage, you can consider in expansion. You can consider introduction or growth stage. Obviously, you can put more money into it and go for expansion. While your product has reached maturity, now that I told you in marathons, the best part, since you know the whole syllabus, you should be in a position to understand. You remember in the strategic choices, we do have a topic called as a stability strategy. Remember that stability is not a do nothing strategy. When a product generally reaches a maturity stage, we will go for it. So that is why they are telling here also, in a maturity stage, you can use these as cash sources. So you can just from whatever money you want to get out of that business, because a well established product can reach maturity. As of now, it's not declining. If you soon see declining, we'll say buy to it. But as of now, you can use to fund the other venture stability strategy. And then decline. What do you mean by decline? Selectively harvesting, cutting off portions of businesses, or doing a retrenchment strategy will be called as the strategy to follow. So basically, stability, expansion, retrenchment, which are the three corporate level strategies. What are you going to do with the product's life cycle? So there's a close link between the PLC and the corporate level to take these decisions, right? So I think the first set of 10 minutes after the break, that is the first topic for us for now. Product, product's characteristics, and product's life cycle. Right, with that, let us move on to the next important topic in this chapter called value chain analysis. So guys, as I told you in the previous sessions end, very important aspects are there in this particular thing. Like the first one, now if you heard the last 10 minutes, right, if one of them turns out to be an exam question, which both of them have been, product life cycle has been an exam question, characteristics of products have been an exam question. So if you're lucky and get any one of them, done. Very recently and more frequently also they ask questions from value chain analysis. Now, Michael Porter's value chain analysis is a method by which strategists understand where value addition is happening. Value chain analysis, though the topic is given here, its actual use is there later when businesses tend to identify their core competencies of these value chain aspects. You will understand where value addition is happening. Now, once you are able to understand where the value addition is happening, that portion where the most value is added in business, that you can consider as your core competence. So your core competence can sometimes lie in HR, your core competence can be in procurement, your core competence can be elsewhere. So basically all that we're trying to say is, look, this is our core competence and this will help us get our competitive advantage. So a method used by strategists to understand how much value of an organization generates, and it breaks down the process to identify the areas for efficiency improvement and in which areas you can gain competitive advantage, so that you should understand the steps which add to value, so that you can easily understand which step is value adding, which step is non value adding. If you see any of the steps to be non value adding, why do you want to hold it? Why do you want to really hold on to those steps? You can, if a step adds or subtracts value, if a step is adding value, hold to it. No sir, the step is actually pulling us down, because of this value is coming down, then you can again figure that out and try and see here whether value chain adds or subtracts value. It links the activities to assess the competitive strength of the organization. The concept was introduced by our well-known Michael Porter, linking value-adding activities, and he categorized the activities into primary activities and support activities. In one of the exams, they asked primary activities, which follow an order. In one of the exams, there are support activities, which are only four but don't follow any kind of order. But if you look at what is the main idea of this concept, please understand, if you have 5 M's, you won't be successful. Men, material, money, machinery, market. We have everything, so we will be successful. That's a bad idea. Organizations are much more than the random collection of machines, money, and people. You should validate the sentence, and it's so important here. Competitive advantage comes from organizing these, not just having those five. Did you get the logic there, right? If you are having all these, you have to organize these into a much more proactive, sensible manner, right? So organizations are more than resources like machines, money, people. Competitive advantage comes from organizing these into proper systems, and they deliver the value. Okay, so guys, let us talk about the primary and support activities. You can see this is how the value chain looks like. Basically, you can see there is a element of primary activities in the bottom, followed by support activities are there here, To do these primary activities, these support activities stand as a help. That is what it is. And here, as much as you can find an order, it will be very important in the primary activities. Can you see that? So these are the primary and support activities, and they definitely help you in trying to understand what the value addition has been. Okay. So primary activities, you follow the order because that's easy to understand like that. Get the raw material in. Inbound logistics followed by operations. Operations, the process of transforming input into final product. While inbound, so instead of just seeing their names, because we have the content in front of us, we can as well see RM to receiving, storing, and distributing inputs. Purely the RM part is inbound logistics. Same thing is when subject to some procedure will be operations, transforming input into final output. Then those outputs you are collect, store, and distribute those to the customers, and that is called as outbound logistics. Then comes marketing and sales. Marketing is a process of creating an awareness, marketing, while service is nothing but the after sale service that we have to do. Because many people think when you finally deliver a product in the hands of customer, the story is over. No, story doesn't get done there. Story gets over only when you support the customer. Because if you want a customer to be with you, you can, if you want a customer to buy a product, you can do that. But if you want a customer to be with you, not just buy, repeat buyers, then you obviously have to, you know, involve them in doing some kind of a service which can uh, enhance or maintain. Like say generally automobile companies do that. Cars, they don't sell the car and say buy, go to hell, we don't repair. They'll have a service center along with them. AC, they won't sell an AC and leave it. They do installation. Why? So that they can enhance. So marketing, as much as you create awareness, marketing should be followed by sales, creating awareness and then enabling the customer to buy that. Marketing and sales, and finally services. That's it, is the most visible piece. That is why inbound, operation, outbound are mostly not visible to our human eye as such. If you are talking about a product, marketing, we can see advertisements or billboards and promotions and everything. Sales, we can see that they are doing through retail stores or retail stores or anything. Services, we can see. That is why used a different color to highlight them also, if you see, right? Now, so that is one part of the story. Then moving on to the other part of the story is about support activities. To do all these 5 primary activities, you need good support activities, and I want to emphasize and highlight this word procurement every time I do this, because many people are the wrong opinion mean procurement of raw material. No, procurement in this context is a broad word. Procurement does not mean procurement of raw material alone. In this context, throughout the like Michael Porter's theory, procurement means procurement of resources. All the resources, you procure any resources, any method that you use to procure any sort of resources is called as a procurement, which is a process for acquiring the needed resources. And it has got nothing to do with you know uh, raw material alone. Men, material, money, machinery, any resources, if you are acquiring the resources, that process is called as procurement. Then adapting the latest technologies, technological development or technology is a very very important support activity. And please mind you, technology here doesn't mean only use of some very hi-fi software or something like that. No, if I'm using the stylus to write on screen, this is technology, right? Earlier I used to use a whiteboard and a black marker, right? Before that, I used to use a blackboard and white chalk. Every time I wanted to depict something only, but the way. So the simple pen is a technology. The marker is a technology. The stylus today is a technology. So we have attributed this word technology so much to computers. That is why every time we talk about technology, we think it's computers. No. Earlier, they used to wash clothes on stones, right? Bash the cloth on stone and wash. Now today, in advanced, the latest washing machines, we have a stone mode. Stone mode means it washes it so hard that it gets the effect of a like washing it on stone. So concept is same. The presentation and the depiction of that is different. So I think this is one of the most easiest to examples to remember. So even now, many of the previous students are making fun of stone wash. They keep telling why, because this is a logic, right? Technology. Washing machine is a technology, physical washing of clothes to washing machine technology, right? Cooking in microwave is a technology. So basically, technology is anything that eases up your life. So this focus on product technologies like R&D, product design, the process improvement that you make, that is a big support activity. Then no matter, then I'll talk about infrastructure. I'll come to HR last. Infrastructure is again not only building. Many people think again infrastructure is a loosely interpreted word, that infrastructure means only these things. No, anything, finance infrastructure, digital infrastructure, quality management system, all the departments of the organization, whatever are there which are value adding, right? That is what planning, finance, quality control, information management, all of those, they're all part of what you call as the infrastructure of the organization. And the most important things to cover all these all these eight activities, five primary and the other three support activities are HR. HR is the most important activity, because without human resources, an organization is going nowhere. So HR services or HR management covers recruitment, training, developing, and rewarding employees across the organization. So if you understand what are the 9 value adding activities, you can see them on screen. All these are the 9 value adding activities, while Michael Porter called them into a very beautiful concept called the value chain, right? Let me also show you the summary as to what these are. You can see value chain analysis, organizational activities. You brought it over there. Take a clearer look of what the value chain activities are. 5 primary activities and 4 support activities. Because right now we are going to go into a very important discussion after this. I hope everybody's clear with value chain. So that's the second leg of the 10 minutes. The first one is about product and the concepts of product. Second concept is value chain analysis. Let us move on to one of the very important pieces of our discussion, which is again talking about the industry analysis. That's where the 5 forces model comes from Michael Porter. So as a small insight, let me bring this to you. The industry and environment analysis, to gain an understanding of the industry strategy, whether it is lucrative, that is attractive or not, we have to do a industry analysis, identifying who are our competitors, right? Competition's intensity. Sometimes competitors are there, but they don't really affect you. Sir, what do you mean by there but don't affect you? It is like competitors are definitely there, right? But they are only competitors by book definition. Sir, what do you mean by that? That means, you're saying that, okay, competition is there, but they are not immediately affecting us. So how much competition is there? Weak competition is there, normal competition is there, intense cutthroat competition is there. That is assessing, that is called as competition's intensity, measuring that. Michael Porter gave 5 words to measure the intensity. We will see that also. And then you know the market position of the rivals, their tactics, what are their success factors, how much profit will this industry be able to make, that entire thing. They are the key insights. To understand the key insights from industry's environment, we are going to use the Michael Porter's 5 forces model, a wonderful tool to do this. Okay, so let us get to understanding the Michael Porter's 5 forces model. Now it analyzes the competitive environment, identify the key sources. One more time, I'm highlighting that key source of competition, helps business adapt the strategy and boost profitability. And more importantly, it is the main reason why Michael Porter's 5 force model is used. It enables you to utilize a strong position. If you are stronger than your rivals, that position should be made the best use of, and you can get the advantage. If at all you are in a weak position, or we are weak here, so that we can try to recoup that situation, so that you can avoid future mistakes. That is also something that we can do through the Porter's model. And Porter's model is a basic unit of analysis, for it focuses on what? On the level of industry level competition. It is focusing on the industry level competition, trying to understand, what best you can do to stay within the parameters, and understand if there's anything serious that's happening right now in the industry, or nothing is there, so that you can really not bother much. Because two things are a danger, ma. When you act when you don't need to act, and when you don't act when you're supposed to act, they both are dangerous situations. So if you know who your forces are, like say, I think all of you know the forces, so I'm talking about new entrant in the first place. So if a new entrant is coming, or you are seeing that new entrants are trying to make an entry, So you have to assess what is the capability of the new entrant. If the new entrant can come and destroy something big time, it is better that we stay quiet. No? Why make complicated aspects, and why do you really want to break that? Arey, no, sir, new entrant can come in and do nothing. And then, so accordingly, according to the forces that are in motion, we can take our actions. Right? So five forces are rivalry. Three forms of competition are there. All these three are forms of competition. These three forms of competition can affect you. First one is called as rivals. Then the other one is called substitutes. Rivals are people who sell the same product as we do, while substitutes are those people who sell a different product. What do they sell? A different product but serve the same purpose. These people are somebody who do that. And then uh, new entrants. New entrant can be anybody, but why is them? Why is that it's becoming important? Is because they're newly entering into the market. They can be anybody. They can be a rival. They can be a substitute. Or only thing is that they know when they come in, they come with some significant amount of pressure that to exert. Sometimes new entrants can be stopped. We are also going to see that question because that is one of the most asked questions of this topic. What are the barriers that one can establish to stop new entrants from coming in? Okay, we will see all that. Then there are two very important forces which are, guys, I am warning you here again. Buyer and supplier are not forces. Buyer and supplier are human beings. They are people. I mean, not human beings. They can be entities or anybody. But please remember, buyer and supplier. Many people are writing buyer, supplier in the answer. If I'm correcting a paper, I'll mark it wrong because buyer and supplier are not forces. The ability of a buyer or supplier to bargain is their force. So remember, buyer and supplier's bargaining powers are the actual forces. Buyer and supplier are entities or individuals. It can be anything. So these five are called Michael Porter's five forces, which have been depicted. I've also put them in the summary. I will show you that. But before we do that, let's talk about the small start point where three steps are there. The strategist can use the five forces model to determine what sort of competition is going on or what competition is like in the market. Step one, identify the competitive forces coming from these five forces. How much competitive pressure is coming from these five? The pressure we will give a ranking. Is it fierce? Fierce, strong, moderate, normal, weak. If it's normal or weak, you will be like, okay, sir, leave it, no big deal. If the competitive force is fierce, strong, or moderate, then some kind of strategic adjustment has to be done. And the point is not about taking one of them and finding something here. The point is about taking their collective strength. I've always given one very simple example at this point. Let me give you now one more time. If somebody throws one stone at you, what will be your immediate action? You will put your hands to block it. That's a normal human reflex. Now, if they throw one stone and they throw another stone after that, so first we'll block one, then we'll block one, right? Then one, two, three, they're going on throwing you one after the other. Then you will do some action like this, that, and stop, right? If they're throwing three stones at you at once, then you have to be a little, what do you say, little bahubali. Take knife, this, that, wield, and stop all three coming at the same time. Now just imagine if they're throwing 5 stones at you, 10, 15, it's a rain of stones. Then unless you understand what I'm saying, you're wielding your knife here and there, you won't be able to stop. Because I was able to stop one. Now one after that, if somebody is throwing me at 50 stones at me, and if I'm good at stopping one stone at a time, I can always stop all 50 stones because only one is attacking at one time. But market is not like that. Michael Porter says the collective strength of these five, because these are all in motion at the same time. One side buyer is irritating you, one side supplier is irritating you. Suddenly, new entrant is coming. I am not saying always all five forces will be there, but yes, there is a possibility that in the extreme, imagine if all five forces are operating in the market, you will have a horrible time. Okay, so you have to work around and understand. So what is the exercise, sir, that we are doing? Understand which pressure is attacking you. So first you make a list of the forces, right? Force. You make a column like this. Forces. 1, 2, 3. What are affecting you? Make. Against each force, write about their intensity. Sir, what is the first force that you are bothered about? The first force I am bothered about is my rival. Okay. Now, How much the rival intensity is very fierce. So many rivals are there, sir, fierce. So then the second force that you are bothered about is substitute. Sir, what about your substitute? How much intensity is there for substitutes? Our product does not have much of a substitute. So substitute is weak. So like that, you list down these one side and then give them a ranking on the other side. Then exactly you will know what to do with each one of these. So this concept, what you saw just now, this piece of discussion is called as the Michael Porter's 5 forces model. Okay. Now, very important point is the individual understanding of all the 5 forces. Let us take one force at a time. To start with, let us start with the new entrants. Okay, but before we do that, I would want you to see something quickly here. I've already made a summary of these points here. Let me bring that. So in industry environment analysis, you're dealing the 5 forces model in the first place, and you can see the firm is at the center. The firm is at the center, and it is dealing with buyers bargaining power, suppliers bargaining power, right? New entrants, I mean rival substitutes and new entrants. While buyers and suppliers bargaining power are individual forces that can affect, when will they affect? All those points are also given. 7 points are there to avoid new entrants. What are the barriers? I have summed up that also. In certain industries where rivals are there, there is something called as the cutthroat competition. We will talk about that also. So let us now go through all these points which are there in the Michael Porter's 5 forces model, which will eventually be helpful for you to understand the exclusive competition that is available in the market. So let me, so summary is very much there. I will bring this back on screen, and as I said, as we are done with this topic, will again, I want you to make a moment of pause and go through all the 3 topics of products, value chain, and 5 forces model. Then we will resume our discussion again. Okay. So let me come back to the uh, thing here. Yeah, there it is. New entrants. Who are new entrants? New entrants increase competition. Okay, we know that. They add to the production capacity, because a new entrant comes inside the market, they'll not fold their hands and sit, they'll produce. Now, what is the danger of they producing? Nothing, but when they start producing, supply will increase. You're all students of economics, I already told you. When supply increases with the same demand, will the per unit cost for the other decline or not? So if more number of new entrants are entering into the market, new entrants reduce the profitability, right? And they increase the supply, and thereby potentially lowering the prices. Potentially what? Lowering the prices. New entrants also challenge market share and force the existing firms, and what? Force the existing firms to adopt that. So therefore, guys, the situation is a little tedious here in terms of understanding. So how to stop new entrants? Put 3 stars as I've marked already is one of the most asked questions of this chapter completely. So 7 points are there. First one, capital requirements. If any industry you have to enter, like pharma, telecom, and aviation, are the 3 are the toughest sectors in India. Pharma, if you have to establish a pharma unit, lot of licenses, permissions, not only licenses and permissions, but also huge factory setup. Telecom, again, spectrum licenses plus equipment. It's not easy. That is why you've seen nobody enter the telecom industry of the Geo. Same way aviation, right? Many people who enter aviation, few years later they're closing. The only big success story of Indigo, the Interglobe Aviation, is not the only case study that you should understand. There are so many people. The Kingfisher Airlines, Go Air, and Air Deccan. There are so many airlines which have started and they have failed. And even today, many of the airlines that are operating still in loss, because aviation again requires huge amount of capital, not just to buy the aircrafts. After that, also operating costs are also high. So one of the very toughest sectors is civil aviation. Like that, if an industry requires huge capital requirements, new entrants generally don't show interest into that. Okay, so capital requirements, industries requiring large capital investment may not be of very attractive choice. Economies of scale. If existing players who are already there, if existing players who are already there in that market are producing Okay, if existing players are producing at economies of scale, their per unit cost will be very low. Just like what I'm saying, say for example, you are entering into a market and you are producing a good which China is the leading manufacturer. Now, China is producing that good so cheaply because of their volume. The volume at which China is producing that product is so huge that you are not able to meet their per unit cost by far. And that is exactly why, since you can't do that, you will never be able to, what I say, match their price also. So that discourages a new entrant, because new entrant we think, what is the point, sir? If we go in and try to produce also, we'll never be able to produce at their per unit cost. So reason number two, which is the barrier for new entrant, the economies of scale of the existing firms. Three, if existing firms are producing differentiated products which are unique product features, if existing firms are already who are there in the market are producing unique products, a new entrant cannot directly barge in and come and, what do you say, match that uniqueness. And since a new entrant can't match that uniqueness just immediately, the challenge will become higher for them later. So unique product features or enhancements like physical or perceptual, let it be any differentiation. But if existing players have differentiated products, then it will be again a challenge. Switching costs is a very important point, guys. I explained this quite detail in the class. So if you know what exactly I'm talking about, nothing. When you're switching from a product A to product B, there's always a switching cost involved. Which cost? Financially, psychologically, or maybe even operationally. Costs that are incurred by customers. Costs that are incurred by the customers when switching to a new provider. Say, for example, I'm switching from Apple products to Microsoft products. So earlier, for all Apple products, we had all Apple ecosystem, that kind of a charger, that kind of a cable, and all of that. Now, if I'm shifting to Windows, my laptop is different, my charger is different. So from switching from Apple to Microsoft, there's a switching cost involved. So the new entrant who comes in is bringing a product which incurs a high switching cost. It will discourage people. They will be like, hey, why to switch from that product to ours? We already are comfortable with this. No, why switch? So they may again resist from switching, right? And then high switching cost, deter. Deter means stop the customers normally from that. And if you are entering an industry as a new entrant, and in that industry there is somebody who people show strong brand loyalty to. If you are a strong brand, new entrants are afraid to enter because they cannot beat your brand identity. Strong brand loyalty makes for new entrants a difficult time. Existing players, if they have strong brand identity, beating their brand and you going in is again a different challenge. And if existing players have access to all distribution channels, the more the existing firms control the distribution channel, that is, existing players are wholesalers, retailers, they're already available online. You name a distribution channel and they're already available there. Then there's no way how you as a new entrant can go in and conquer everything out there. So the access to the more existing firms have access to distribution channel, the less will be the chance of new entrant to beat it. And lastly, very important point, this I generally relate to the behavior of dogs. This last point, it's called possibility of aggressive retaliation. Okay, possibility of what retaliation? Aggressive retaliation. That is, threats of retaliatory actions. Existing players, you see this behavior in dogs. There are some dogs in every street, they keep fighting between themselves all through for the food that they get, this, that, and all that. But the moment a new dog enters that street, all these dogs will team up and shout so much that they will force those new dogs to get out. This is called aggressive retaliation. You can understand why. Because already the food supply is limited for the existing dogs itself. They themselves are fighting. So that existing is called market share. Already 10 people are fighting for the existing market share. Now if you allow 11th one, just because 11th one came, market size can't increase, no? Somebody donating food in the street, array, more dogs are there now, let's donate more. They won't do that. Whatever they are doing there. So what will happen? With the same food, if you allow new people to come in, they will also share that. And just imagine, if new people, whoever have come in, they have more power than your existing one, then that could obviously create even more a problem. Understood? So it is exactly why one needs to take into consideration the retaliatory actions of the incumbents. Incumbents means existing people. So the incumbent dogs, if they are shouting on the new entrant dog, that's all. The new entrant will get afraid and run away. Why enter a market? Why get shouted and go? So some new entrants are like, okay, sir, we will not go only. That's the best thing to do. Understood? So these are all something that you have as one of the very, very, very important questions to see there. They are called the possible barriers to the new entrants. See there. Done. Very good. Please go through it. You have an ability to put me on pause wherever you want, so you can do that. And I hope you're doing it whenever needed. Now, moving on to the second Michael Porter's force is called buyer's bargaining power. Buyer, if they are fully aware, right? Guys, if you remember the shopping with mom example here, uh, I went to shopping with my mom. She will ask a 800 product for 80 rupees. Does it ring a bell? And I hope those of you listening to this for the first time, I'll just tell you a quick example. So if I go around shopping with my mom, she puts the shop person and us to the embarrassment. Shop fellow will say 80 rupees, I mean 800 rupees. She will bargain it by simply striking off one zero, say 80 rupees. I am like, what is going on here? Did you hear properly? He said 800. Then she'll be like, hey, you wait, you don't know anything. Then best part of the story is 2 minutes later, shop fellow is giving that product for 100 rupees. She's buying that and going. 800 rupees he told. She asked for 80 rupees. Does it even make any sense? That is only because she has a full knowledge of what that product is. So those buyers who have full knowledge about the product, they have complete information. If I was there in that place, shop fellow would have told 800. I'll be like, no, 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 you have to give me for 750 rupees. 800 is too much. Shop fellow will be like, no, sir, please. 750 is too less. I won't make anything out of that. Please pay 780. I would have paid 780 and bought that product and gone home thinking that I bargained. 20 rupees bargain. 800 he told I bought for 780. When I go home and tell I bought it for 780 and they reveal that price actually 80, you paid 700 more. So there'll be a heartbreak. Not only heartbreak, if I do that with my mom, she'll cut my meals also. So that is why in territories where you are less aware, it's better that you shut your mouth. Do let those people bargain who are the best in their business, right? So look at that point properly. But tell me something, when will buyers also be able to do that? See, this is not a skill that every buyer can exhibit. That is also something that you have to understand. Okay, it's not something that every buyer can exhibit. Only those buyers with full knowledge, they will be able to do this. Full knowledge should be there. And if buyers are big buyers who are like bulk buyers, buyers who spend significantly. Nowadays, DMart is a big buyer. DMart buys directly from Hindustan Lever, Britannia, Dabur, everybody. They make orders of such big size. That is why you are able to see DMart able to sell at a lower price than the others. Because when they procure only, they procure at such lower price because that is the kind of confidence that they have that they can sell. So they buy so much quantity that they are big buyers. They can bargain better. Products non-criticality. If a product is very essential to me, I will go to any extent to buy that product at any price. But when the product is not very essential, shop fellow is telling, you buy this product. I'm like, not required. I'm going. So when you say I'm going, they understand that okay, it's not very essential to you. So if the product is not very essential to buyers' needs, you can command a more bargaining power. But if the product is more essential, shopkeeper knows, array, this product is very essential to this fellow. He will not go from here without buying. Then if you do that acting there, I'm going, I'm really going, standing near the door and saying I will go off, he will be like, please go off. Do you want me to open the door? That is supplier's bargaining power. When the supplier knows the product is very crucial to you, they will use that bargain. Same way, if it is not very useful to us, we can use that on there. And plus, people form cartels or groups, concentrated buyers. When buyers all team up, which is again a strategy from my mom and her friends, right? They do with all these vegetable vendors, sari vendors. They'll, a group of she and her friends will sit there and they'll, target the sari vendor. Be like, look, we are 5 people. We are going to buy 2 saris each, 10 saris, and give me at this price. If you are not giving at this price, none of us will buy. Sari vendor will be like, hey, what should I do? Vegetable vendor also, right? They'll tell, per kilo, this is the price. So many of us are there. All of us will buy 1-2 kilos. In fact, we will empty your cart. Your whole business will happen off with us only. Are you giving at this price or not? No, that fellow will analyze everything and he'll be like, okay, if I'm getting a little margin also, I don't need to, roam around 10 places to sell. I can tell 10 people here. But then again, she's threatening. If you don't give at this price, not me. None of my team will buy. Bargaining power of grouping, right? Think all I told you in the beginning. Strategic management is a wonderful subject. It's a way of life. It is what you see around. So these are very simple, practical examples. And most importantly, if the buyers can easily switch from one product to other, easily switch the product with substitutes, will threaten the supplier. Array, give me at this price. If you are giving, I will take. If you are not giving, I will easily switch to a substitute. Now that fellow will be on his toes. Array, where really if this fellow will go off. Understood? So these 5 points are there, which are absolutely a possible short answer question to ask you. What are those factors that increase the buyer's bargaining? Similarly, suppliers can also influence bargaining powers because suppliers also key people. What will they do? If you see, buyers, suppliers with specialized offerings and limited competition. Two types of suppliers. Supplier influence is high when supplier specialized offering. Supplier knows, array, our product is special. This guy will not go anywhere without buying our product. So let me play with that fellow. So they will, that is why they will tell, I will not give any bargaining. They'll write one board and put no bargain. If you go and bargain, they'll show you that board. But you can't bargain there also because it is your need. So shut your mouth and do it, right? So these people, what are their, obviously, if suppliers have better bargaining power, we will end up paying more for the supplies, and which will impact the cost of raw materials. The cost of raw materials are affected by suppliers' power. So more the bargaining power of the supplier, higher will be the cost of raw material. What are the factors that increase the supplier's bargaining power? Which is nothing but the supplier's product being very crucial to the buyer. And when there are no substitutes, automatically it will be higher. High switching cost. Now you saw new entrants will be discouraged if the new entrant comes with high switching cost. Similarly here, supplier, you are threatening the supplier. As a buyer, you are threatening a supplier. Hey, give me at this product. Give me this product at this price. Otherwise, I'm going. Now, supplier knows that you won't switch so easily because the switching cost is high. He'll be like, okay, go. So suppliers will not do that very easily, saying go and all that. But in this case, if the high switching costs are there, they will definitely have that confidence. And more importantly, just like how buyers teamed up, suppliers also, if they are few in number, in oligopoly, they will form groups or cartels. Like the petroleum exporting countries, they formed a group called OPEC, Organization of Petroleum Exporting Countries. All of them together, because when two people fight and third party becomes a winner, that is a loss for everybody and nobody wants to suffer that. So therefore, they will come together. Clear? That is the third factor. Then comes another very important, Michael Porter force, the nature of rivalry. Who are rivals? Rivals are people who sell the same product as we do. They're targeting the same customers. Rivalry impacts your significant strategic decisions. The impact will depend on how much is their intensity. If rivals are of low intensity, you don't have to break your head, you don't have to bother much. You'll be like, okay, sir, rivals only, no, not a big deal. But if the intensity of rivals are high, high rivalry increases the cost and decrease profitability. Now that is definitely a matter of concern, because if high rivalry is there and it is decreasing your profitability, I will have to be little bothered. Now, sir, what are those factors that will influence the rivalry? Let us talk about another exam question, which is if those 7 points that are there in barriers to new entrant is not asked, this can be asked, right? Definitely something or the other, and somewhere or the other, not something, somewhere or the other. These questions from Michael Porter's 5 forces model, either in MCQs or in short answer, somewhere or the other, they've been asked so many times. So this piece that you did for the, like the last half an hour, whatever piece we have been doing, it's a very important thing. Anyway, let us move on and wind up this topic by discussing point number 4, factors. If industry is characterized with one leader, the industry leader will discourage price wars. If you try to play games with these people, no, they will suddenly decrease the price so much that they will drive you out of the market. So small players who are trying to play price war games, I will reduce price and attract more customers. One industry leader will discipline them. So the industry leaders will discourage price wars. Two, too many number of competitors. Now the question is, why competition is cutthroat? What are the factors influencing rivalry? Why is there a cutthroat competition? The cutthroat competition is there because of presence of industry leader. Number of competitors. The greater the number of rivals, the harder it is. Greater the number of rivals, harder it is for industry leaders to maintain discipline. Because see, you can discipline one or two or three people who are initiating that. You can't discipline everybody, Understood? So that is one point. The greater the number of rivals, the harder it is for the industry leader to maintain the pricing discipline. Similarly, talking about high fixed cost. Now, these 2 points that you see here, no, these these are 2 points in such a way that I am being affected for no mistake of mine. So, what are you saying? My competitors' fixed costs are high. Because they have high fixed costs, they are willing to produce more to cover the fixed cost. Now, you understand the logic? Their fixed cost is high, so they are producing more, and because they are producing more, they are leaving more supply into the market. And because these guys are having more supply, overall per unit cost is declining. Supply and demand interaction only, is price. Because too much supply is there, the per unit pricing falls down. So some idiot having some high fixed cost somewhere is impacting all the other competitors. Similarly, if an industry has exit barriers, some people want to say buy and get out of the industry, but they are not going. Some people want to in the sense they want to exit, or they are seeking ways to exit, but that's not happening. And it's like, why is it not happening? This is the reason. Exit barriers are there. Now, simple logic. Exit barrier is there. He doesn't want to go. What will do? He is there within the industry. Now he is not going and he's within the industry. Will he fold his hands and sit in the industry? No. They'll produce. And to cover fixed costs, they'll again produce. And because fixed costs are to be recovered and they produce, again they add up to supply. So whoever are staying in the industry because their fixed costs are high and exit barriers are there, others are facing the heat. My fixed costs are not high. Somebody's fixed costs are high, so I am facing the music. Somebody is not exiting, so I'm facing the music. These 2 points are so disastrous that the intensity of competition is rising even without my mistake. Point number 5 is a straight arrow. The competitor's product is different. They have some uniqueness. Very good. If the products are highly differentiated, that will increase the intensity of competition. No, sir, our product and others' products are not differentiated at all. Like, say, memory card. Whether you buy a Transcend memory card or a SanDisk memory card doesn't make sense. 32 GB or 64 GB, that makes sense. So then you went to buy coal. Give me A brand coal, B brand coal, C brand coal. Coal is coal. Every coal will burn, right? So indifferent products like sometimes, coal, natural resource basically, or gold. When you want to buy ornament gold, shape of ornament, design, I'm not talking about that. Raw gold, silver. Any place you go and buy raw gold or silver, it is that only. So metals, railroads, basically commodities like memory card, they don't have any difference. So low differentiation results in low profitability. If you can't show any difference, our coal is more black, our gold is more bright, you can't show. But where you can show differences, there you will have enjoying more profitability because you are attracting their patronage. Array, no, these guys are different from the other. They will have a concept like that. And lastly, this point is probably for everybody. Every industry goes through a tough time, right? So slow industry growth intensifies the rivalry as firms fight harder to maintain and grow their market share, thereby reducing the overall profitability. So, profitability as a whole comes down. The last Michael Porter's force is about the substitutes. Now, substitutes are not direct source of competition. They are a latent source of competition. Latent means a different way. Not direct, indirect like that. No. So, rivals are the same product people who are, like affecting you. But substitutes are not like that. Substitutes are a latent source of competition. Substitutes either offering price advantage or performance improvement. Two things. Sir, this substitute is better by price. This substitute is better by performance. When I am able to substitute anything by other than this, then it will be a great thing to deal with. So impact of substitutes. Substitutes will limit the prices and reduce the profit, whereby substitutes can suddenly come. As long as people are doing R&D, they always keep finding what is a substitute for the existing thing. So suddenly if an R&D clicks, right, if R&D investments work well and a substitute comes over, that's all, the existing product will be done. Like, say, for example, for our earlier in beds they used to use coir mattresses. Synthetic fiber came and ruined the entire coir. So synthetic fiber substituted coir, right? Real estate, insurance, bonds, bank deposits, all these are substitutes to common stock means equity share. Instead of buying equity shares, you can invest. See, look at the number of investments that, I mean, like, what do you say? Alternatives that are available. So, like that. For one, if more substitutes are there, intensity of competition will be high. If less substitutes are there, intensity of competition will be low. If no substitutes are there for a product, you don't have to worry about that force at all. These are Michael Porter's 5 forces that can have a significant impact, right? Check this out. Everything summarized. I want you to take a more clearer look at these points. The 5 forces model is one very important topic. I think we have been doing this for about the last 25 minutes. So I want you to go through that very thoroughly so that we can talk about 2 more small aspects are there in the same topic. And then we have some things to discuss in the further final topics of this particular chapter. So if you can run down that story. Michael Porter's 5 forces model, very good. At this point of time, you can go ahead and edit your comment to add Michael Porter's 5 forces model tick, right? So I think you've been doing the aspect. Stage 1 completed. Then in stage 2, we moved about analysis. We talked about analysis. I mean, because this is a very important juncture in the syllabus. So you can say Porter's 5 forces model completed. Okay. So then because after this, we are going to mark the next completed at Mendelow's matrix. And then end of stage 2, we will mark. So right now, management strategy, strategic management. We did strategic management, stage 1, right? And then we are doing stage 2 right now. In that, we talked about the external analysis, the first part, where we have driven topics of strategic analysis, business environment, macro factors. And then we came to, I mean, of course, including globalization in the macro factor. And then we are talking about product, we are talking about value chain, and then we've talked successfully about the 5 forces model, right? It's close to the 75 to 80% of this chapter, because I have experience curve to be followed by a value creation topic, then market and customer, and then competitive landscape and key success factors. So I think another probably half an hour, 35 minutes discussion is pending from the, our revision is pending from the second chapter. We will do that. And meanwhile, if you guys want to take a pause on at this point of time and run through it, not a complete break, maybe a pause, and come back, we will resume the further discussion. All right, guys, I hope you have gone through. Let us move on to the next topic. Normally in this module, what you see, the next one is a experience curve topic. But I would like to, since we have a chance, I would like to quickly discuss one important point here, which talks about the attractiveness of industry. A question that is important and asked in the exam, bringing that to you. It is how attractive an industry is. While determining, this topic basically is about determining whether an industry is attractive or unattractive. If you determine an industry is not very attractive, we will, for some time hold back and say, okay, let us not continue in this industry, like that. Okay. So to decide that, what are the factors? What are the key factors? So this is an exam level question. What are the key factors to determine whether an industry is attractive or not? First point, the very easy one, whether the industry has good growth potential or not, right? Is it futuristically viable? That is a keyword. Evaluates whether the industry is futuristically viable. 2, competitive forces. All the 5 forces that we just finished reading up, those assess if the current competition, does it allow profitability? No, sir, the current competition is not letting us be profitable. Somewhere or the other, it is somewhat helping us incurring a loss only. There is nothing that then in that industry is not very attractive. Then some of the driving forces, whether the industry will be positively or negatively impacted. What are the few driving forces? Change in government policy, change in law or regulation, entry exit of some major competitor. Anything can be a possible driving force which will tell you whether this industry, one very solid player in the industry moved away from the industry. That gave you enough chance for you to do something good. So like that, What will you be, what will this be meaning to you for future? The driving forces you have to check. Organization's competitive position in comparison with the others, right? We will do an evaluation to say, will the organization go stronger or weaker within the industry? Sir, less number of competitors are there. We can capitalize this situation and grow stronger. Same way with points 5 and 6, capitalizing on weaker rivals and defense against unattractive forces, right? Others' weaknesses. Can you use it to make a solid position, leveraging the weakness of competitors? If you can do that, and also turn unattractive. See, in the class we have underlined each and every word here. Unattractive situations into opportunities, because I've been explaining this point so many times. What is unattractive for other people in the industry? It is not necessary that it has to be unattractive for everybody. So something which is weak for a rival. So on a weaker rivals note, you're capitalizing. Defense against unattractive factors, right? How will you beat those threats? How can the company counteract? So what is the company's ability to counteract the industry challenges? And also you're talking about the element of risk and uncertainty involved, where it evaluates the degree of uncertainty. Evaluate how much uncertainty is there. Evaluate the degree of uncertainty in the industry's future. We are also talking about industry wide problems. So this is not your problem alone. This is a problem of the entire industry. So can we do something about it? Analyzing the severity of issues affecting the entire industry. We're seeing that. And then contribution to other business interests. It analyzes whether continued participation, if you continue to participate in this, does it add to the company's success? Add to the company's success in other business areas. That is what we are looking at. And then it is followed by, see, please understand, if the profit prospects in the industry are above average and below average. If it is above average, it's considered attractive. If it is below average, it is considered unattractive. Now, your average profit is something like you remember goodwill computation where you have studied about NRR, the normal rate of return. That one only. So attractiveness depends on the firm's strength. Weak competitors, this is a very interesting line. Weak competitors may find an industry unattractive, while the strong competitors may find the same industry for giving you opportunities. So how could be this one for somebody and another for somebody else? That is the logic that I was talking about. If it is something for somebody and something else for somebody else, then it is a situation that has to be weighed. You cannot make some conclusions about it without knowing who is doing what. So that is a very important point. Relative attractiveness. What is attractive in my opinion necessarily need not be attractive for everybody. Just like, I shouldn't be saying this, but just like people, somebody would say I don't like them and they're not attractive. Somebody is saying, why is that person not attractive? So it's just a human nature to, there are certain aspects about which we consider in terms of understanding it. So that is why it's called relative attractiveness. So what is not necessarily a conducive industry situation for one business, maybe because they lack capital, or maybe because they don't have the marketing ability. What somebody else sees the same thing as, wow, this is a great opportunity, we can reach out to a lot of people through this. So small but a very very important question. Like this attempt, since we have revised this, maybe if I'm hopeful that something like this comes up in the exam, you should later come back and leave a comment here saying that this did work. Anyway, I am not somebody who's the important questions person, that, right? So if I'm capable of reading the full syllabus, why should I bother about important questions? Top 50, top 21, top 100, 14 days, how to pass CA in 14 days. Come on. That of course, I can tell you how to pass in 14 days, but those 14 days belong to me, right? If you have to do that, then you have to become the different person than you are. So don't watch those things that only are provoking you to do something, but not actually you. So realize I'm just somewhere because I said that I'm saying it. So everything that you see may not apply to you. So you be a better judge in that position, right? So let us now move on to something very important, which is called as experience curve. two topics are there here, experience curve, and also we are talking about what is called as customer satisfaction, right? Wherein we talk about value creation. Let me bring those two topics to you in simple sense. I think we already know what experience curve is. When you are doing, when repeatedly the same work again and again, if you do, when repeatedly a productive work is undertaken, when repeatedly a productive work is undertaken, the way you do that work will, kind of enhance what you're doing, and the productive efficiency goes up. So first time if you did something like say revisions only, first time let's say it took 25 hours to revise something. Next time also if it's taking 25 hours, then you're doing something wrong. So first time if it took 25 hours, next time probably if you're revising it faster, it should be 20 hours. Then the third time you're doing it 15 hours. Sir, fourth time can I do it in 5 hours? No, not possible. A subject will have a minimum time, like 15 hours is the minimum. But to reach it in the first go, it may not be possible. So like that, with experience being accumulated, your efficiency will increase. Now, when the same thing is applied to units, when our experience increases, per unit cost will decline. All of you students of costing, I don't have to tell you what this topic actually means. So, therefore, the time taken to complete the task will significantly reduce. What is the keyword here? Significantly reduce. And therefore, as the cumulative volume of output grows, decline in per unit cost of production. This is the whole theory of what you call as the experience curve. Very, very simple topic, right? Please go through that experience curve topic. And lastly, let me also discuss in this lot what is called value creation. Value creation is a topic whereby we're talking about not just creating a product or something like that. You are going to create a value for a particular product. You are going to create what? Value. So product features, quality, durability, availability, and performance. All these, what you see here, they're all some sort of value adding points, which is what, in other words, you're asking a very straight and simple question. What is the customer willing to pay for? Because the customer is willing to pay for the color, customer is willing to pay for the packing, customer is willing to pay for this, that, whatever you tell, that particular feature that you tell that yes, this is the factor that is going to make the customer come back to me again, then that particular part is called as the value creation aspect. You are making, when a firm is able to retain a customer, what are you doing? Retain a customer. They have delivered value to the customer. If first time you can make a customer buy the product by showing advertisements, by doing whatsoever possible, first time you can make the customer buy. After that, if the customer is buying without liking, definitely they'll not buy. Or sometimes we'll, maybe without liking also, sometimes I may end up buying because of choice issues. But in this case, it is not all that. Where the customer bought it first time, he liked it, and because of which he is making a repeated purchase. That is, means you have created value. Value can be in anything. Value for me can be in any of these following features, right? What customer is willing to pay for? If you are able to answer this clearly, you're done a clear business. And more importantly, this very aspect, what they're willing to pay for your product, by not choosing somebody else's product and choosing your product, this is exactly what they are doing. That exactly is called as competitive advantage for you ultimately in comparison to the other competitors. You have an edge over your adversaries, and that is exactly what is called as competitive advantage, right? You guys want to take a clearer look at this? Come on, both the topics, you can hold me there for a second. Experience curve and value creation. Come on, let's move on to the next topic as soon as you're done with going through this. On that note, let me show you also something from the point here, which is about the key factors which impact the the concept of value creation, where we spoke about just now. I want you to understand these key factors. I think we know that a word from economics, utility, which is nothing but the want satisfying ability of a commodity. So that is, in other words, the value that customer places for a particular product reflects the utility, the happiness or satisfaction that customers derive. So, what is a combination? Low cost, right price, great value will give you the highest amount of profits. So, these are the three key factors influencing your profitability. How much value does customer place on your product? Amount of price charge. No matter you give a, like you are giving a wonderful product, but you're charging extremely high for that product, that may still not make sense. And same way, if you are only able to recover a little margin over cost, so trying to keep the cost low, adding some margin to it, and then again not margin so much that it makes it look very bad. So like that, these are all things that one has to consider while taking this point into consideration. So the key factors for influencing profitability in that you will see, and this is what get extended later as cost leadership, differentiation and focus, for what the customer is willing to pay for, right? Now there's one small but a very important insight here, which is talking about the role of value chain in helping you competitive advantage. Those 5 primary activities and 4 support activities that is spoken before, right? So the core activities of those and the 4 activities that you see as support activities, you have to understand which one you are doing better, because only from those 9 aspects there will be something that you are doing better than the others, which will help you get this competitive advantage, right? So therefore, value for customers, the value customers are willing to pay, which I've already explained, over and above the price charged by the business, and that excess amount reflects the value creation for customers. For a 100 rupees product, I told you about first day first show, right? For a 150 rupees movie ticket, if that person is saying I'll pay 500 and go, that extra 350 rupees that is ready to pay, 150 rupees only, no movie ticket, then why are you paying that much? This doubt has to come. No sir, I like the movie. So that is exactly the point. You like, so you're ready to pay 350 more than the usual price, and which is exactly what you believe has to be the value created for that particular product. Okay, then let us talk about market and customer, two important people, right? Market and customer. Definition of market is a place, basically any place which is physical or virtual, where buyers and sellers exchange goods and services. I don't think I have to emphasize more. All of you are well versed with this definition of market, right? If you're talking about a stock market, it's a place, but it's not physical anymore. It's a virtual place, online trading platform where buyers and sellers exchange shares, like that. So market is a place basically, right? A physical market is a tangible location, while a virtual market is an online market like a Flipkart or an Amazon. Dollar market, fish market, and all of those are tangible, right? And then in the other context, as I just told you, stock market, oil market for the crude oil, all those things are there. Now, in this particular market, if you have to attract people, then there is marketing. Marketing is nothing but a range of activities which include research, design, pricing, promotion, transportation, distribution. So many people think marketing means making an ad. No, please concentrate on this very point here. Very, very important. Marketing includes range of activities ranging from research, design, pricing, targeting the right person. To targeting means this one. The purpose to identify and meet customer needs, deliver satisfaction, and then build the relationships. The 4 P's of marketing, if you see what are the 4 P's of marketing: product, price, place, and promotion. There are 4 P's which used to guide strategies to meet the customer demands, right? So then how can we make marketing very focused on what should we be focusing on? Sometimes marketing is product oriented, while sometimes marketing is production oriented, marketing is sales oriented, and last one is customer oriented marketing. In product oriented marketing, you will talk about the product quality, performance, design, features, like generally these mobile phone people do, right? That is, it has so much RAM, it is abilities to process this much, that much, everything. They're more product oriented marketing. Then production oriented marketing, generally production oriented, is like the strategy of low cost, right? Mass production, where you will try to reduce the per unit cost. It assumes customer prefers low priced product, so their marketing is saying that this is the low price product but very good, so they target on production oriented marketing. Then sales oriented marketing, you want to get the product sold anyway, so how to make the product sold? Show them through advertisement. Focus on spending on advertisement, sales, promotions, and anything to do to persuade customers. Modern day marketing, many of them are sales oriented, but if you have to do a marketing which ultimately works, and if it ultimately runs down in the hearts of the customer, it is customer or market oriented marketing, right? Understand the pulse of the customer centric approach. What is the customer willing to pay for? From the previous topic you find that out. Prioritizing customer needs and market dynamics for creating a better value proposition. If you are able to do these 4 points, right? Production oriented, product oriented, sales oriented. I'm again expecting this question. If it comes out, it should be one of the easiest things to grab marks. Marketing orientation. In the last one, a little explanation of what is a customer centric approach. Businesses should continuously learn from customers as to what they want, as to what they want and the goal is to ultimately create value propositions which are tailored to the customer needs for better satisfaction and success. Keep it very simple and you should be in a position to or be able to achieve that. Okay, so this is about the first part of that marketing aspect. Then the second part here is about customer. I hope all of you know that is difference between customer and consumer, right? A person who buys the product is called customer, and a business cannot exist without a customer. Customer is the person who buys the product, while consumer is the one who ultimately uses it. I think till here all of you have already seen marketing, any person who bought, customer, consumer. Now let me just show you this, because let's just see whether everything is covered here. Marketplace, this one, marketing, 4 Ps. Any person who buys a product or is called customer. Groups are based on age, gender, geography. I think customer groups you can make them, and customer maybe and consumer maybe same, can also be different. The person who ultimately uses the product is called as consumer. I think all those have also been summarized. Now let's talk about a point which is a very important uh, question, because this has come in the exam. When you are conducting a strategic analysis, one of the micro factors, right? Macro factors already we analyzed. Micro factors we already talked about. Product, we talked about the 5 forces, that is about competitors and all that. One of the important micro force who can have a significant impact on you again is our consumer. The consumer behavior and the way consumers are influenced will make a lot of deal. How do you do their analysis? You conduct survey, study past data, or do a customer profiling. But I would like definitely you all to bother about this one a little bit more here. What is that you have to bother a little bit more is everything to do with, let me bring that on your screen quickly. Yes, here, customer analysis. I want all of you to have a clear understanding. What are the key activities in customer analysis? What are you analyzing about the customer? Study the consumer data, positioning, profiles, segmentation. That's what I told you now. Customer behavior. This question has been asked in the exam. That's why 2 stars here. What influences the customer behavior? 4 points are there, guys. Technically 3 plus 1. Why plus 1? I will show you. First one is external influences. Second one is something within the customer says, internal influences. Then comes the third one, a decision making process. Concentrate here. Come on. Customer behavior is shaped by a mix of external and internal factors, and also as well as how decisions are made. They fall into 3 categories. First one is external influences, right? Whereby we're talking about external factors such as advertisements, peer recommendations. Peers means people of equal standing, somebody suggested or something like that, right? Advertisements, peer recommendations, or social trends from outside, maybe through marketing campaign, something from outside world. If you get an influence, it's called an external influence, more like environmental factors and marketing efforts. But the second one we are talking about is the internal influences. These are something within me as a customer. What influences me? My mind will influence me, right? So these are more personal and psychological. Internal factors are both personal and psychological. These include customers' motivations, attitudes, and preferences. For example, a person's desire, person desire, I want to buy something. That desire is enough to provoke him to do something. He need not be told by neighbors or others or something like that. My mind itself is influencing me internal. Then comes a decision making process, whether it is worth buying a product or not. All as customers, many people don't do that, that's a different story, but everybody as a customer should do this, right? When making decisions, especially that too for significant purchases. Which purchases? For significant purchases, customers follow a few steps. What are those? One, identify the need. To recognizing a need or desire that's unmet, looking for alternatives that can meet, and gathering information and weighing on the pros and cons, and finally make a choice based on the decision of their evaluation. These, like everybody every time will not take a white paper and write a list. This. You want to buy a pen, what will you do? You'll go to the nearest stationery shop and ask pen. But sometimes some people are very choosy. Now on a random day you want to buy a pen, shopkeeper is asking which pen. Give some pen, sir, you are taking, because you're not bothered. But if it's your exam, then you will tell a brand, give me Reynolds or Cello or this or that. Why? Because you're very specific. Can you do a casual walk like this into, you went into the car showroom and you're like, give which car, any car you give. We can't do that because car is a priced, highly priced product. So there you will do these 4 steps. Do I really need a car? Okay, yes, I want to buy a car. Need is there, desire is there, yes. Then who will meet? Okay, 1, 2, 3. In my range, budget 25 lakhs of cars, these are there. 50 lakhs car, these are there. I'm ready to spend 1 crore. Then these cars are there. Then do a little bit of research in that also. See, somebody who's buying a 1 crore car also will not go blindly buy. Maybe his personal choice is like, I like the rings in Audi, right? Or no, sir, I like the feel in BMW, or I like the luxury in Merc. Whatever it is, his choice, right? And then you choose and make a final decision. This has been asked in the exam, guys. These 3 steps, I want you to one more time revise along with me. What will influence the customer behavior? External influences, internal influences, and a decision making process. Now what is very important is the post purchase evaluation. Before buying a product, you'll have something in mind like, okay, how should we buy this product and what should come. But after buying the product, customer assess their satisfaction. Satisfied customers are more likely to buy again. Dissatisfied customers are unlikely. Forget about they're not buying, they will not promote that product also, right? But if a customer is satisfied, they're very likely to recommend that product to the others also. Okay, even though the, like now I'm saying, Arey, I bought this pen, it's very nice, you also buy. The pen company didn't give me any money, but still because I like the use, I recommended it to the others. Like just like movie, we watched a movie, production house didn't pay me any money, I'll tell my friend, Arey, nice movie, you can also watch. Just out of, passing on a good suggestion, that's all, right? So those 4 points are very important and interesting here. So with that, that brings us to the last episode of this, chapter, where we are talking about 2 important aspects, guys. One is about the competitive strategy, in which you have competitive landscape, and then we have KSF, not KGF, KSF, right? So key success factors and competitive landscape, two of the most asked questions. Before we do any of that, uh, every business, they have something in mind. I want you to see that. See here, this one, a business competitive strategy is based on 2 very important points. What are the 2 points? If you see, one is about creating a competitive advantage. Majority of the people work through their lives to create a competitive advantage, but I know what happens after that, they're unable to protect that. So the second aspect of it is called protecting the same advantage. Creating is one side of the story, but protecting is also equally important. Understood? So this is the story of the competitive strategy. To develop a good strategy, you should understand your competitive forces. In this context, there are 2 very important exam questions. What are the factors to consider while doing a competitive landscape? This one is a 2-star, 3-star, already put there one more time for you. I've done that. Competitive landscape, multiple time they've asked that question, these 5 points, right? Identify the competitors, understand the competitors, determine what their strengths are, determine what their weaknesses are, combine and put all the information into a meaningful assessment, and the story will be taken care of. This is something, these are the 5 steps in competitive landscape. And in every point, we have a key question. The first step is to understand who the competitors are and who are my competitors and how large are they. First question. To understand them, that is little more detailing. thoroughly understand about competitors, read from magazines. Nowadays, you have social media handles to tell what your competitors are doing. Try to find out from industry reports, social media, learn about their products. You can go to Amazon or Flipkart and see what products they have listed, how others are commenting about their products on Amazon or Flipkart. Then, what is their strength? What are their strengths? That is, in this, the key set of questions are how do they you know, fix their financial situation, what is their financial position, cost or price advantages, what might they do next, at least gazing what they can do next, how strong is the distribution network, who are their human resources, are there any employees with them that we don't have, and how is it they've become so strong like this, and then determine competitors weaknesses, right? Because their weakness could become, you know, something that you can attack and bridge the gap. What do they fall short? Try to understand about what are they lacking or struggling, and then combine all this information, prepare a neat report, assess the gaps, right? Where we call this a gap analysis, assess those gaps, determine areas for improvement and strategies to capitalize on the competitors weaknesses. Some of the key questions that you can see here are: what can the business do with this information? What improvements are needed in this story? What are they talking about? What can the business do? What improvements are needed? How can the firm take advantage? How can the firm take advantage of the competitors' weaknesses? By following all these steps that we discussed above, you can gain a clear advantage of what understanding you want to have, and that only I have summarized here. For competitive landscape, it is understanding competitive requires application of competitive intelligence. This line has come in the multiple choice question so many times, so what is called competitive intelligence, and that is exactly what we are looking for in this story. The last but the very important piece comes to KSF, which are called as key success factors. Key success factors are nothing but those things that affect the industry members, whoever are there in that industry, they get affected by something called as key success factors, right? On what basis do customers choose a particular product? Why are they not choosing others product, and why are they choosing a particular product? What is the basis? Two, what resources and competitive capabilities are needed to achieve that competitive advantage? And what does it take to achieve what is called as sustainable competitive advantage? These are the three key questions on how to identify KSF. There's also a point on the importance of KSF. Let me bring that to you here. Key success factors are elements that businesses, whether business in an industry will thrive or fail, it will determine that every company in an industry must to focus on these KSF. And while identifying the KSF here, what do customers care about the most? What features or qualities drive the purchasing decision? What resources and capabilities are essential for success? What ensures long-term competitive advantage? And more importantly, what can company do better than the others in a way that the competitive advantage will last over them? That is called as sustainable competitive advantage. Say for example, what are KSFs in apparel manufacturing, that is in clothing? Attractive designs and low cost, both are your key success. How can somebody become successful in clothing industry? By this one. Okay, so are KSFs important? Of course, KSFs are very important because they should be. Which factors matter the most? And wrongly judging the KSF can lead to poor strategic decision. So keep those 3 points in mind. Understanding the key success factors is essential for crafting effective strategies. Which of those matter the most will tell you in which areas you're doing good. And wrongly judging any KSF, because what is not a KSF, you think it is a KSF, it could turn out to be a problem, and therefore we need to make a interesting study of the KSF. And the last thing that I want to tell you here before I end this chapter is a pro tip, the pro strategy tip. A company that stands out in one or more KSF often gains a stronger market position. Remember, so if you have one or more key success factors than the others, which could be a low cost or differentiating or anything, that will help you stand out in the market. And remember, KSFs are not static, they are dynamic in nature. KSFs are not static, they vary from industry to industry, and within an industry also from time to time they vary. Understood? And because of this variation, some of the key success factors may not be identified by people, because right now are the key success factors. Sometimes technology would be the key success factor. People fail to identify that. Then there could be suddenly you thought something which is not a key success factor is a key success factor. So those problems can arise, and you may misjudge. So you have to take all of that into consideration. That is why we given there. Usually only 3 or 4 key success factors are critical at any given point of time, with 1 or 2 being particularly significant. Understood? So managers should avoid listing all the key factors. If you list down 20 key factors, then they are not called key, the factors. So key factors mean they'll be limited in number. You identify what those are correctly, and then make a effective understanding of those. Okay. So conclusion: to succeed, companies need to identify few critical KSF and prioritize those while building the strategies. Right? So one more time, if you have to see the summary of what this KSF talk about, that is what is here: competitive landscape. So with which this brings us to the end of chapter number 2 in our syllabus, which is also talking about the strategic analysis external. Okay. So I would want you to obviously take a moment of pause. Now, depending on whether you are in a zone to continue or not, you can decide on that. But at this point, definitely I would want you to revisit the whole thing that we have discussed in chapters 1 and 2. Of course, you're going stage wise, so we are midway in stage 2. Stage 2 external is done. We'll kickstart stage 2 internal, with who are stakeholders, firm, Mendelow's matrix. Then very important topic which is coming up is the key strategic drivers. Okay, I'm lining up all that for the discussion in the upcoming piece. Meanwhile, please take a moment of pause and neatly revise everything that has been discussed thus far, and come back to continuing watching the marathon. All right, guys, I hope you have gone through that. Now let us move on to the next topic, where we will be discussing about strategic analysis of the internal environment. So let us go with that. All I want you guys to do is to first understand what is the scope of the chapter there. Let us bring that on screen. Yes, strategic analysis of the internal environment. Let me give you a quick overview of what all we are going to talk about. The firm's internal environment consists of 5 things you're seeing there, followed by the stakeholder and stakeholder breakdown from Mendelow's matrix, and then we are discussing key strategic drivers. And once that discussion is done, wherein we have a couple of important questions like the strategy group mapping, and we also have the 13 different forms of marketing, right? If we are done with all of this, and of course certain other ancillary topics, then we will do a combination of internal and external analysis, which is called the SWOT analysis, a final beautiful framework that is available for businesses to put all the content that they have done in stage 2 strategic analysis in one place. So let us target this in the next space and finish this. Of course, before going to stage 3, which is about crafting a strategy, a couple of standalone topics are there which are about uh, core competencies and competitive advantage. We will see that. And then towards the later part of the third chapter, you will see Michael Porter's 3 generic strategies, which are part of stage 3 actually. So we will go ahead and have a breakdown there and discuss how stage 3 called crafting the strategy looks like and all of that. So for now, to start with, who are all there in the internal environment? The internal environment of an organization includes people, processes, physical infrastructure, administrative structure, and more importantly, a very, very intangible aspect called the culture. Relation between employees, values, ethics, philosophy that is there in the organization. All this will make up to the culture. Now, culture and its impact in the organization, we are anyway going to discuss in the implementation stage, because no matter what establishments you do, until you bring in a proper culture, it is not going to work in the organization. So organization structure, the culture, how to establish all this, we are anyway going to see in the chapter 5. For now, people are important. People means who? Any set of people, employees, management, shareholders, investors, board of directors. In fact, anybody who's involved in the organization, they are all coming under the broad bracket of people. People, processes. Process means the workflow where you are giving input, what is being the activity done, and what is coming out as the output. And then we talk about physical infrastructure. Physical infrastructure is about this. Now, this time when you say physical infrastructure is very clear. It is about space, equipment, workplace condition, the factory, all of that. Administrative structure, again, which is intangible. If you remember the first chapter we've already discussed, there are some lines of flow, that is vertical, horizontal, matrix lines of authority. So authority, power, responsibility, accountability, the flow of that, that is called as the administrative structure. You can see here all of that: authority, power, responsibility, and accountability. Done. So moving around that, let us now take care of what we call as the Mendelow's matrix by understanding the key stakeholders who are involved. So strategic analysis, internal is what we are doing now. And each organization's internal environment is pretty much unique, shaped by its own structure, business model. I hope everybody knows these two words: business definition and business model, right? Business definition is about what your business is, while business model is nothing but the way a business generates revenue is called as business model. Very neatly, those of you who have done the um, crash course, this material, full material, though the name was about crash course, we have covered this whole material in such great detail. That is why you see so much being already written. And this marathon should help all of you. So I mean, like, since we are halfway in the marathon, I'm talking about this. So this marathon should help you to revise and recollect everything that we discussed. And people who are watching only the marathon, if you're already well aware of the subject, I don't think there should be any problem in you also catching up with it. Okay. So yeah, I hope it goes very well. Even the other half of the marathon should go very well. So let us continue, where we talk about some of the internal environments reflect the key elements. What are the key elements? Ethics and principles of an organization, employee satisfaction, how happy are they in working that environment, in the culture, and more importantly, the investors' confidence and other cultural and philosophical aspects which drive the success of the organization. So that is a basic introduction, guys, as to what you will see as the internal environment. But what I am more bothered about is this concept that is coming right after this, which is called as Mendelow's matrix, right? So I've already uh, discussed Mendelow's matrix in thorough terms, right? Now I want all of you to stay along with me, because when you talk about internal environment, right, we have covered who are there in the internal environment, understanding the key stakeholders, shareholders, board of directors, major vendors, consumers, all these guys are there. Now, a very important topic on Mendelow's matrix. Let me bring in here as to the construction of Mendelow's matrix. Guys, Mendelow's matrix is also known as power, influence, uh, or an interest matrix. Power or influence, anything, any word you can use. Power, influence, right? Same meaning. So it's called a power interest matrix or influence interest matrix for this reason. Why? Who has the power? Who has the interest? Now, let us first get to decode these two words. What is power and what is interest? Power means your ability to exert something in the organization. Then, when we talk about interest in the organization, right? How interested are you financially or otherwise? How interested are you? Now, let us just have some understanding here, right? Who are stakeholders? You saw that stakeholders are somebody who have a interest in the organization. Anybody who has some sort of an interest in the organization is called a stakeholder. Employee, shareholder, investor, supplier, customer, regulators, all these people can be called as stakeholders. Now, if you define the stakeholders, how about defining stakeholders? Stakeholders can be anyone, internal or external, right? Now, two things: an interest in the business and power to influence. These are the two things that stakeholders have. They have an interest in the business, and they also have a slight power to influence the organization's strategy or the performance. Now let's see how they vary. Everybody will they have equal power? No. Will everybody have equal interest? No. Say primary stakeholders are there, some of them. Who are those people who are almost involved in the business daily, like management, employees, shareholders, right? Closely who are dealing on a regular basis, right? They are called as primary stakeholders. Now, additional stakeholders are there, like government is there, uh, labor unions are there, and other local community, societal aspects are there. These are not people who bother daily, but when they come in, they bring in considerable amount of influence. So, two things that vary are how much influence they can create and how much interest they have in the business. Therefore, this point becomes a very important one. It is essential to recognize the influence and interest levels. It is important to what? Recognize the influence and interest levels of different stakeholders as these vary, as they vary. And for example, a healthcare innovation, who's doing what? Healthcare innovation. A healthcare innovation firm may prioritize long-term investments, because you cannot bring results in research and development and all in short term. Chalo, we have done something, we got something. You can't be like that, right? A healthcare innovation firm may prioritize long-term investments in research, while which aligns with stakeholders the long term. Okay, let it take time, but when they come out, they'll come out with a blockbuster idea. Let the research take 10 years, but after 10 years, say probably some for a medical research firm telling like, sir, after 10 years will they come out with a medicine for cancer? Maybe, maybe not. You're an AI company, or you come out with a wonderful technology after research of 3 years. So some people in the organization, they understand, array research means it will take time, let them do with patience. But there are some people who are like, no, 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 I don't want all that. I have to put money and get back my money. These are people who should have, I mean, like, I'm not saying that is wrong. Understood? I'm saying that that type of share stakeholder also will be there. So some are focused on what? Short-term profits. So for people focused on short-term profit, this is not a very viable idea. They should go, probably these are people who should look for stock market investments or something like that. Nothing wrong in thinking like that. No, depends in which company. Some companies, their idea itself is like that, that to make money in the short term. So depending on that, stakeholders should decide. Okay. Now, to understand which stakeholder falls where, right? Mendello has put up a Mendello's matrix. Now you can go through the key list of key stakeholders. Stakeholders in terms of an OTT platform, like take an OTT platform like Netflix or Prime, you can see shareholders are important. These are people who are holding shares in that entity, who are bothered about creative content, return on investment, top rankings for the organization, how much CSR the organization is doing, and whether the organization is holding high market share. These are their requirements. But if you slightly slide down and look at what are the requirements of CEOs and board directors, who are the likes of management, they're more bothered about prestige, market share, revenues and profits, market rankings. So you can clearly see between one and two how much there is a stark contrast of what each of them want. Then accordingly, if you see from like three and four, major vendors, who are the major vendors of Netflix? Production houses. They want Netflix's growth, right? Repeat ordering is required for them, because that is how they also grow, and stable margins. And consumers, if you and I are viewers of Netflix or Prime, what do you want? New content every week, something new should come, right? Better deals or pricing benefits, value for money continuously. Movies should keep coming, continuous supply. As viewers, that is what we expect. Employees, what do they expect? Salaries. People working in Prime, they'll expect what? Wages and benefits, stability of employment, and pride for working for a reputed organization. So like this is the basic insight of who the stakeholders are, and with one example also we are able to cover this. Now moving on, let me come to the uh, you know major exam question. 3 stars already marked. It is one of the very important aspects that have been asked so many times. So if you see, what is Mendelow's matrix? Mendelow's matrix, no, it is also called as Mendelow's matrix is called as stakeholder analysis matrix. You are analyzing what? Some stakeholders. Now only you saw the list of stakeholders. We are putting them in the right boxes, right? How? Power, interest, two things, right? Power and interest, these are the two things. Now, it helps the organization to understand who is the priority. This is such a simple matrix. All the stakeholders, we are going to put them in 4 categories. You can see what I wrote below. KP, key players. LP, low priority. KI, keep them informed. KS, keep them satisfied. How are these 4 categories being discussed? Based on 2 concepts. One is called the power. Sir, what do you mean by power? Power is nothing but power is the ability of a stakeholder to influence the organization. Just imagine how much power Mr. Mukesh Ambani will be having in Reliance, right? Understand that is what is called the power, ability to influence. Gautam Adani having influence in Adani Group, right? So Ratan Tata, sir, influence in Tata Group. So like that, these are such key individuals. They're called the key players. Their ability to influence the organization is so high. Not only that, plus their interest. My organization should grow. That level of concern that they have, no, which is called interest. That level of concern is also very high. So for these two things, right now, once you know what is power and interest, we'll put a 4 box matrix. Power high, power low. Interest high, interest low. So when you do that, it is more like it is rather than seeing something from there, we'll see how it got constructed. Okay. Yeah, see there, power, we are taking on one side power, and on the other side we're talking about interest in the organization. Now, if the power is high and if the power is low, if this is high and this is low, we are talking about it. Now, when first thing we'll talk about when both are high. When both are high, very less number of people are there in the organization whose power is also high, and whose interest is also high. They are called as key players. What are they called? Key players. Shareholders, CEO, board of directors, all these people are generally called as the key players. High power with high interest. Guys, this matrix has come so many times in the exam, and I think this should be of so much use to you when you learn it. Okay. Now, second one, let's talk about both being low. 4, low priority people. We are neither having interest nor power. Who are these people? Outside media house, news, magazines. They don't have any interest in our growth, our well-being. They also don't have any power, as of now, because we are not there in the limelight as of now. Why I'm telling this, I'll tell you in a minute. So these are one set of people who are not really interested in your well-being on a daily basis. So these guys are now. What becomes very interesting aspect is the other two. There is a high amount of power. Government has a high amount of power, but they are not interested in your well-being and all that. Government is not bothered like, yeah, they should be successful, this, that, nothing like that. Government is there as a system. It will take care of something, that's all. They are not bothered in your well-being. They are not, like people who are bothered about, acha acha, this organization should grow good. They are not into all that zone. Understood? But at the same time, they are very much focused on your whether you're paying taxes on time, whether you're filing returns on time. Same way with banks. Banks are ready to give loans, but only when everything of your compliances are good. So what should you do with these people? Banks, government, customers, these people, you should literally keep them satisfied by giving the right information. Keep satisfied. Customers, give them the right products. Okay. Banks and government, give them the right information. Everything, keep them happy. Then there are some set of people who have very low power, like outsiders, suppliers, vendors, our own employees. They don't have power, but they have a lot of interest in the well-being of the company. Obviously, employees will feel, no, that our company should be good, our company should grow, because if the company grows, that is where their growth is. So they'll always think like that. So for all these people, since they are showing so much interest, be courteous. Sir, be courteous means what? Keep them informed. That's all. You need not file any returns or do something great. Just keep them informed. Give them the necessary details that they need, and they'll be happy. So his understanding is each stakeholder has to be treated in a certain way. That is what Mendelow's matrix talks about. Such an easy, simple matrix, right? We can take a more clearer look here. Power and influence on one side, and the interest of people on the other. So considering that, you can clearly decide as to what exactly the story is. Okay, take a minute, run through this, because now I also want to conclude this topic by telling you one thing very important. Then I'll give you a time to revise here. Sir, will all of them be there in the same box at all times? No, that is what I want you to understand here, because sometimes there is a chance that people hop from one box to the other. Now, like say the company is going for an IPO. Company is going for a IPO. What people write in newspapers, right? What people are talking about our company just before our IPO, these become very important things, right? So suddenly those media houses which were of low priority till now, suddenly they get high power. So suddenly they jump from low priority to keep satisfied. You have to give them all the information and keep them satisfied. Did you understand this point? What I'm trying to tell you here? People can jump from one box to the other. That's what I am saying, right? Let me just show you the text of this. Yeah, there you see everything neatly embodied. Key players keep satisfied, keep informed, and low priority. I think I gave 1, 2, 3, 4 so that it be easy to remember. Two things: extreme high, extreme low, 1 and 2 we mark. Then who should be kept satisfied and who should be kept informed. I hope now everybody knows, right? Now if you see what I was talking, application, uh, those with high power and high interest require very close attention, while the other people, they need minimal effort. If you just give them the information that is needed, it will be taken care of. One of the very important points is this particular point which I'm starting now, which is called the dynamic nature of stakeholders, which is what I was just trying to explain you guys. For example, uh, government is there, media houses are there. So government, normally they don't poke into your business. If you're doing everything right, they won't poke into your business. But see what is happening now. Government has low interest in your well-being. They have high power already. Example, an organization might inadvertently contravene the provisions of GST. Now suddenly you are inviting attention of the indirect taxes department by not paying GST on time. This department already has power, you know that, because it's a statutory body. Now, till now they were not bothered in you because you were paying everything on time. Whatever has been going on is nice and all that. But the moment you did this drama, they are now interested in, Ray, what is this entity doing? What is this entity up to? That way they will immediately come to an understanding. So who was having high power and low interest suddenly now becomes somebody with high power and high interest in you. That's all. So they move from which box to, till now if you have kept them satisfied, it was enough. But now suddenly they will have all the power also, all the interest also. They become key players. Understood? Earlier they were people with high power and low interest. Now they become people with high power and high interest, and they will move from keep satisfied to key player. Understood? Same way as I'll give you one more example here. Equally, media houses, which are normally low power, low interest, will move from low power to high interest. Suddenly, this depends, like on the time. So all I'm saying is the stakeholders' uh, content might not be the same. Their content changes, then their dynamic nature will come out. That suddenly they will also change their status. A key player won't be a key player forever, and a low priority will not remain in low priority forever, right? That is what this topic is all about, right? So I think about 20 minutes into this piece of discussion of chapter 3, you can take one moment of pause to go through what these are before we rush down to what we call as the key strategic drivers. So I'm going to put that key strategic drivers to you, but before that, like I said, I want you to go through up till Mendelow's matrix. Take a minute of pause, not more than that, and run through just as to what we have discussed, so that we can be in a safe spot as we continue to the key strategic drivers. Come on. All right, guys. I hope you have done what I asked you to. So let us now move on to another very important discussion called the key strategic drivers. Let me show you what are the factors that are there for discussion here. You can see key strategic drivers are split into four aspects, all four of which have been asked in the exam. So let us break them down clearly, try to understand what each of them are talking about. So there are four strategic drivers that drive a particular industry. There are particularly, they drive an industry, saying that, look, this is something that can shape up the industry and the understanding of the industry. Like that, these four key strategic drivers are: first one is trying to understand the very industry and the market that are available. In doing this, we have a very important, I won't say what just important, but it is one of the most asked questions of the entire syllabus of strategic management. It's called SGM, or strategy group mapping. What is the concept of strategy group mapping? We will see that. Before we discuss anything further, I would want you to understand the second group of people who are the key strategic drivers are our favorite people of customers and consumers. We already in the previous discussion had a understanding of what is the difference between both of them, because customers are those people who are going to buy the product. Sometimes they themselves can turn out to be the consumers, but now there is also sometimes a difference where customers only buy the product while consumers are the one who ultimately use it, right? Then we already have discussed the micro factor called as products, its characteristics and life cycle. But these products and services to be brought to the people, we need some marketing strategies. Again, another important area in the exam is the set of marketing strategies, where they have asked each definition of these marketing strategies can get you possible 2 marks sometime, because they're asking that in the MCQs. Similarly, another exam question that has recently come, 2 attempt back only, is the channels. There are 3 channels through which you can sell your product. So sales channel, product channel, and service channel are the 3 channels which are very important. So this piece of discussion is going to be about the key strategic drivers. Now, what is the understanding of the term industry? Let's start with that. Now, industry, many people think group of similar firms, full stop. No, there is a very important clarification, a little piece of extension here. I want all of you to understand this. Group of similar firms. Of course, it is a group of similar firms competing for the same set of buyers. Competing for what? The same set of buyers. Now, sir, why are they competing for the same set of buyers? Because only those buyers are there in the industry. Only those set of buyers are there in the industry. So if you can figure out who those are and who are those people whom you are supposed to target, this exercise of yours will be fruitful. Understood? So that is exactly what we are doing or trying to figure out as in terms of this strategy group mapping exercise. Who are our actual competitors? So if you see who are our actual competitors, coming down to this. So before which I want you to understand that you are talking about a similar firms competing for the same set of buyers, and for industry as a whole, there's only one big structure. For industry as a whole, there's only one big circle, and from industry's point of view, there is only one strategy group. If everybody in the industry are doing the same or similar thing, you will not find many strategy groups, you will find only one. But within the industry, now simple logic, guys, I've given this example so many times, so I'll continue the same example. Like I've opened a petrol bunk. What did I open? I've opened a petrol bunk. Who is my competition? Not petrol bunks in other cities or other states, no? Because I'm talking about a very limited orientation. In my area, if another petrol bunk is there, that fellow will be my competition. So the competition for petrol bunks are geographic in nature, because 5 kilometers later on petrol bunk is there. Nobody is going to tell that, this petrol bunk is here, but 5 kilometers later there's one more petrol bunk where the petrol is very tasty. Nobody is going to say that. You understand what I'm saying? Which means whatever is close to my house. So if I have a petrol bunk here, somebody near my vicinity will be my competition. Or Mukesh Ambani also doing petroleum business, they are also my competition. Maybe you guys belong to the same industry because you're dealing in petroleum and petroleum related products, but you're not competitors. So please understand that this is a very important topic in understanding who your exact competitors are. Otherwise, you are just fighting this is called throwing a dart in the dark. Generally, an expression called throwing the dart in the dark. Those of you are my students who already know that, right? That means you know the dartboard, right? Taking a dart and throwing at it. But throwing a dart in the dark means you don't know where the board is. You're just throwing a wild attempt. That is not something that we want to do. So we would basically want to understand who our competitors are. How are those people there? And accordingly strategize for each one of them. That is the understanding of this whole topic. So strategy group mapping is one of the procedure that is done to understand who your correct competitors are. Understood? The bigger question that always has come in the exam or whatever is repeatedly asked is, what is the procedure? The procedure for constructing a strategy group map. This is a question that comes in the exam, and I want all of you to concentrate. So very, very easy. That is why I'm going with this 4-step process. I want you to understand. But before that, let us examine that this circle here is a industry. Okay, this circle here is the entire industry with lot of people inside. Now, what I have marked, all those people are belonging to the same industry. Are all of them competitors? By book definition, yes, all of them are competitors. Okay, let me just show you what is the story here. Now, here, people who are selling in the same price range, you can see this marking, right? This particular marking, whom we are talking about, competitors selling in the same price range, they are all in that green circle. Then there is another set of people in this broader circle, right? This one here, right? In that circle, who are there? They are those people who are dealing with some, let's say, same geography. But now if you see here, which is very clear, let me show you that one more time for you in clearer sense. Can you see that third circle, which is a combination of many? Seeing that. So now here, if you see the other circle that is there here, this is an overlap of all those people who are there in the other circles also. So like that, somebody may be a competition to you price wise, somebody may be a competition to you quality wise, somebody may be a competition to you geography wise, somebody may be in the same geography and same price range. So like this, in this circle, if you say one is in the people who are selling in the same price and same geography, and is that greener circle? It's a combination of two things: same price, same geography. So how did we draw this? For that, we have to follow 4 steps. Very easy. See this. First one, identify the competitive characteristics between you and the others. What are the competitive characteristics that differentiate price, quality, geography? How vertically integrated each one is? Are they doing only one portion of the chain, or many pieces are being done? Who is our right competitor in terms of first differentiate all this. Now, if you're taking only one variable, what happens is you will still feel so many people are falling in that category. That is why this concept suggests, whenever you're drawing this map, not take two people, plot the firms on a two variable map, not one but a two variable map, using a pair of differentiating characteristics, using a pair of different, not one but take two pair of differentiating characteristics, right? So price, geography, quality, like that. Take two characteristics and plot them. Now, who are in the same price range and geography, who are in the same geography and quality, like that, you assign the firms that fall in the same strategic space. Assigning. So like what I did here, those the ones highlighted are the ones who fall in the same strategic space. Then draw circles around each strategic group. Now again, if you understand the story, one big circle is there, no? That is the strategy group for industry as a whole. So if you see, for industry as a whole, there will only be one strategy group. Within the industry, when competitive characteristics differ, so many circles can be drawn, but all these circles ultimately will be within the bigger circle. So all the circles are in proportion to the larger one there. Understood? 4 steps. What are the 4 steps in strategy group mapping? Step number 1, what will what are the differentiating characters between you and your competitors? Identify that. Identify the competitive characteristics that differentiate the firms. 2, plot the firms on a two variable map, not one but a two variable map. Then based on those factors, assign the firms that fall in the same strategic space, and then draw circles around each strategic group. Draw circles around each strategic group. And once you're done, you will get who your exact competitors are. Like, say, finally, I will have that smaller circle where I know, acha, these people are my competitors. People who are selling in the same price range. People who are selling in the same price range in the same geography. That is what the final understanding would be, right? So that is what is a concept of strategy group map. I don't think there is anything new in discussing this. Let me just come here in terms of talking about analyzing who our strategy group are. 4 points I would want to show you that, right? So strategy group mapping identifies that group of competitors with similar marketing approaches, people in the same product line, price qualities, using same distribution channels. These are the common factors between various firms in the industry. Then once you see for industry as a whole, if everybody has same characteristics, there will only be one strategy group. But within the industry, there are always multiple strategy groups, because all the entities in the industry following only one strategy is a very like it's a myth. Nobody does that, right? So only one strategy group will be there. If all follow similar strategy, which is not practical, everybody will follow different approaches. So there will be so many mini strategy groups within the entire industry. So in identifying that, 4 steps: identify the differentiating characteristics, plot the firms by taking two variables, and firms with similar strategies, put them in the same group and draw circles around the same. Guys, this as it is, if you write these 4 steps, right, and this has fetched enough number of marks so many times when people have done this. So before we go to the second strategic driver called as customers, I would like you to take a minute of pause and run through this topic here, because it's a very important one. What are the 4 steps? I don't even know how many times they have asked this question. So that is the highest importance to this particular question, this chapter. Please do that and let us resume it once you finish doing it. I hope you're done with that, guys. So let us move on to the next topic here. Next topic is a very simple one in considering what it is. Let's say, for example, this one, customers. Customer, you know who is it? Customer, consumer. This piece, I'm not uh, reiterating the fact again, So similarly, parent purchasing stationery for child is the customer. Child who uses is the consumer. So I think that is a very easy bit for you to take care of. Now, moving on to the next one is where the interesting part is products and services. Again, they're reiterating what is a product. We know already what is a product because we have already discussed that quite extensively. So a product is a combination of goods and services, which should not be a problem in recollecting. And we also discussed the 5 characteristics of product. So they are very important to understand what products are, so that accordingly, depending on what sort of a product you are dealing, you can manage your existing products, introduce new products, discontinuing unsuccessful products. Because if I'm explaining this for the first time, probably at this point I would not generally want to tell you what those are, but because this is a marathon and you by now should know what those are. Managing existing products is more to do with penetration, increasing the existing spending. Introducing new products is product development. Discontinuing unsuccessful products is called divestment of a product, right? This could be market penetration. Introducing new products. Introducing new products into existing markets is called product development. Discontinuing will be about divest. So basically, what are going to be your corporate level strategies with respect to the product, that is also being discussed here. So managing existing products over time, introducing new products, and discontinuing unsuccessful, these are all corporate level strategies. And to help you understand what corporate level strategies are, of course we will do stage 3. But plus, decisions are to be made regarding backpacking, branding, warranties. How much warranty to give? Should we give a limited warranty, lifetime warranty? What should be the packing? Which color should be the packing? What should be the branding? What should be the logo? All of those which make a little sense to that, they have to be given that also. Then, when coming to the types of product, this is to understand how many types of products are there. There are some products which have a perpetual demand. That means 365 days, 24/7, no matter what you do, they'll keep having demand. But there are some products whose demands are having a very short lifespan. Some products have steady demand over time, while others have short lifespans. Then, how to differentiate one product to the other? Products can differ in size, shape, color, packing, brand name, and also after sale services. Now, since all these are the differences which are either sometimes see, sometimes even if difference is not there, people think some difference is there. That is psychological. So some differences which are visible, they are very much unique in nature, but some of them are also psychological in nature. So that is why, right? Multiple brands of shampoos are there. Head and Shoulders, Olay, Pantene, different names to think different things. Head and Shoulders removes dandruff, right? Pantene gives you strong hair. They'll tell you all this right in the advertisement. They're all sold by the same company, Procter and Gamble, P&G, right? So like that, the point is about people do different things to ensure that customers develop a strong brand loyalty towards brand. So brands, yes, role of brands, you can see brand is a very important thing. Brand names help customers identify the products and the companies that are behind them. Strong brand loyalty is built through advertising and promotional efforts, which enhance the company's image and the product's appeal. So that is what the story is. And then moving on here, pricing strategies, very important. I think all of you are well aware of the pricing strategies. When launching a new product, companies must decide pricing strategies after considering the focus on customer needs, and don't price the product without you getting anything out of it. So you also charge a reasonable margin over cost. That is also sensible to do. And then how to increase the market share. But in this context, if you have to discuss, there are two pricing strategies. One is called as penetration pricing, or it's also called as preemptive pricing. Penetration or preemptive pricing, where your idea is to enter the market with temptingly low price and then increase it. Then the other one is where you enter the market with a high price and slowly you lower it, like they do it for mobile phones. When you launch a mobile phone, 1 lakh rupees, slowly 6 months later the same phone will become 80,000. How? They removed some parts. No, they won't remove some. That's a strategy. So all those people who are attracted to the novelty, that is the new ness of the product, they'll be like, "Yeah, a new product. I want to acquire. I want to acquire." So they pay more for it. But once the product's slightly becoming older in the market, other people who want to buy can also buy. This price is called as a skimming pricing, right? Anyway, their names are not discussed in our syllabus, but I thought you should know these two pricing strategies. Are called penetration pricing and skimming pricing. Now, depending on these aspects, it go for various marketing services, right? Guys, these one-line marketing techniques have been asked in the MCQs. So you can just run through all of those and go. Social marketing, where social ideas and thoughts are promoted. It is called as social marketing. Save water, go green kind of stuff, right? Acceptance of social ideas or causes. That's what the point talks about. Then moving on, we talk about augmented marketing. This was once an exam question. Augmented means in addition to. So more than what we're doing now, if you're doing something in addition to what you're giving, say for example, you took Tata Sky TV connection. Along with that, they gave you watch movies on demand. Now, you didn't take a cable TV connection to watch movies. They're giving that to you in addition, right? Like say Geo Fiber is giving you OTT, as I wrote there, right? You bought for internet. No, you didn't buy for OTT, but they're giving additional services, right? So Geo Fiber, and then direct marketing. Direct marketing is through catalog marketing. What do you do? Make a catalog of your product and present it. Engages consumers directly. It engages whom? Consumers directly through various media such as catalog. Catalog is nothing but a old school style of making a book of all your products and giving. Nowadays also, if you go to paint shops, paint, they'll give you a catalog of all colors. Which color you mix with what new color can come. They'll give you a catalog. A catalog is like a book. Okay, nowadays everything is digital, so people tend to choose all this digitally also. But the fundamental point is that catalog is a bundle. Nor through email, then the telebrands, TV shopping headache. You saw that, no? Those. That means you're directly attacking the customer. Social augmented direct. Relationship marketing to build strong relationships. Generally, banks employ this kind of a strategy, right? Banks, credit card companies, they give you reward points. Airlines, service oriented businesses can do relationship marketing to build a strong sense of relationship with the customers. Then followed by services marketing, person marketing, place marketing, and organization marketing. All these in the name only they are there. In services marketing, you are marketing something which are intangible services. Like I'm a chartered accountant. In practice, when I'm going to my clients, I'd be like, hello, I'll do this service for you. I'll do audits. And what is audit? Audit is not a product that I can show them. It's a service that I can render, or for that matter, giving them a valuable advice. That is a service. So generally, if you are marketing something which is intangible, right, that is what is called services marketing. Person marketing and place marketing are very much the name. If a strategy involves promoting individuals, sports stars, politicians, celebrities, they do that. Their Instagram handles and Facebook handles are also nowadays handled by entity called as social media managers, because the image is very important for these people, because that is what keeps their career going. Whether anybody, social media is today one of the most important platforms for politicians, sports stars, film stars. And you think what, they have the time to sit and keep posting on Instagram? Only the average citizen of this country is wasting time on social media. Other people, like say some movie actors, they post 10, 10, 15, 20 photos a day, right? A bundle of photos. Then they'll post their vacation stories. You think they are going to uh, you know these vacations and do all this and then just to post those photos? They're all paid vacations. They're either paid by those resorts that they're promoting, or they're either paid by the country that they are going to. It's all marketing, right? So person marketing is done to promote careers. Place marketing is done to promote the place, like location. Please visit our city. That is a tourism marketing. Or please visit our website, right? Tourism is physical marketing. Come to Sri Lankan tourism. They'll show you all beautiful uh, you know the greenery, then the elephants, and then what do you say, the beaches, all of that in Sri Lankan tourism. They'll show kangaroos in Australian tourism. New Zealand, they'll again showcase you that breathtaking landscapes. Every country takes a short 1 2 minute video of that and say visit, right? Malaysian tourism, Singapore tourism, everybody come to a place. Or we do visit us at xyz.com. So that xyz.com is a website which is also a place. So many people think that place means it has to be physical. No, not necessary. It can be even virtual. So that is why that is also marked clearly. If all these eight are one side of the story, ninth one is an amazing side of the story called enlightened marketing. And if you see, the sentence starts by saying this philosophy, it is not even a topic, it's a philosophy. Why? Because one of the toughest things to communicate in marketing is, why am I in business? That is why generally people don't choose that. What people choose is what is that you want, and we are providing that. Nobody tells why I am in this business. I'm with a service motive or a profit motive. That's all my headache, right? So like that here, this is a philosophy which talks about 5 principles, and this has been asked so many times in the exam. Customer oriented marketing. So we are marketing what the customer wants, point number one. Two, finding an innovative way of doing the marketing. Value marketing, delivering value to customer is there. No. So what value are we delivering through this product? And very toughest part is to communicate my mission to my customers. A sense of mission marketing, because I believe if the other side people know my mission, they would be more connected or associated with me. So sense of mission marketing, and most importantly, what impact are we creating or making in the society? What impact are we making in the society? A societal marketing. What is it? A societal marketing also taken care of. So these are about the various marketing strategies of products and services. Now, segmental or target oriented marketing, if you see, differential marketing for different segments, right? Multiple market segment. Break your entire customer market into segment. Like say, for example, the best example is HUL, Hindustan Unilever. They are marketing their soaps. Hindustan Liver makes so many soaps, right? But end customer, as you saw some time back, he doesn't even know, because people are aware of the brands. They are not aware of the company behind it. So, for example, Lifebuoy, Lux, and Rexona, they are all for mass markets, but Dove is a premium segment. Lifebuoy also is HUL product only. Dove also HUL product only. Lifebuoy is like probably 30-40% of the price of what Dove is. Why they're doing that? Because Lifebuoy they want to market for different people, and Dove they want to market for different people. That is called differential marketing. Then marketing which is based on season or a time-based marketing is called synchro marketing, seasonal. Discounted movie tickets on weekdays, because weekends anyway demand is high. So like that, synchro marketing manages demand fluctuations. concentrated marketing. In the name only it is there. You are concentrating not on the entire market, but on a portion of the market, right? What are you concentrating on? You're concentrating on a portion of market. You're talking not large market, mind the word. Large share of a specific sub-market. What are you targeting? Large share of a specific sub-market, and that small sub-market is often referred as a niche, right? And that is why it's called as niche marketing. Whoever is your niche, if you target them right, you should be in a position to sell your product to them. Now, if all these 12, 9 in the previous one, and this 3, they were all promoting something, then comes a very remarkable strategy called demarketing. Sometimes, because the demand is so much, if the demand increases too much over and above the leaps and bounds that we can manage, then it would obviously turn into a problem. You know why? Because we won't be able to manage the demand and we may collapse. And which is exactly why sometimes strategies are introduced to reduce the demand. Sir, which mad fellow will reduce the demand? Yes, sometimes it is better to reduce the demand than to finally lose the entire business. So, because every time there is over full demand, people expect from you and you're not able to deliver. Some days later, they'll write off. Just like, say, for example, in a restaurant is there. Every time I'm going, it's full. Some days later, people won't go only. And you would have seen this. So many high power brands like that who make a huge impact in the beginning will be having no business later. That is because of hype. That is why to have a regulated flow, sometimes strategies to reduce the demand either temporarily or even permanently, like controlling overcrowding in public places during peak times, or overcrowding in buses, right? Time based offers can all be given to do some demarketing so that it is made sure that you don't lose it permanently. Understood? If you, sir, why will anybody do their own demarketing? To survive. If you don't do that, probably you lose the whole basic also. So that is exactly why some people may tend to do the demarketing. So these are the 13 different forms of marketing. First 9 based on products and services, and the last 4 based on segmental marketing aspects, right? So I would like all of you to listen to me for one more topic called as channels, and that will complete the strategic drivers. Then I will give you a moment of pause where probably you can go ahead and do one more round of quick run through. So just hold on there. We will move on to the last piece of discussion called channels in this strategic drivers topic. Channels. What are channels? Channels are nothing but distribution system. What is your way of taking the product or service to the customers? Deliver it product or service, or we'll deliver it online. We will deliver it physically anyway. See, Lakme. Lakme is one of the most popular beauty products, right? Lakme sells through retail stores. In the local nearby fancy shop, you will find a Lakme product. Amazon, Flipkart, Nykaa, if you open their online platform, it will be available there. Lakme is available on their own website. Same way, Boat. Boat is sold only through e-commerce platforms because Boat recognize that all those high cost of rent, marketing, all that can be avoided. Who are the people who are mostly using earphones? Earphones are mostly used by people those who have smartphones. So why not sell the product also on smartphones and online? Okay, done. So they have taken that route. And Coca-Cola available in retail stores, available in online platforms, right? So everybody, Britannia, Nestle, Coca-Cola, these are some of the brands that have the largest distribution channel. Imagine Britannia, they supply bread to the whole country every morning in your nearby retail store. Also, Britannia bread is available, which means that's big. Maggie packet by Nestle is available everywhere. So you go to a place, some place, no water also is not available. Coke and Pepsi are available there. So these guys have established their distribution channels so strong. And in the recent times means in the last decade, somebody who has captured all possible distribution channels is Patanjali. Now I don't really care whether you like that brand or not. For me, it's a great example, right, in strategic management. Now, of course, I do understand some people are you know claiming that the promotion of the product, saying it's all natural, is not correct. Agreed, no product can be all natural like that. Now, of course, the Ramdev Baba who backs up that Patanjali products, right? It's a huge business empire right now. So I am not bothered about the moral aspect of it right now. I want you to understand the way they capture distribution channel. Every possible, they're available. Earlier, they used to be available only in select places, which are Patanjali yoga centers. Then from yoga center, they expanded to exclusive Patanjali stores. Then they became Patanjali mega stores. Then they came to supermarkets. Then they came to retail stores. They're available in D-Mart. Now they are available all places online. You name a distribution channel and a Patanjali product is available there. That is one of the widest examples of how every small distribution channel was captured by them. So the more control you have on a distribution channel, the greater will be your competitive advantage. So therefore, a company's distribution channel plays a very critical role in its ability to compete. The more you are available, the more you'd be visible. So three channels are there here and discuss the main types. The three main types of channels to consider are sales channel, product channel, and service channel. In sales channel, we have intermediaries who sell the product. For example, fashion designers are there. They generally don't sell, they only design. Now, like say you see somebody big names like Manish Malhotra is there, right? In the fashion industry, I'm telling, right? And you have Sabyasachi. These guys are so, they become so huge that they don't have the time to go and sell their products. So they focus their intellect on design, how to bring new designer, where they focus on that. They have agents. What these agents do, they take agency from multiple designers. They go to these rich people and they're like, see, this is a Manish Malhotra design, this is a Sabyasachi design, this is Shantanu Nikhil design. They show all this and they sell and take commission and come. Right? So now that end of the day, it is about the skill on how it works. Okay. So that is what as a channel, first one. So that about a sale channel. Now let us move on to product channel. The next one here. So you understood the designer example, right? So all these guys use the sales channel. Now, product channel is where we are talking about the channel uses intermediaries who physically handle, like these are like the people who deliver. Now our India Post is there, the speed post services. So Australia Post delivers the products purchased through online stores like eBay. So if anybody in Australia purchases through eBay, the Australia Post, they will handle the product delivery. So how the product reaches your customer? Through an intermediary like this. These are intermediaries who physically handle. Sir, can we call them a courier company? Yeah, probably a courier or a post office or a post company can be a product channel. Then service channel, very important. You buy an AC or an electronic appliance or anything like that, what you need is somebody should come and install those. Without installation, you're saying, hey, okay, buy this and product is sold. That will not be really done. This refers to the entity that provide services to support. For example, dishwasher. Bosch, you know Bosch, one of the very well-versed companies when it comes to these industrial equipment, if you see them, right? So the Bosch dishwasher, if you buy a dishwasher or a washing machine, anything like that, in a Bosch showroom, they'll be installed by a Bosch contracted plumber, right? They will come and they will install, just like how ACs, LG company AC, Samsung AC, Voltas AC, any AC you buy, installation guys will come and install it. That is the service, because without that, the sale is not complete. So delivering the final product into the hands of customer, delivering the final product into the hands of customer and completing the sale is also possible through the service channel. So sales channel, product channel, and service channel are the three channels. Now, all three are very important. But if you want to see deeply into the minds of customer, which channel is good for you? If you want to see, you have to do a little channel analysis for growth. When you are expanding into new markets to grow, the business must develop or leverage the existing channels. Leverage means make the best use of, and then to reach new customers, which channels you have to find out. This is an important question to answer. Choosing the right channel, this sentence right here is a very important. Choosing the right channels for your products and target markets are very critical. See, my example is there. Even in a hill station, forget about hill station, you go to any place, right? Coke and Pepsi are available there. Coca-Cola, bottled water and cool drinks, same way, right? um, I was once in Ladakh. I trekked up to the, I mean, like we drove up to the highest motorable road back then. Back then it is a, like 18,000 feet above. and then we drove up there in the highest motorable road and all that. And everybody after going there, they're like, okay, it's a very serene experience and all. There they are selling Maggie. Now there, a 10 rupees Maggie packet, they'll just boil and give you, or 100 rupees, right? Place Monopoly is the best example. But more than anything, why would people pay that much? Because an experience. Standing at that height, once it's almost, its oxygen levels are pretty low, you're almost in that state, and then there is a slight bit of a snow, and there you're holding a Maggie very hot and eating. That's an experience. People pay for that. So 10 rupees Maggie packet sold at 100 rupees won't look like a big deal. Understood? So the point is, how did these people even reach there? So there, a package bottled water is available, Maggie is available. So, and there is a shop. It's not like people take, that is like, so there is a distribution channel. We've reached there. So this is one of the widest possible distribution channel activities. Same, many places like that, they have reached people where people can't imagine. They have reached there and kept, right? Coke, Pepsi, Patanjali, Asian Paints has reached almost every possible place, even a small village, they have Asian Paints, a paint shop there. So like that, the more you are distributed, the more you are widespread, the much better this situation would be. Okay. So this is the story, guys, with respect to the four aspects of drivers. Let me just see if that completes our discussion here. Yes, of course, let me bring back that on your screen. So this is what the key strategic drivers look like. Done. So with that, we wrap up the whole discussion of all the aspects which are to be analyzed externally and internally. Now let me sum up quickly this discussion by taking you through a small understanding of what we call as a SWOT analysis. But before doing the SWOT analysis aspect, I would like to discuss a couple of small but very important aspects, both of which are exam questions, right? Because after we did all this, we will have to accumulate all this and put it into a SWOT analysis story, so that the finality of stage 2, we can call stage 2 as done, and then we can open up the discussion on stage 3. So if you go by the book, no, after these key strategic drivers are over, immediately there will be a topic on what do you call as SWOT analysis to wrap this up. But before that, core competencies and competitive advantage, I want to discuss both these topics. Core competencies, let me bring through that on your screen right now quickly. Yes, building a core competency. What is core competency? It is a combination of skills and techniques. Combination of skills and techniques rather than an individual skill or technique, right? So what are the skills you have? What are the techniques you have, right? Which techniques and skills you can bring together? The word bringing together, I've used it as synergy. You gain a synergical advantage rather than individual skill or technique. Many individuals will have in individual places, but that doesn't generate a core competency. It can generate a competency, but when that combination of all those make it a unique thing, that's when you call it as a core competency. Okay, so that is what we have here in terms of building a core competency. Two people, CK Prahlad and Gary Hamel, told that major core competencies are identified in three areas. How many areas? Three areas, which are about competitors differentiation, customer value, and application of competencies. So talking about competitors, I'll take you to these three. But before we go there, I want you to understand one of the most important aspects about core competency is when these skills and techniques can be applied not in one but across the organization. If you can apply this concept across the entire organization, then only you will call it as a core competency. Core competencies are read as the unique strength. They are read as what? The unique strength of the organization. And core competencies, when applied in the right manner, will generate core competencies. When applied in the right manner, will generate what is called as competitive advantage. So in which areas can you generate core competencies? You have to be different from the other competitors so that you can have some edge over them. That is called competitors differentiation. Then two, deliver some kind of a value. Deliver what? Value to customer. If you're delivering some sort of a value to customer value, and also application of competencies. If you have competencies alone, they are not enough. You should know how to apply those competencies. Like we discussed about value chain. You remember primary activities and support activities, right? How are primary activities linked between each other? How are support activities linked between each other? And how are primary and support activities linked to each other? Now, on a normal day, every organization following value chain will do all these activities. On a normal day, every entity following a value chain will do all these activities. But what is the secret of their success? The linkage between those. How one organization is linked to the other. That is what will create the ultimate success story for them, right? So that is about the three areas in which you can build core competencies. You want to take a more clearer look of this, you can do so. I would want to obviously discuss something which are just, what about the 3 points that we are talking about? I want you to just see those quickly. I'm bringing that also back to you. As you see this one, you can see key conditions for achieving a core competency. Competitors differentiation. You have to have a unique edge over competitors, and also the company has a skill or technology which is difficult for others to imitate. That is the first thing, competitive differentiation. Then two, core competency should be such that they create real value for customers. What do they create? Real value for customers. And if it offers some unique advantage, then it is called a core competency. If customers choose the product because they got a unique advantage, then it is called core competency. And like I just told you, it should not be applicable only to one product or one area. It should be applicable to across or entire organization. Then only something will be called as a core competency. Core competency should apply across the entire organization. So one more time, I'm showing you all three things. It gives a unique advantage, create real value for customers, and apply across the entire organization. These are the three key conditions when you can call something a core competency. Okay. Now, building core competencies is a very important aspect. While core competencies are the knowledge, skills, and facilities needed to design key products, they are the unique combination of technological, physical, and human resources. I can copy somebody's strategy. I can copy somebody's way of doing something. But what I can't copy, the intangible thing that is involved inside that, that is only called as the linkage or the core competency. Now, everybody is doing primary activities, everybody is doing support activities, but way X Limited is doing the primary activities is very different from the way Y Limited is doing that. That is why X Limited has an advantage over Y Limited. That is the ultimate understanding of this story. Okay. Now, once you build a core competency, you have to hold it up. The four criteria, these are a very, very, very important points. The core competency that you develop should be valuable capabilities. A company creates value for customers by using these capabilities effectively, right? Create value for customers. If your capability is not creating value for customer, it won't be called a core competency. Second criteria to build a core competency is such capabilities are supposed to be rare. How are those capabilities supposed to be? Pretty rare. Core competencies are rare capabilities that only a few competitors can possess. If many firms have the same capabilities, they cannot be a source of competitive advantage. So, the first 2 points are core competency should be valuable, core competency should be rare. And then the core competencies, if they are easily imitable, then also they will go off. So the core competency should be costly to imitate. Even if others try to imitate, that should be so difficult to imitate that they'll give up somewhere midway and say, okay, it's very difficult to imitate, right? So it should be costly to imitate, and capabilities are difficult or expensive. So when you do that, like say for example, Intel designed something. By the time others were able to copy Intel's designing second product, then when somebody is trying to copy Intel's first product, Intel's already gone to their second, third product. That is called first mover advantage. the faster you develop a product, and then you're continuing to have a better R&D skill. So here, the fast R&D that Intel is able to do, that is their core competency. And then lastly, it should not be substitutable. If your competency is substitutable by something else, then again other companies will copy. So therefore, non-substitutable capabilities are those which do not have any equivalents, right? So valuable, rare, costly to imitate, and non-substitutable are the 4 criteria that will determine or that will tell the core competencies have been built. Okay, so I want you to just quickly go through the entire aspect, because what we are going to now do is, if I bring this up for you, yeah. So core competencies and 4 criteria to build the core competencies are the valuable, rare, costly to imitate, and not substitutable. Similarly, when you build core competencies, you would achieve something called as competitive advantage, that is an edge over the adversaries. Once you achieve a competitive advantage, you have to protect that. This is another very important question that has been asked many times in the exam. How to hold or how to have sustainable competitive advantage. Sustainable competitive advantage is something that to achieve, you need to bother about 4 aspects: durability, appropriability, imitability, and transferability. In this, 2 of them should be there. What are those? Durability and appropriability should be there, because durability means the stretch, the timeline for which you can have. Appropriability means if you are getting some profits or returns. Appropriability is about getting some profits or returns from the business. Are you able to appropriate them back to the business? If so, you can hold the competitive advantage. So durability and appropriability are the 2 factors that are supposed to be present to sustain a competitive advantage, while imitability and transferability are 2 things that are not supposed to be present. Like if they can imitate what you have, then again you lose a competitive advantage. Same way, if skills and resources are easily transferable, then also you will lose your competitive advantage. How to have sustainability in competitive advantage is a multiple time asked exam question. So I would want you to go through all of this. Guys, to sum up, all I want to tell you is the small piece of work that you can always do. We did a very extensive discussion of all the external factors. We discussed in this last 1 or 10 minutes or so, we discussed the entire content of the 3rd chapter, which are part of internal analysis. Now, finally, we are discussing the conclusion of stage 2, which is by preparing what is called as a SWOT analysis. SWOT analysis talks about strength, weakness, opportunity, and threat. Strength is an inherent capability for the organization, while weakness is an inherent limitation of the organization. Opportunity is a favorable condition in the organization, and threat is a unfavorable condition in the organization. And remember, SWOT, we are only plotting those 4 things in 4 boxes as strength, weakness, opportunity, and threat. We are not going to compare them. SWOT is a comparative framework which enables comparison and not compare, because as you can see here on screen, A, B, C, D, only 4 boxes are plotted over there, right? You are not doing any comparison. If you want to take strength and weakness, if you want to take opportunity and compare and all of that, you can always do that. Let me just show you the example. Here we've been SWOT analysis example. Strength, weakness, opportunity, threat. Only in 4 boxes we have plotted them. We are not doing any comparison because the comparison piece is not in your syllabus. It is called a TOS matrix. S2O, WT, STWO, as I wrote here. This comparison will be done in what is called a TOS matrix proposed by Heinz Wirich. Now that is not there in your syllabus, so let us not break our head on that. All I am saying is SWOT just is something that will enable a comparison. After writing all these 4, you can do a comparison, but on its own, it is not a comparison. It is just a comparative framework. I hope that clarifies the entire thing. See, this is such a simple analysis, but for you to plot those opportunities and threats, you did a lot of external analysis. For you to plot these strengths and weaknesses, you did a lot of internal analysis. After doing all this analysis, finally you present this in the form of SWOT analysis, which is the beginning point of various decisions that you can take. Understood? So SWOT analysis, again I'm telling, is not a comparison, it is a comparative framework. I hope that clarifies this entire story. We have to move to stage 3 on crafting a strategy. But again, this is a time where I suggest you, sir, third chapter is not yet over. Yes, third chapter is not over. It has Michael Porter's generic strategies. I know very well, don't worry. But Michael Porter's generic strategies come under, crafting a strategy. So the last piece of third chapter, though the chapter's title is internal analysis, the last topic, that is the, different textbooks have different numbers. So I'm saying Michael Porter generic studies of cost leadership differentiation focus. I will discuss them obviously in the next segment, but they are also under crafting a strategy. So I will give you a brief overview of stage 3 and then see what comes where, and then we will pick up that discussion. So right now, all I want you guys to do is to take a moment of pause at this point of time and revise the entire thing, maybe from the definition of stakeholders, Mendelow's matrix, to everything that has gone in the last 1 hour 15 minutes of this segment. And right now is a time where I want you to go ahead and comment stage 2 done, right? You can even say, stage 2 done is like already you achieved core competencies. Right now you know what core competencies are, so you can comment achieved core competencies. And since we have done SWOT analysis also, you can go ahead, you can leave these two comments. Once you achieved core competencies, below that say stage 2 is done. So now very extensive stage of strategic analysis is done. Previously we discussed the entire story about the strategic intent. In the upcoming piece, we will discuss about stage 3, crafting a strategy. And then obviously we will move ahead as per, after discussing the stage 3 story of crafting a strategy, we will then discuss about uh, the last piece of chapter 3 and the whole of chapter 4's first part, where we talk about stability, expansion, retrenchment, and combination. So let me show you this quickly as to what we are going to discuss here. Stage 3, which is about crafting a strategy. Two topics are there in that chapter. It is going to come up, and only thing I want you to do right now is to put me on pause and comfortably review everything till here, and then resume watching the marathon. Welcome back, guys. I hope you have gone through everything up till stage 2. Let us now move on to stage 3, which is about crafting a strategy. Now, in this stage, which is one of the very, very important stages, of course, in strategic management, and also from exam perspective, a lot of questions have been asked in the past from this, because you have so many interesting topics like the matrix are there, right? Then stability, expansion, retrenchment are there, cost leadership differentiation focus are there. So the stage 3 of strategic management always is one of the very, very important thing from strategic management perspective, and also from a student's perspective who is writing an exam also, it is very important. Now let us move on to understand what are the aspects that are there in crafting a strategy. So you have so many choices to make a strategy. That is why it is called a strategic choice. So of the several aspects that are available, what are the strategies that we should choose? Now, I want to take your memory back to the first chapter, where we discussed the fact that strategy is made by all levels in the organization. Corporate level people make strategies, business level people make strategies, functional level people make strategies. Now, functional level strategies are not part of our syllabus, while business level strategies, which are also called as base generic strategies or Michael Porter strategies, which are in the likes of cost leadership, differentiation, and focus, while corporate level strategies, which are in the likes of stability, expansion, retrenchment, and combination. Again, combination is not discussed in our syllabus separately, but multi-product businesses which are engaged in, like our conglomerate businesses which are engaged in multiple types of products, they can choose to do stability in some areas, retrench certain other products, and expand over certain other products. So that strategy, where you're actually using more than one of the corporate strategies, is called a combination strategy. So this is one part of the discussion, while business level strategies are discussed in the last topic of chapter 3, that is Michael Porter strategies are discussed in end of chapter number 3 syllabus wise, and the first part of fourth chapter. Now chapter 4 we can split into two parts. Part 1 of chapter 4 is discussing all the corporate level strategies, also known as Gluick and Josh strategies, because they are the ones to propose these. So right now what we will do is, because the marathon is going in a form of the stage wise revision, wherein our idea is to cover the entire syllabus, and this time we are not even leaving small topics. So let us now do one thing. First, I want you to understand the framework, which I hope you did now. Crafting a strategy talks about three levels: corporate level, business level, and functional level. While this business level is about the last topic of the third chapter, we will do that: cost leadership, differentiation, and focus. Then we'll come to stability, expansion, and retrenchment. This is chapter 4, part 1. So we will be done with chapter 3 and half of chapter 4 and one part of stage 3. The other part of stage 3 talks about if you have money, that is when you have to make an investment decision in a multi product business. We have to construct a portfolio of all our businesses, a portfolio of all our businesses, and then decide which business will receive how much investment. Some business may receive high investment, some business may receive low investment, and some business may receive no investment. So which business should receive how much? Which business should you build? Which business should you harvest? Which business should you divest? To take these kind of calls only, we have some wonderful matrix in the game. Boston Consulting Group matrix. Igor Ansoff gave a product growth matrix, right? Wherein, already when we talk about expansion strategy as part of intensification, we get to see the Igor Ansoff matrix, uh, market penetration, all of those aspects. And then, uh, in order to address the BCG matrix's limitations, there is a GE model, also called as a stoplight model. And then we have one of the best matrices in strategic management, which covers every possible situation for every possible company. 5 companies, 4 stages in the life cycle, everything taken together. 20 box matrix, and where do you stand is what the ADL matrix is about. Now, there is a definite way. Those of you who are watching this for the first time, or those of you watching or hearing me for the first time, I will teach you ADL matrix in such a way right now that you will not forget it forever, right? Because till now, maybe that's one of the topics that you would have left in choice because it's having too much content to by heart or remember. But once you know the logic today, you will not look back. And in fact, it will become one of the most easiest things for you. And if it comes in the exam, you are going to make the most of it. So this is the agenda for this hour of discussion, and I want you to stay really focused because um, this is something which I take a full look at it as I speak. So this is something when you see on screen, there's a lot of marks on this very screen of yours right now, right? Cost leadership, differentiation, focus. There is always some kind of a question from this lot. Okay. Then stability, expansion, retrenchment. There are definitely something or the other. They ask you concentric, conglomerate, vertical integration, horizontal, in something or the other. And sometimes they ask you straight questions about stability. And then there has been no strategic management question paper without a question from portfolio analysis. In my experience, from when I was a student to when strategic management basically was introduced in 2008 in CA syllabus, so in the last 17 years or time about that, there hasn't been a question paper where there is no question from one of these four matrix. Something or the other, a question or an MCQ or something or the other will definitely be there from portfolio analysis. So guys, this R is going to be one of those very crucial aspects of your revision. So I want all of you to stay very alert and stay with me in this particular exercise, right? So let us now continue the discussion going back to what we talk as Michael Porter's generic strategies. As I told you, because we want to wind up, I can obviously do it, what do you say, order wise, but I would also want to keep syllabus intact so that where we are coming now, we don't want to break the flow there. So last topic of the third chapter, if you can come down to that, you will find Michael Porter's generic strategies, which are also titled as business level strategies, also titled as base generic strategies. Sometimes all your marks can be there only, huh? So Michael Porter's generic strategies are talking about cost leadership, differentiation, and focus. Now, let us talk about the cost leadership strategy. What is a cost leadership strategy? Cost leadership strategy and differentiation strategy, both these aim at a broad market. I hope you know that. And because this is revision, I'm taking that liberty of thinking that you already know what these two mean. And I'm wanting to give you a little more information about here. Cost leadership. You're striving to be the lowest cost producer in the market, lowest cost. You're working and putting all your effort to be the lowest cost producer in the market. However, on the other side of product differentiation, you're aiming to drop or create a unique product in the market, unique in the form of its color, size, packing, anything which is unique for which the customer is willing to pay. That is the uniqueness that we are looking at. And once these two are done, we have a strategy called as focus strategy, where in focus, you are only going to focus on a narrow market niche. Focus strategy is also called the niche marketing strategy, right? Niche means a narrow market, a very specific targeted group of people with specific taste and preferences. Like if you're making products only for people who are diabetic, right? You have targeted, like sugar free products are being made only for them. So then that is the target market. Or you're choosing only infants, you're choosing only women, only men, like say depends on what sort of a product you are. That is why on perfumes, men, women, separate target market, right? And then on beauty products, certain products because the skin type is different, right? All healthcare products, again, classification. Infants, children, adolescents, adults, like that classification, right? Then products which are meant for everybody, unisex products, so like that. You have to understand who your target market is. Now, the beauty part of focus strategy is, once you have decided to focus on a particular group, like you, there will be others who are also focusing on that very group, correct? So, within the same target market, competition might arise now. So, within that small target group, you may now choose to become a cost leader. You may now choose to become a cost leader, or you may now choose to play a differentiator where not for the whole market, but only within that market. So that brings us into the game of focused cost leadership and focused differentiation, right? So this is exactly what are the two branches that you're seeing here, which again the focus strategy is split into focused cost leadership and focused differentiation. So guys, striving to be the lowest cost producer in the market is called as cost leadership. Aiming and creating a unique product which is unique in the form of color, size, or packing is our target in the second. Now, look at who are you targeting. In the cost leadership story, you are targeting the price sensitive customers. Who are you targeting? Price sensitive customers. People who are uh, people who are sensitive towards changes in prices. You are targeting them. How? I gave you an example. Can you see there? Cost is 8 rupees, profit is 2 rupees, selling price is 10 rupees. This is the initial equation. Okay. Now, later you did cost leadership and you got it down to 6 rupees. Now, 6 rupees is your new cost. Now, listen here. We have two options. Either you can continue to sell at 10 rupees. You can continue to sell at 10 rupees and add a margin of 4 rupees. This is one particular option here. Or you can do one thing. You can check the cost at 6 rupees. I mean, you can keep the cost at 6 rupees and just add a profit of 2 rupees. Now, 6 rupees of cost with 2 rupees of profit will make the product at 8 rupees. Now, that is where the entire game changes. When your product price is at 8 rupees, all price sensitive customers will be attracted towards you. There is one more advantage here, that after a particular point of time, if suppliers increase the cost of raw material, your cost went from 6 rupees to 7 rupees. Your cost went from 6 rupees to 7 rupees. You will be able to absorb the greater price increase in the cost of the product, and then that 6 plus 2 can now become 7 plus 2, and still you are at 9, which is way below your rivals. The only target in cost leadership strategy is to underprice the rivals. What are you doing here? Underpricing the rivals. And when you underprice the rivals, automatically all the price sensitive customers will always be with you. So this is the story of cost leadership, right? Now every story here of cost leadership and all of that, they have advantages. I have not obviously given each one of them here. We will see advantages, talk about how to handle all the Michael Porter's 5 forces, while each of them have some disadvantages also. We'll take a look at that once we finish revising all three. Now coming to differentiation, in differentiation your target market are people who are price insensitive. Some people are there who are price insensitive. They don't bother about the price, but they are sensitive towards the product features and its novelty. Novelty means it being new. A new product came, so they will jump and go and buy the new product. That is their way of doing things, so that they are like more happy in buying a new product. Just like you see people queuing up on the day of iPhone's release. Why 3 days or 5 days or 1 month later, if you buy the iPhone, will features change? No, but they want to have it new. 6 months later, the price of the same iPhone is dropped by 10,000 or 15,000, but 6 months later it becomes a old phone, right? They don't want some old phone that the day of release they want to go and buy, or very shortly after the release. So these guys are sensitive towards novelty, sir, but in the initial time they will charge high. No, they are ready to pay. And that is what differentiators aim also. They create the differentiation, they make it unique, and they charge a premium. Will customers be ready to pay the premium? Of course, yes. There are no two thoughts in that. They will be ready to pay the premium. Now, please understand the next topic very clearly, because this could turn out to be an exam question as well. Here, on what basis can you show the differentiation? Many people think differentiation means some new feature has been added. That is why it is different. Yeah, you are right, but only to 33% extent, because that is only 1/3 of the story. There are two more aspects where you can show. Yes, first one, what you said, product differentiation. Due to innovation, if you are adding new features to the product, due to innovation, if you are adding new features to a product, you can definitely charge a premium for it, and that is one of the bases to show differentiation. Product differentiation, where you can clearly tell, hello, look, our product is different from other people's product. You can clearly tell that and then show the differentiation. But the second one is about organization differentiation, where you are saying that our organization itself is different, where you are maximizing the power of a brand. What are you doing? Maximizing the power of a brand. Now, what many people don't even bother, but there is a huge differentiation shown every time, is the price differentiation. A differentiation that is shown in the price. That depends on the demand for the product. Okay, now I want all of you to carefully understand this. Price differentiation has to do nothing with cost. Okay, so don't confuse this with cost leadership. Are they trying to become cost leader and all that? No, they are trying to be price differentiators, providing the same product with a different price ideology is what the differentiators are doing when they are showing differentiation in price. They're giving the same product with the same set of features, maybe at a lower price or maybe at a higher price. Nobody told you that the price is going to be lower than the others. Price is different. Different means price can be higher, price can be lower, but they are emphasizing that, look, our product is different. How? By showing a differentiation in price. And with focus, you can clearly see there that focus is that shaded part that I put up there is what you're targeting. While this entire circle is the whole market, this one, the entire circle is the whole market. This is the total market. While in that, if you're choosing only this part, that be called as the focus strategy, the shaded region there, because you're not targeting the entire market, you're targeting a portion of, only you are targeting a particular specific, what do you call that, as a narrow market niche. That is what is called as a focus strategy, right? So I will take you through the advantages and disadvantages from the material, that I will do that right now. But before doing that, there is something that I want all of you to understand. Alongside these three people, who are the three people? Cost leaders, differentiators, and focus providers. There is also somebody in the market who is called as the best cost provider. Who is that? a best cost provider. These people, they don't target price sensitive or price insensitive people. The target of the best cost provider, the target of the best cost provider is a value conscious buyer. Who is he targeting? A buyer who is a value conscious. Now, people who are value conscious, you know what they are only bothered about? The value of the product. They are not bothered about anything else but for the value of the product. So, therefore, what are you now going to do is you provide the same product as your competitors, same product as that of competitors, but at a lower price, right? Or you do one thing, you give the same price as competitors, give the same price what the competitor is giving, but give better features. Somewhere you show that there is a difference, right? Same product, lesser price. Same product means whatever features are there in the competitor's product, your product also has the same features. So people when they compare A, B, C, D, E, 5 features are there. Here also A, B, C, D is there. Okay, very good. This product is 100, this product is 90. So you're showing that variation. They're saying that, look, we are giving you the same features at a lesser price. And on this side, you give the product at the same price. What is the price of A? Okay, 100 rupees. What is the price of B? 100 rupees. Array, no, sir, but B has 5 features more than A. Better features when you are loading up. That is what will be the better thing for, better thing to do for these people. Okay, so that is exactly what we call as a best cost provider strategy. Now, you know what best cost provider strategy is, right? Same product, lower price, and same price with better features. All this come under the best cost provider. So guys, this stretch of what you call as Michael Porter's generic strategies is a very easy yet an important thing. So the last 20 minutes we spent on doing Michael Porter's strategies. I would generally not, in the previous versions, I've never done the advantages, disadvantages. I would always leave it to students to do it. But now that we have access to the material, we will also do one thing. We'll just run down back to the Michael Porter generic strategies. They're also called base generic and business level strategies, cost leadership, differentiation, and focus. I've covered all the points as I explained. I just wanted to look at the advantages, disadvantages piece right now. So if you're seeing what the advantages and disadvantages are, in the advantage of cost leadership strategy, you can see that you can compete your rivals. They avoid a price war. They don't compete with you on price because your cost is too low. Even if they try to play games with you, you will bring down the price and teach them a lesson. So nobody would want to play price games or price wars with a cost leader. Two, buyers will not be able to exploit. You can easily tackle the buyer's bargaining power issue because your cost is so low and they will continue to buy your product because of the price. Then suppliers, as I told you, even if suppliers increase the price, we saw that example, right? Our cost was 6 rupees, 6 became 7. We were still able to make decent profits and sell at a lower price than competitors. So cost leaders can absorb greater price increases before they raise prices. New entrants will not dare to come in and fight with you because low cost providers, low cost providers have created such a facility that they can provide at such low cost. New entrant will never be able to do that. And when a new entrant is not able to do that, obviously they will be afraid. And a significant barrier to a new entry is cost leaders existing in the market. And lastly, substitutes. Low cost leaders are more likely to spend some money to induce customers to stay with their product. That is what we're doing here, stay with their product. And since they are saving cost here, they might want to invest to develop substitutes or even purchase of the substitutes. So cost leaders, whatever profits they are getting because of they being cost leader, they'll use that to either create a substitute or buy off that only, so that they have the entire control of the market. One of the very well sought after strategies is cost leadership. Mass production could lead to economies of scale and you can become a cost leader. Having said that, this strategy, like I just told you, will be workable only when you produce in mass quantities. So high sales volume is needed for you to succeed. Imitability. Now, first point what I wrote and kept as imitability is there as a disadvantage in all three. They can imitate your cost leader strategy. They can imitate your differentiation strategy. They can also imitate your focus strategy. So this point of imitability is there as a disadvantage in all three Michael Porter strategy. Now, cost leaders, again, another third point you see, One of the big disadvantages for them is they'll remove every additional cost, advertisement expenses, selling, distribution, wherever possibility is there, they'll reduce the cost. Now, while you do all of that, it can turn out to be a problem in the long run, not now, right? See, now everything will be going fine, but in the long run, because you didn't do R&D, you cut down R&D cost. Because you didn't do advertising, because you cut down that cost, in the long run, you may face a challenge. Until now, if you are doing something superior than the others using a technology, and tomorrow if that technology becomes a normal thing, technological changes can become a great threat to the cost leader. Okay, so this is a problem with respect to cost leaders. Then I would like to, we discussed everything about differentiation. I want to show you these three bases. Okay, base of differentiation is the product differentiation, where Apple's iPhone, because they invested heavily in their R&D, innovative products, that is product differentiation. Pricing differentiation, Apple charges premium prices for their products to establish superiority. That is called pricing differentiation. I told you it's not necessary that it has to be the lesser than others or more than others. Pricing can either be set low or high, but only thing is pricing is the differentiating point. I'm saying that look, we are superior, to convey that they're doing pricing. And organization differentiation is about the brand power. Apple again, all 3 points have been explained using Apple's example to say how Apple is using the differentiation strategy. And to achieve cost leadership and differentiation strategy, few points are there. Both of them have been exam questions. I would like you to take a quick look. Cost leadership, how much to produce, forecast the demand properly, use resources optimally, achieve economies of scale, standardize the product and produce it in mass production, invest in cost saving technologies, and don't do differentiation until it becomes a need by the market. This is for achieving cost leadership. While if you want to achieve differentiation, you have to see here, to successfully differentiate, match the products with taste and preferences, improve the product's performance, offer high quality products, engage in new product innovation, enhance the brand image, and fix the prices based on the unique features and the customer's ability to pay. If you fix something very high, customers would not be willing to pay for it. So think about achieving the differentiation strategy and follow this, right? Again, here also, uniqueness is difficult to sustain. Charging too high a price, uh, no, you may be different, but after some time, if you keep charging high price, customer will be like, that much is not needed for these guys. We will, cut back. So they will always think of another alternative. And differentiation fails to work if it is not a basis that the other person values. You are calling your product different, different, different. Customer is not calling it. So these three disadvantages are there in differentiation, and same five advantages on how you can counteract the Michael Porter's five forces. Rivalry, you can beat them because of people act that they buy the differentiated product because the brand. Buyers are price insensitive, so they don't negotiate for prices. Suppliers, even if the supplier increases the cost, you can buy the product and charge premium from customers. That's not a problem. We already discussed charging premium is anyway our thing, right? So there, because of low cost, you are able to absorb. Here, because you're charging premium, you can absorb. Then new entrants. Now, no matter what we do, new entrants may not be able to match the kind of differentiation that we bring in. So we act as a barrier for new entrants. And lastly, substitutes can't replace differentiated product, because the very fact that you're paying for a differentiated feature will not be visible or will not be there in a substitute product. Okay, so this is the set of advantages and disadvantages. Similarly, in focus also, advantages and disadvantages are there. You can charge premium prices to the niche, and rivals and new entrants find it difficult to compete because you're already there in the niche. Two advantages. But only thing, disadvantages, the firms lacking in distinctive competencies. If you don't have a special feature, or you don't have something which is crucial to show, then again this will be a matter of challenge for you to prove that we are different. So the firms lacking distinctive competencies may not be able to pursue a focus strategy. And since the niche is limited due to limited demand, costs can sometimes be high. And obviously, when the niche members' tastes and preferences change in the long run, niche could disappear. In the long run, niche itself can disappear. So, guys, I think I did my best to take you through all advantages and disadvantages. I know it's little quick. Obviously, that is what revision is all about. So please do, because earlier, like I said earlier, in the previous version of the marathons, I used to just simply say people have to just, I told you, right? I wrote right here, advantage, disadvantage, please go through is what I used to say. But now that time was there and the book is there, I choose to spend a little time on doing it. So that brings us to the best cost provider we already discussed. So that brings us to the end of this particular segment on Michael Porter's generic strategies, where he has talked about cost leadership, differentiation, and focus. Okay, so I would want all of you to take a small moment of pause and go through all the points. Use the whichever textbook you're having, go through all the points in these three strategies, and which will also mark the end of the third chapter, right? And we will then move on to, again, we will have to come back to our discussion on this one. Let me bring this back on your screen again. Yeah, this one, crafting a strategy. We are now going to discuss, since we've talked about business, now we're talking about corporate level strategies: stability, expansion, retrenchment. We will discuss those three, and then that'll be the next segment. And this further segment to that, we will discuss about the strategic options and wind up chapter 4. And then the last part of the stories discussion, we will go to talking about the chapter number 5 of the syllabus, which talks about implementation and control. Okay, so that is lined up. Anyway, all I want you to do is to give a couple of minutes to yourself and run through this one more time and continue watching the marathon. Come on, please do it. All right, guys. So on that note, let us come down to the corporate level strategies now. So in this context of strategic choices, we are talking about crafting a strategy, where we talked already about the cost leadership, differentiation, and focus part. Now, let us go ahead and examine the stability, expansion, and retrenchment part of the story to discuss about what are the corporate level strategies. As I then told you, we will discuss about the portfolio analysis. So at this level, we have two topics to discuss. First, we'll discuss the corporate level strategy of stability, expansion, retrenchment, and then we will come to the discussion about the various portfolio tools, right? So under strategic choice, the first thing that I would want to tell you is that these corporate level strategies that you see here, they also have other names. Let's bring that on your screen. And they are called as Glueck and Josh strategies, corporate level strategies. They're also called as grand strategies because the scale that is involved in doing this. And they are also called as directional strategies because they provide direction to the entity, right? So that is exactly how they become corporate level strategies or corporate strategies. Just to cross check before we start discussing stability, expansion, and retrenchment, we will just take a look here. Corporate strategies, as you can see, are three of these: stability, expansion, retrenchment. And of course, I told you that combination is a strategy that is used by those entities which are dealing in multi-product businesses, right? Meanwhile, the other three, stability, the firm does not do any risky aspects. The firm does not go out and try something new. The firm stays wherever it is. The firm stays with its current business. The firm what? Stays with its current business. It's not trying anything new. It's not venturing into anything new. All it is doing is use its existing resources properly and try to match to get a incremental, which means a step by step growth. These are not entities that are looking for radical growth opportunities. These are entities that are slowly wanting to sustain in the long run stability. But you cannot do stability strategy forever. When do you do stability? When do you do expansion? What is the right time to do retrenchment? All these aspects also we will discuss one by one. The second strategy is about so stability taken care of. The second strategy is about expansion. While expansion is considered the true growth strategy, when a firm is looking for significant growth, when a firm seeks significant growth in the current businesses, that is exactly when they want to enter into new businesses, which is in the like of diversification. Now, the other question that arises is, sir, the new business that you are entering, is it related to the existing business or not related? So considering all those aspects and then deciding what to do, related or unrelated, all those expansion aspects, we'll talk about expansion in detail. because corporate expansion can be categorized into two types, right? One is intensification, the other one is diversification. So how will that work? We will see that also. And after putting a lot of effort also, after putting a lot of effort also, if sometimes you are not able to, you know, to make the best out of that product, the firm should cut it off. Such a strategy where you cut off the product, such a strategy where you cut off the product is called as retrenchment. The firm retrenches some of the activities in some businesses or drops the businesses as such to through sellout or liquidation. That is what they are, and we will see them all in detail. So for now, all that I want you guys to do along with me is be a part of it. It's a very, very smooth, simple, flowing exercise. So to start with, let us understand what is the nature of a stability strategy. So if you see the key points in stability strategy, firm stays with its current business. So it is not a very remarkable strategy where you're introducing something new, or but at the same time, what you need to also remember is stability means folding hands, will not do anything wrong. Stability is not a do nothing strategy. So remember, stability means staying stable. You will continue to do what you're doing. Understood? It is not like stability means sit like a rock. Not that. Stability is about holding stabilization in the work that we do. So, stable workflow. You are not doing anything new. So, thereby, it is not a do nothing strategy. Right? What are we doing then? When you're doing nothing, that means you're doing something. What is that something that you're doing? Whatever you've been doing thus far, we'll do that only. Firm stays within the current business. It does not do anything new. Firm looks for incremental growth. It is happy with a step by step incremental growth. No fresh investments are needed. Risk is less. Now, very important point is sometimes the entities which have reached introduction, I will come to that point. Normally, an entity that has reached the maturity stage will take up stability because there is nothing more to do innovation or do something new. It is a matured entity, already reached that position. So you'll go by that, right? Entities who have reached maturity will take up stability. But sometimes stability is also preferred in introduction stage. I'll tell you the example of a spring. Now, the more you press the spring and release, it will go that far, right? That is the principle of expansion and contraction. So, more you contract, that is like the more you press the spring and leave it. So, this is like that. For a great launch strategy later, what you need to do is to stay stable, stay stable, stay stable. This is something called as perseverance. Like, normally, you cannot, if you're like willing to lift a weight, so you want to lift a 10 kg rod. First day, when you go and directly lift the 10 kg rod, that's all, you will have a back spasm and gone. You will never be able to step into the place again. So what should you do? Start the free hand, then a stick, then a 1 kg, 2 kg. Why? Gradually, daily effort, daily effort, daily effort. And then once you are ready for the big launch, that is when you can lift the 10 kg rod. Same way here, stay stable, practice, 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 practice till you get to a level where, yes, now I know what I'm doing. And then you can launch for a growth strategy, right? Stability is just about staying wherever you are, not trying to do anything new. So it is about maintaining a status quo, no redefinition of business, and more importantly, firms with a modest growth objective. Somebody who don't want to grow overnight, they can grow incrementally, one by one. Those people who want to grow modest, they will follow the stability strategy. So that is our very first corporate level strategy, which is called as stability strategy. I don't think I've missed any point. So let us just quickly cross check. Maintaining the business, steady efficiency. The business stays. No new aspects. The strategy ensures that business stays on its established path, retaining its competitive position and also adapting to the market changes. Now, the big question is, when is a stability strategy used? A stability strategy is adopted when the firm serves similar markets, that it is not doing anything new, huh? Where there's the same or similar products, where you're dealing with same or similar products, and where the products are in which stage? Products are in maturity stage. In fact, Small organizations can aim to consolidate before planning for growth. Now, what is the stage that is before planning for growth? Introduction stage. So that is why sometimes you can use stability also in the introduction stages. Looking at two very important exam questions, as you can see there. One of the key set of characteristics. Continuing in the same business, same level of effort, incremental improvements, not drastic, but step by step improvements. Avoiding significant changes or redefining the business, and having a very safe approach that maintains the status quo. Status quo means you're maintaining the same position. Okay, you're not doing anything new, you're not doing anything bad, right? Maintaining the same position, requiring minimal new investments, very less risk is involved, and it allows the organization to focus on their core competencies and strength of the existing markets or products. And what I told you towards the end, those firms with modest growth objectives, but because if you have ambitious growth objectives, you will go for the next strategy and not this one, right? So this is typically chosen by those firms with modest growth objectives. And also, if you look at what are the major reasons for doing a stability strategy, business chooses a stability strategy because products have reached the maturity stage. You want to maintain a status quo. The operating environment is relatively stable. When outside so many changes are not there, relatively everything is stable. Why do you want to complicate by doing something, right? And then right now doing expansion could turn out to be risky. So it's better to stay stable. And when the right time comes, you can go for it, right? And lastly, after a rapid growth, the firm now wants to consolidate, means to stabilize for some time. This is after the storm, right? There are two types of calm before the storm and a calm after the storm. The second one is like the calm after the storm. Rapid expansion took place. So for some time, I want to chill down and, kind of take a regular activity going. That is like stay stable, not doing anything new or big, right? The big question is already made into the exam. Why don't startups aim for stability? Obviously, startups don't aim for stability for a simple reason that in the beginning, the fire is high. Speed, agility. Agility means the ability to move quickly, move easily. That ability, the most important factor is speed and agility in the beginning of an enterprise. When you're in the nascent means in the new stages, right? When you're in a new stage of an entrepreneurial venture, you can't be like, okay, slow and steady wins the race. That is not the idea here. Here we are looking for some real kind of a gain. We're looking for some real activity to happen. So at the start of an entrepreneurial venture, in the early stages, that too of ideation and development, you are going to go for, um, in a stability strategy, it might not be there. But for well-established entities who have seen their life after reaching a particular time, stability makes a lot of sense. So stability is more meaningful when the size of the operations expand to full capacity and reach the maturity stage. So many startups who are willing for, inching for doing something great, they go for expansion growth strategies. And that is why we rarely see startups aiming for stability. So guys, please definitely take a moment of a pause, 1 second, and then go through this aspect very quickly about everything that is there with respect to stability from here. Then we will move to the second strategy called as the expansion strategy. Come on, stability strategy. Okay, I hope you've gone through it. If not, guys, you have the nice option to put on pause and go through anything. Now let's move on to the second strategy, which is called as expansion strategy. Now, here in the expansion strategy, as you see, it's a very important strategy in terms of an organization's ability to grow. So let us come back to that discussion quickly. Let me bring that, yeah, there. Growth or expansion strategy focus on redefining. What does it do? Focus on redefining and growing, redefining and growing a business. In stability, you're staying within the bounds, right? But here you are not doing that. Here you are going to outgrow basics, and you want to go leaps and bounds outside what you want to do. So that is exactly what the strategy we need here is. Growth or expansion strategy focuses on redefining and growing a business by broadening the scope and increasing the investments. This approach is associated with what? Energy, innovation, and success. Now, in the name only, it is there energy, innovation, success. When you are putting all this, obviously risk will be there, no? Because see, in the name only, it is their expansion. So when you are expanding, obviously for the sake of getting some benefits, risk also will come for free. There is nothing that you need to think about. So risk will be there. Now if you don't want any risk to come, or in this story, if you want the risk to take a back foot, you probably would not ever be able to grow. See, business always, right, can grow or expand only if there is a business in the larger, I mean, like there's a the ability to take risk in the larger picture. So key characteristics of what you call as a growth or expansion strategy, if you see, this is basically something to do with the opposite of stability strategy completely. There, whatever you saw here, we are going to see the opposite of that completely. Let's see this, come on. It involves the redefinition of business. In stability there was no redefinition of business, but in expansion there is redefinition of business. There they said no risk. Here there is huge risk. There, in stability, limited rewards are there, whereas in expansion, you have high rewards with high risk, high rewards with high risk. And companies aiming for significant growth, obviously, those companies which want to grow big with significant growth can achieve it only through this particular strategy, right? So, it is very important that you understand that expansion is a true growth strategy. Of course, it involves risks. There are no two thoughts about it, right? So expansion fuels a business renewal. When you are renewing the business and bringing something, obviously there will be need for fresh investments and entry into new markets, products, and all of that. Plus, it provides you with various growth options. Now, why did I write various growth options? Those numbers are, as you go down, here we call as A1, A2, A3, the heading numbers I wrote. A1 is intensification, A2 is diversification, A3 is innovation, P1 is about external, right? So there are broadly the entire growth opportunities are classified into two: internal growth and external growth. So internally we have A1, A2, A3. Externally, we have a mergers and acquisitions and strategic alliance. So I will anyway show you how that has come. But the two of the main approaches that we use here are intensification and diversification. So these two are market penetration, market development, and product development are called as intensification, while diversification is again in itself split into vertical, horizontal, concentric, and conglomerate. I will take you through all of that explanation. But meanwhile, here is a very important point. Why do businesses go for expansion strategy? Now, in the previous point, you did talk about why do businesses do stability. So those businesses that don't want to venture much, they don't want to, like take a different outlook and all that, they were basically being there wherever. But these ones who want to grow, right? Why businesses choose growth or expansion strategy is basically because there's an increased demand. When the market environment requires faster growth, when the market requires what sort of a growth? A faster growth. Leaders often prefer to steer growth. Now, if I'm just somebody wanting to do whatever I'm doing, I'll, like stay quiet, do that and follow. But not. I want more. I want to steer growth. Like as a leader for an organization, I will not be, appreciated if I announce a strategy like let us all stay wherever we are. As a leader, if I announce this is the ambitious strategy, this is where the company is going in the next 5 years, people will be like, wow, this guy has a vision. It's taking us somewhere. So that idea of a leader, satisfaction of leadership is only there in expansion. Continuing, of course, more stability is very important. Okay, we will do stability, but nothing can beat the real kick of the, what do you say, the growth strategy. Plus, if growth works, you will have a larger share in the market to control. So gaining more control over the market compared to the competitors. And there are some benefits from economies of scale, and also there are a lot of growth options: intensification, diversification, acquisition, mergers and acquisition. All those are some of the growth options that one can look into. So broadly, if you see, I will tell you, they say refer chart, we will check the chart right away. So internal and external growth opportunities are there, both of those. What are they further broken down into is the chart that is there here. We will see, I'm bringing it to you. So guys, expansion is the term, and before that is the opposite of stability. Strategy, fresh investments are made, risk is high. We already know that. Now, going further, expansion. Expansion is about internal growth and external. Two things is split, right? Internal A1, A2, A3. That is why I mark them as A1 is intensification, A2 is diversification, A3 is innovation, where option A or part A is internal growth. Now, part B of the expansion story is external, wherein we are talking about B1 and B2. Okay, these are the two here. Now, in intensification, we have market penetration, market development, and product development. In diversification, we have vertical, horizontal, concentric, and conglomerate. Then innovation and its three advantages are there here. I wrote them up, but we will discuss all three of those advantages as we go further. And if you look at external, we did talk about mergers and acquisitions, which are again in the nature of vertical, horizontal, co-generic. The same way, what is concentric there becomes co-generic here. And then we have something called as strategic alliance. Vertical diversification has been explained with an example. Forward backward integration, we will discuss all of that as we go deeper into the story. So I hope you have the picture of expansion with you right now, so that we can go into a detailed discussion. Can you take a better view of what we have in expansion, so that we can now move on to discussing each one of them very quickly, right? So as we start the discussion, let us bring the discussion of about the expansion through intensification. We are talking about Igor and Soft's product growth matrix. Here, if you see the name Igor H and Soft, Igor and Soft has given a framework which is shown in the figure below, which describes intensification options that are available to a firm, wherein we are talking about the product growth matrix. We will talk about two things here. What products are you talking about, and what markets are you talking about, right? So if your product is an existing product and you want to launch that product into an existing market, that means already people are there who are dealing with that product. So existing product being launched into an existing market is called market penetration. Existing product being launched into existing market is called as market penetration, right? So let's say, for example, I want to launch one toothpaste. Okay, so already 10 toothpastes are there. If you're launching one more, it's only going to penetrate into that market and go. So that is market penetration. Then when you talk about market development, I am already doing business in Bangalore, Hyderabad, Chennai. Okay, now I'm willing to launch in couple of other cities. That is market penetration. That is physical, geographically I'm expanding my business. No, sir, what about launching an e-commerce? You can sell your product there also. That is also considered as market development. You are widening your market presence, right? Existing product, if you launch it into a new market, existing product being launched into a new market is called as market development. Product is very much existing. Okay, all that you're trying to do is to reach out through new distribution channels, or change the content of advertising to attract the new set of people, or maybe you are using different promotional strategies to tackle and attract new people. All that will come under market development. If you do some R&D, if you do some kind of an R&D and come up with a new product, okay, and that new product you're selling to your existing customers or existing market, it is called as product development. To be very keeping it very simple, one of these three are existing. In the first one, existing product, second one, existing product, here existing market, right? So at least one of them is existing, and because of which you are intensifying or the other. Understood? One is there, only you are intensifying on the other. That is why these three put together are called as intensification strategies. What are intensification? Intensify is to improve or increase the intensity. How are you increasing the intensity? Already one is existing. You do some, because if something is new, we will focus on developing that. So did you see in the second one and third one? What was new in the second one? Market was new. So we called it market development. Third one, product is not new. So we called it product development. If you want to, of course, I did explain you the concept, but if you still want to remain somebody who understands it vaguely, whichever is new, develop that. But the first one, both are not new. Then that is why you are penetrating and going into a market space where already somebody is having a strong hold, right? So guys, that is exactly what are the three strategies that one has to understand to like three sub strategies under the heading intensification. Now, moving on to the second one, if you want to take a little more leeway and look into it, you can look at all four boxes of what is market penetration, market development, product development, and all of that. Now, diversification, of course, is also part of the ego of framework, but we will talk about it uh, later as we get down. Now, second one, expansion through diversification. Diversification is a very, very interesting growth strategy. In fact, it is one of the true growth strategies. It is considered to be what? The true growth strategy. Really, if you want to grow as a business, intensification is only going to improve the existing. But when you talk about the true growth strategy, it is there in diversification. So what are you doing in diversification? In diversification, we are just trying to enter new markets with new products. Diversification is often chosen because it offers better prospects for both growth and profitability, and that is the reason why we are looking at it. Now, in simple terms, what is diversification? A very easy definition. As I just told you, two news. If both are existing, it is penetration, and one whichever is new, we are developing that. Market development, product development for whichever is developed. What if both are new? Diversification involves entering into areas that require totally different skills, technology, or knowledge than the what firm currently possesses. For example, new product or service into a completely that is unrelated to the current offering. This unrelated to current offering is called a conglomerate diversification. That means between your existing product and the new product, there is absolutely no relation. There is what? Absolutely no relation. So this type of diversification, where both the product and market are unrelated to a firm, it is called as conglomerate diversification, which is what I just told you. Can you take a look at it? All people, Adani, Reliance, Tata, Birla, Godrej, all these guys, they're all conglomerately diversified entities, right? Now, just going back to the question as to why do the firms really want to choose diversification? Obviously, it's a more exciting strategy, right? Why do you want to keep the funds the same way when you can spend or put that more and make much more of it? So why don't you diversify into new areas of business and do something really remarkable, right? Firms may have excess capacity in manufacturing, they may have excess funds, marketing, or other areas which can be utilized more efficiently. So diversification allows the firm to make better use of its existing facilities. So better use of existing resources. That is the main reason why we go for diversification. And another reason why we diversify is because of this word called synergy or synergistic advantage. Synergy means synchronized energy. Each individual will have an energy, right? But when two entities come together, if X Limited is doing 100 crore business and Y Limited is doing another 100 crore business, when XY Limited come together, they won't make 200 crore business. If that is the case, then what is the point in coming together, right? So XY Limited makes 230 crores of business. That extra 30 crores is called synergical gain. Sir, but 1 crore, 100 crore plus 100 crore should be 200 only. No, why greater than? That greater than portion is only called the synergy. Idea of synergy is 1 plus 1 is greater than 2. By adding new or related products to the existing products in the firm, you can improve. Like say, for example, a car company is there. They're adding tires to their portfolio, right? Further, when they're making tires, they can use those tires for their own cars. And not only that, linkages in technology or markets. Product A's technology and product B's technology. The underlying technology can remain the same between old and new products, which will again create additional benefits. So these are the big reasons why we do diversification. Now, as I discussed with you, two types of diversification is there. If the existing product is related to the new product, if the existing product is related to the new product, then it is called as concentric diversification, because they are related in nature, and they are what? They are related in nature, and then they will end up helping you get synergistic gains. What do you get? You get synergistic gains. Then same way, conglomerate diversification. What about that? Expansion is into unrelated business areas. Unrelated, which is completely giving you new opportunities. Now, as much as this sounds exciting, it can also be a big risk. But conglomerately diversified entities, they diversify for the sake of diversifying the risk. In times of COVID, all of you know, all these conglomerate entities, they were highly successful. Why? Because they have 10, 15, 20 items in their portfolio. And suddenly, if an entity is down, another entity came up to, like another entity of the same group came up to cope up. For example, uh, you know, Tata, Tata Steel got stuck because there was no real estate movement. Tata Motors, where lockdowns are going on, how will you sell vehicles? So Tata Steel and Tata Motors being highly affected by pandemic. Same way, Tata Consumer Products, huge inflow of food items. Tata Consultancy Services, new softwares are being built. Their businesses grew. So as a whole, Tata Group didn't suffer. So like that, when big groups diversify, they diversify into unrelated businesses, which is ideally called as conglomerate diversification, so that on a bad day, everything will come handy for you to, everything will come handy to help you at the right set of time. Understood? That is what the story is, guys. Now, so vertical, horizontal, concentric, conglomerate. I'm going to explain all these four to you. First one, let's talk about concentric. If your new product, whatever you are coming up, is related to your existing product through three words: PTM, not PTM, PTM. What is that? Process, technology, or marketing. It involves expanding into, so concentric diversification. If somebody says we are doing concentric diversification, it means you are entering into related businesses, but not 100% directly related. Sir, then how are they related? Through this one: process, technology, or marketing. That is the link between. So the new product is also made out of the same process. The new product and the previous product have the same technology, or the new product and the existing product can be can be marketed to the same set of people. So process, technology, or marketing, like say for example, a clothing manufacturer is also entering into what you call as shoes. Now places like Zudio, they earlier started with clothes. Now they have shoes, because somebody going to buy those apparels, they will anyway go and buy the shoes as well. So like that, you are expanding your business. Some stationary person who's only selling books and papers is now selling pens and pencils also. So like that, they're very much related goods, and they are related through process, technology, and marketing. You can call them as concentric diversification. And you already know the meaning for the other one: conglomerate diversification, completely unrelated. Now let's talk about vertical, horizontal. Now everybody understood concentric, conglomerate? Good. Now listen carefully. Vertical integration. I want you to understand this example that is there here. You can easily make the text. Name of the entity is X Limited. Sugar business is what they are doing. Now, before I discuss anything, everybody should understand that there is a product or process chain. Starts with raw material, followed by manufacturing, followed by distribution, and then by retail. Okay, so that is the product or process chain. Now, listen very carefully. If you are moving up, if you are moving up or down, if you are moving up or down in the same product or process chain, if you are moving up or down in the same product or process chain, but not jumping anywhere else, then that is called a vertical integration. Say, for example, X Limited is that kind of a business just producing sugar. Now, X Limited went one step back into sugar cane, because now X Limited is buying sugar cane from somebody and then crushing the sugar cane and making sugar. Limited thought, why buy from somebody else? Why not buy the land and we only cultivate? So Limited started doing the business of raw material as well. So if Limited was earlier doing only manufacturing and now they diversify into raw material also, then that is about going one step back. That is called as backward integration. Vertical only, this movement only, but backward. Same way, X Limited was earlier doing manufacturing. Right now, X Limited went to doing even distribution also. They were not distributing earlier, but now they are distributing also. So this move coming one step ahead is called as forward integration. So if you move one step, raw material to manufacturing, manufacturing to distribution, distribution to retail, like that, if you come one step forward in the same vertical line, it is called forward integration. If you are a retailer, you went back to distributing, then you went back to manufacturing, then you went back to buying raw material, then you are called as backward integration. So the forward or backward integration. Okay. So forward or backward integration, that totally depends on the choice of the business. What is that they want to do and how is that they want to do is something that we need to clearly understand. But one thing is very clear. The firm is vertically moving. You are not going one step off the story, right? When you move up or down the same product or process chain, that is what is called as a vertical integration. Now, but when you jump at the same level, expanding by acquiring similar businesses, that is by entering into byproducts or complementary products, either you're going for byproducts or complementary products and anything like that, then that is called as horizontal integration. Similar businesses taking over competitors businesses and all of that, same stage. Example, a textile mill is acquiring another textile mill, a textile mill is acquiring another textile mill or any other related businesses. That is what is called as horizontal integration. So vertical, horizontal, concentric and conglomerate, all these are the four types of diversification. I put that example here also. By entering business of byproducts or taking over competitors products, including complementary products, they're all coming under horizontal. The same vertical, horizontal, concentric, conglomerate logic which is there for diversification is the same logic that is there for mergers and acquisitions also. Mergers and acquisition also. Sir, but merger acquisition and then what is the difference? Yeah, in mergers and acquisitions, there are minimum of two entities. Now, if you see my example, there's only one X Limited in that. So, if one entity does this exercise of moving forward or backward, it is called as diversification. But when two or more entities are participating, the same story will become merger and acquisition. Now, what is the difference between merger and acquisition? When two or more entities come together and form an all new third entity, then it is called as merger. When one financially stronger entity buys a weaker entity or acquires a weaker entity and only one entity remains, then it is called as acquisition. Like for example, Vodafone and Idea, they came together and formed a VI. That is a merger, right? Now, when one entity like HDFC Bank takes off HDFC Bank, HDFC, right? HDFC Bank and HDFC are two different wings earlier. Now, again, they got merged and they operate under a common name of HDFC Bank Limited. So, like that, sometimes best examples of these are they are the horizontal mergers, right? Two competitors are merging together. No, they are all horizontal mergers. So, guys, if you really see in the practical sense, vertical diversification and conglomerate diversification are very common, while horizontal and co-generic mergers are very common. Okay, in the practical sense, in the books everything are there definition wise. In practical sense, vertical and conglomerate diversifications will happen and horizontal and co-generic mergers and acquisitions can generally happen. Now, this is the stark understanding on these side. Now, there are two things that we didn't discuss, A3 and B2. A3 is about innovation. Okay, let's have a quick look at what is innovation. Innovation means, working on improving the existing process by either finding something new or by improving the existing process. What does it do? It helps you solve complex problems, increases the productivity, and helps you gain a competitive advantage, right? Let me see if I can bring in innovation for you here. Yes, key benefits of innovation. First of all, innovation is all about upgrading the existing product resulting in increased market or increased customer satisfaction, right? Sometimes people tell that innovation and all is not required. It is incurring unnecessary additional cost and all that, but that's not true. Without innovating, your business will get stagnant. So if not now, at any given point of time, you have to go for innovation. So better at the earliest, if you realize and do some innovation, that can bring you some benefit. So thereby, it helps you solve some complex problems. One, that is the first advantage of doing innovation, identifying opportunities which are customer centric. And second one, increases productivity. Same task, you can do it much faster. Final output or the task or process, when you measure it, it's called efficiency. And if you can do the same task much faster. So how can we do the same task much faster? By removing all the unwanted or repetitive aspects, right? Redundancies, they are called as. Remove all of them. And most importantly, if you have if you have an edge or advantage over somebody, right? Because you have a product which is more better than theirs, that is thanks to innovation again. So reason number 3 why you should go for innovation is that it provides a competitive advantage. Staying ahead of competitors is a strategic priority, right? It is a strategic priority. That means today, if you don't do that, you will be lagging behind in the market. Faster innovation creates a chance for that, right? Because if you don't innovate, your competitors will innovate. So therefore, innovative products require less marketing, added satisfaction for both existing and new customers. And plus, the customers will stay with you, will be increasing or enhancing the customer retention and acquisition through innovation, right? So the 3 point, this came in the exams, can always come. What is innovation and what are the key benefits? So kindly go through that small piece of what is innovation, which will then bring us to discussing external growth opportunities, which I just discussed with you about what are mergers and acquisitions. The only difference is there, I can clearly show you here, and it's already written. X Limited, Y Limited will now become XY Limited. Vodafone Idea was the best example, right? And one financially stronger entity called the X Limited acquires a financially weaker one called as Y Limited. It is called as acquisition. So those are the two terms about merger and acquisition. Mergers also are vertical, horizontal, co-generic. Only the terminology change. Concentric has now become co-generic, and then completely unrelated merger, which is very rare to happen. Why will two entities which have no connection come together? Are very rare. That's why one more time I'm reminding you, concentric and horizontal mergers are very common, and vertical and conglomerate diversifications are more common. So type of mergers: horizontal, vertical, concentric or co-generic merger it is called, and conglomerate. Same PTM is a logic here also, right? So I don't think you'll find anything new. So if you read this side of the story, you can automatically make the other one of that. Okay. So that's all, guys. That is what we have in the topic of mergers. And the last topic in this lot is called as uh, strategic alliances. But before we go there, I just want you to see about 4 or 5 benefits are there. If you merge, instant access to new technologies, new markets and resources. It increases your enhanced operational and managerial efficiency by combining all the resources. Greater economies of scale, no doubt. And because again, you're producing at such high scale, and earlier you used to be two split entities, but now because you're a common entity, your per unit cost will also decline to a great extent. And then we're talking about market control, because all of the bigger people have come together. Then we talk about is reduced competition and greater control over supply and distribution chains. It gives you access to new technologies, customer base, or geographic regions, or what? Geographic regions. So these are the definite strategic benefits. There are no two thoughts about it. And as I want to wind up this one, I think we are exactly about 45 minutes into this particular unit or a session. Anyway, you don't bother about time or minutes. Our last few minutes on expansion, and then we have to talk quickly about retrenchment strategies also, right? Meanwhile, if you want to take a moment of pause, you can do that. Now let me continue the last piece, and then you can, I think you can take a pause there. Strategic alliance. What is strategic alliance? A, B, C, three people are there. This is just an example of the assembly seats. 250 assembly seats are there in a particular state. 126 are needed for majority to form government. Now, political party A 100 seats, B 180 seats, and C 170 seats. So nobody has won the majority. Therefore, no independent entity can form a government over there. So what you need to form is a coalition government, which uses the principle of strategic alliance. What is the definition? Which is a relationship between two or more entities that have common strategic objectives would not be possible independently. So A also can't achieve independently. B also can't achieve. C also can't achieve. The only way they can achieve this is by coming together. Say, for example, if you see this example, neither of the political parties can form a government, but possible combinations are A and B can come together. They'll have 180 seats. They can form. B and C can come together as they have 150 seats, and A and C can come together to have about 170 seats. But let's say B and C are arch political rivals that they will not come together. Then there are only two possible options. Either A should join hands with B or A should join hands with C. Whoever it joins, they will continue to win they continue to form the government and have a coalition government. Right? So this is a very simple aspect. 4 advantages are there, couple of disadvantages are there. Let's check advantages. 4 advantages. 1. Organization advantages, as you can learn new skills from your strategic alliance partner. Productivity will get enhanced, and more importantly, if you have well-known partners, if you have a well-known partner, their name gets associated with you, then people will start trusting you also. Array, if you are partners with them, that means I can believe you. This, you can gain legitimacy by associating with well-known partners. Plus 1 plus 1, when two people are doing work, obviously cost will come down, risk also will come down. Economic benefits are reduces the cost and risk, achieve economies of scale, and co-specialization. You are not special alone, you are having them also. So co-specialization of you both working together will also ease out the situation. Then talking about some of the strategic advantages, cooperation among rivals. Cooperation among rivals reduces the competition, and vertical integration strengthens the supply chain. Competitive advantage is achieved, and the last point talks about political advantages. What are some political advantages? Like, I want to start a business in another country, but they are not giving me the road to do that. So if I join an alliance with somebody, facilitates entry into foreign markets through local partnerships, and also builds political influence, you can join hands. 4 of these benefits are there: organizational, economic, strategic, and political. This has been a multiple time asked exam question. Also, to wrap up, couple of disadvantages will always be there, no matter how great of an entity this is. Sharing profits or all your resources and revealing trade secrets to your alliance partners can turn out to be a problem. So resource sharing is a problem. Knowledge risks. If you're sharing knowledge with them, sharing trade secrets, tomorrow if those people exit the alliance and go out, they will become your biggest competitor, which is a big danger. So sharing trade secrets can expose critical business information. And lastly, alliances. You are by yourself creating your own future partner. Alliances may create future competitors if one of them becomes independent. As long as one of them doesn't become independent, it's okay. But if one of them becomes independent, then you have put all the knowledge to them, and you created your own competitor, which could turn out to become complicated. Okay, so these are all the expansion strategies. I would definitely want you guys to take a moment of pause. This sheet which is there in your revision summary, I want you to come to this and please run through everything by putting me on pause. I will discuss the retrenchment strategy of turnaround, divestment. Two are there. Liquidation is also a retrenchment strategy but not discussed in our syllabus. So I will discuss with you turnaround and divestment to wind up this part of strategic choices, and then you can take a slightly longer break and then come back to listening the strategic portfolio tools, BCG and SOF. Already answer we have discussed anyway. That piece is going to be a small piece of revision which we can easily understand, but provided I want you to revise the entire expansion strategy. Stability also I'm fine, but take a minute purely to revise the entire expansion strategy. And this chart is exactly what I want you to revise one more time so that we can end this discussion by going through retrenchment strategies. Come on. Done, guys. If not, please take your time and go through that. It's not an issue, right? Let me continue here with respect to the last one called as the um, retrenchment strategy. Now, this one is a very simple thing. 5 stages of turnaround is a very frequently asked question in the exam. So let me take you through to the last piece of what is called as strategic exits. So no matter how important it is for a businessman to stay in business and continue doing business, sometimes it is also important for business people to find the right time to exit. Find the right time to exit. So strategic exit, when do you think a strategic exit has to happen? Strategic exit occur when an organization significantly reduces the scope of its activity. Okay. And then three types of retrenchment strategies are there. As you can see, turnaround strategy, which we are going to uh, adopt when the in the product life cycle. You remember introduction, growth, maturity, decline. In the early stage of decline, if you want to slowly when it's starting to fall down, the reversing of the decline when it is coming down and suddenly want to, okay, we can't obviously suddenly switch it and take it up, but is there anything that we can do to really work around that? Of course there is. The answer is a yes, and therefore we will adopt what is called as a turnaround strategy. Turnaround strategy focuses on reversing the process of decline to improve internal efficiency. I hope you did a chapter called internal reconstruction in accounts. So that is exactly what it is, improving your internal efficiency so that you can try and restore profitability, which is the main objective. You are not a profitable entity anymore, so you want to restore profitability and stabilize the organization. Okay. Divestment strategy is to sell or liquidate any portion of a business. If you're selling or liquidating any portion of a business, then it is called as divestment. You're not selling the entire thing, right? You're only selling the portion of a business. It's called divestment or divestiture, right? Then why are you doing that? So that you can curtail. Curtail means cutting down the product. Unprofitable products, whatever are there, will cut them down. Cutting off loss making units. Loss making unit, division, SBU, anything. If you're cutting it off, it is called a divestment. No, sir, we want to close the entire business and go abandoning all activities, which is considered as the most extreme step. That is called as liquidation. Understood? Generally, we don't want to do liquidation because it involves selling assets, closing out everything. A lot of people will lose jobs, settle all your debts, pay off everything, minimize the losses, and kind of go home. But like I said, that is not something any businessman would wish to do, because after putting so much heart and soul and effort in doing a business, you just don't want to at one point of time say, I will, like close my business. Voluntary liquidation, of course, is possible, but other than that, environmentally forced liquidations are not such a pleasant experience. Now, of this story, if you look at what is the first one, it is called a turnaround strategy. One of the most important points, as I can show you there in the picture, I've drawn the product life cycle one more time. This is the part where we're talking about decline. It is coming down. But if you want to reverse the decline, if you want to reverse the decline and take it up here again, as a matter of fact, if you're going up like that, that process is called turnaround. Two very important exam questions, as you can see. The first one, what is the need for turnaround? This itself is a question in the exam. Continuously you're getting negative cash flows. Uncompetitive products. Your products have become uncompetitive. Market share is constantly declining, a declining market share. Deterioration in physical facilities. Facilities have come down drastically. Overstaffing, high manpower or low morale, and mismanagement. You can see these six are solid reasons as to, they are also called as danger signals. Sometimes that is a word used in the question to say what are the danger signals that are indicative of a turnaround. Yes, sir, we decided to go for a turnaround. One of the most asked questions of this chapter is, what are the action plan for turnaround? Guys, I don't want to discuss the entire detail, but you know that I would want to discuss at least what is the stage. In the first stage, we're talking about stage one, assessment of current problems. Right now, what are the root cause? You can have a view on what are underlined there. Identify the root cause of the problem, analyze the situation and develop a strategic plan. That is, in other words, redo the SWOT analysis. Long back you did know, redo it one more time right now to see what your strength and weakness are. So assess the current problems, analyze the situation and develop a strategic plan. After that, stop the bleeding. Stop the bleeding means initiate an emergency action plan. Stage 3, implement right now. I will bring back see, if somebody is met with an accident, what will you do? You will not try to stabilize everything. First you have to get them to breathe. That is why they'll take to emergency, trauma care, ICU, whatever you call it. There, the first goal of the doctor is to make the patient breathe properly. Now we will do the surgery, we will do everything what is needed to bring that person, but first he has to breathe. So like that, here to control the bleeding, what they do first aid, like that, implement an emergency action plan, right? Do some stabilization aspects, go to bankers, talk about restructuring debts, unprofitable divisions, whatever are there, cut off those. Prune means to cut off. And if any high potential products are there, accelerate them, grow them, and make sure that entity breathes. Emergency action plan, followed by doing something to restructure the business. Now 4 and 5 are crucial steps to bring back life into the business. Restructuring the business is about repositioning the core products, prepare a cash flow forecast and analyze whether this will really work. Change what product mix changes we can make, what goes into making the product. Now change the product mix and withdraw from non-core products that are not adding, and then tell the employees to work harder. How will you motivate employees to work harder? By providing them with appropriate reward systems. And finally, when all this work, come back to normal, returning to normal, right? Make the new way of business the regular flow and focus on profitability and sustainable growth and come back to normal. 5 stages. Identify what is going wrong, that is assessment of current problems, analyze the situation and develop a plan, implement an emergency action plan, restructuring the business and returning to normal, right? These are the activities that are done in the stage of turnaround. In the previous discussion, I haven't really mentioned about these 5, but in this discussion I made it a point so that we discuss all this in greater detail, right? And one more time, I want you to, I've all these points have been summarized in detail. I would want you to just come down here and take a look. It is all there in the summary also. Retrenchment, turnaround, divestment, liquidation. Now divestment, coming to that part, we're talking about selling a portion of business. Alongside that, there's one important question as to, recently also they asked, what are the reasons for adopting this strategy? So let me take you back there onto the closure point where we are talking about divestment strategy and the reasons to do it. Divestment is done in 2 conditions. One, you attempted a turnaround and failed. You tried to do a turnaround but failed, right? Turnaround has failed. And 2, sometimes it is very clear, sir, we don't want to do turnaround and all. It's a classic waste of time. Let's straight away go for divestment. And what is divestment? Refers to a sale or liquidation. Can you see that? Refers to sale or liquidation of a portion of business or a major division or SBU. Why are you doing it? 5 reasons. 1, you bought a business, acquired business proves to be a mismatch. Acquired business cannot be integrated, proves to be a mismatch. 2, continuously you are getting negative cash flow, persistent negative cash flows. Severity of competition is there, intense competition, but you have inability to cope with it, severe competition. Change in technology is there, but you are unable to or unwilling to invest in that. And lastly, with this money, if you sell this business, you can put this money elsewhere and it's a more profitable opportunity. It is called as opportunity, the next best alternative. So better alternative investment. So if your acquired business proves to be a mismatch, if there's negative cash flows, if there's severity of competition and you are unable to cope with it, technological changes have acquired, but you are unable to meet them, or where better alternatives are available. All these are reasons, 5 solid reasons why you would go for a divestment strategy. Alongside that, 2 more additional reasons are there why you do normally. Continuous losses if you are going on getting, or improving the viability. If divesting this can help other businesses survive, then also you can divest. And other 5 reasons are exactly the same as to what you saw earlier, right? So now, very important question that we have to discuss is turnaround only relevant for loss making business? Nothing like that. A turnaround strategy is relevant when a company is experiencing a period of poor performance. And poor performance does not always mean losses. Put a start at this point. Normally, small points like this are generally not covered in marathon. But if you see this marathon, we have covered almost every small point. And at the end of this marathon, when you say stage 5, now we are going to mark stage 3 as done. After this is done, bro, when you're done with stage 5, I would want you to exactly leave me with a comment saying how this elaborate marathon, because generally people are like so overwhelmed with the content that they, when they finish, they feel happy. So I understand that. So even if you don't leave a comment, but if it has helped, it is good. But if you can, do make a specific point about how was your experience in watching this marathon. Okay, so on that note, that brings us to the end of the discussion of all the corporate level strategies. Business level strategies are already done in the previous chapter, and the functional level strategies are not there in your syllabus, so you can relax about it, right? So just for you to see where we stand, this is where we stand, and we have revised all of this, including retrenchment. Now, the next piece that I want to discuss with you guys is, I'm coming back to again the stage 3 slide, right? Stage 3 slide, we have the other part of discussion called strategic options, talking about the 4 portfolio tools of Boston Consulting Group Matrix, and Soft ADL, and General Electric Matrix. So that is the other piece of discussion that is pending for this chapter. Probably another half an hour discussion on that, or somewhere around half an hour, 40 minutes. Or again, like I said, if we can like stay focused on what we're doing, we can even wrap it much quicker, and discuss also the main content of ADL matrix, which I believe many people, I think I already told you. One more time I'm reminding. So we will do that. At this point, if you really want to take a small break and continue, that also works with me, because I mean, I will go for it, but it again depends on how you are placed. So take a small break, come back with a fresh mind on strategic options. We will discuss all the 4 portfolio tools which you see here in clearer detail. All right, guys, let us move on to the next aspect, which is called as the strategic options, wherein we are going to now talk about the 4 portfolio models, which are one of the most important aspects of strategic management. Okay, as I told you in the previous part, there hasn't been a question paper without some sort of question. Now, I won't guarantee that definitely a 5 marks question only is going to come, but having said that, definitely a question can come from any of this BCG, GE matrix, and soft and ADL. So considering your comfort and understanding, let me do these topics in this segment. But before I do those topics, what is the need for a portfolio analysis, and what are these strategic options? Let us just dive into the understanding of that as to what are the strategic options. I will just show you the text here. You can see strategic options are derived from the existing products and industry innovations. So basically, it is about, very relevant, the star point that you can see there is, this entire concept of having so many options are relevant only to multi-product and multi-businesses. I think there is a logic in itself which clearly says that if you have only one business, why do you have to think so much? You can put all your money in that business only, no? Right? So you don't have many options. Then it is like our mom telling, what did you make for dinner today? Choose from one of these. She gives one option and says choose from that. So there's like nothing. She's made that, and you have to just go by eating it, right? So that is exactly how some choices work. Mm. But in business, strategic choices are not like that. Strategic choices, they give you many options. So why don't you put more money into product A? Why don't you put less money on product C? So now that depends on what exactly these products are and how are they contributing. Okay, less diversified firms with a main business, they can generally, like this point, less diversified means you don't have too many businesses to handle. You have only few. So less diversified businesses with a main business, and others are, ancillary or complementary interests. They can also use these strategies, but for them, they always invest more on their main product. But if you're using portfolio analysis, what is the main advantage? I've already made this point in the summary, right? The main advantage of this, the management must analyze the business portfolio and decide where to invest. That is the key factor. Where to invest, more, less, or not at all. So, in other words, I've written this only as which business should receive more investment, less investment, or no investment. So this particular point is applicable to multi-product businesses where a decision is being made about which business should receive high, low, or no investment. High investment, low investment, or no investment at all. So this is what we are going to decide. And to decide this, there are four theories on BCG and SOF. Now, the ANSOF product growth matrix has already been discussed with you in the likes of. Sir, when did you discuss? No, obviously, when I discussed market penetration, product development, market development, and diversification. When I discuss this, they are the same four words Igor and SOF put in a framework. So, by default, that has been covered, but we will take one more look at it. Then we will do BCG and G together, because the drawbacks that are there in the BCG matrix have then been addressed in the GE model. So let us keep this a very, like I said, a short session, piece of that, because all four are very important. And let's start with hands off in the first place, right? So normally, if you look at the class notes, I would generally mark this as a homework, right? Let me show you that. See there, and soft is a homework. Why? Because we would obviously have discussed this. So one more time, I would want to just discuss overview. You can run through it anytime. So coming to ants off, you are taking a 2 by 2 4 box matrix where you take markets on the vertical axis. Markets are always there on the vertical axis, and what we are taking on the horizontal axis are the products. Let me quickly highlight them: markets and products. Now you know that products are again classified into existing products and new products, while markets are also categorized as existing markets and new markets, right? Now, if you are introducing an existing product into an existing market, it's a very tough choice. It is part of those three that I've highlighted in the shaded place. They are called intensification. Only the other one is called diversification, and we already know that diversification is quite risky, right? So market penetration, product development, and market development, one thing that is common is something is existing. In first one, both are existing. In second one, market is existing and product is new. In the third one, you are entering a new market with an existing product. Point being, something is existing and you are intensifying the other. So those are the three intensification strategies. Introducing an existing product into an existing market is called market penetration. That is in the closed group market you are trying to enter. This is a toothpaste example, which is about Colgate, Pepsodent, Close Up, and XYZ, where you are entering now, and that means you're capturing this market. You are winning customers from others. You cannot just like that barge in, and just because you entered with a new toothpaste, some new people will start brushing from tomorrow is not the scene there, right? So you have to win customers. Somebody should give up Colgate, somebody should give up Pepsodent, somebody should give up something else. They have to give up those, and then somebody has to come in to pitch in the space there, and you capture what was left out by somebody. That is the idea there. So that is the story of the first one, which is called ants of product growth matrix. And diversification is new to new, very risky in terms of a strategy, because you are entering into territories that you are not very well versed with. So that risk is always there on you doing that. So it is titled as a risky strategy. Okay. So that is the very first one, guys. And SOF's product growth matrix. Let us spend just an additional minute here on trying to understand the text also, so that it'll be as good as guiding you through the this one also. So market penetration, existing to existing, increasing sales to the current customers can also be considered as the strategy of market penetration, whereby you're not trying to do anything new, just to increase the sales to the current customers itself by increasing advertising, maybe personal selling or campaigns, or trying to go for an aggressive pricing strategy to outcompete your rivals. We can as well do that also. If you go by the example as to what they are, you can say Gucci, which is one of the luxurious brands. Gucci selling luxury clothing in European markets. They're already selling, and they're selling new designs now. So which means they're existing to existing, which will be a classic example of market penetration. Market development involves existing products into new markets, where same Gucci is expanding from European markets into Chinese markets. You're going to either new geographical areas or new market segments. And product development focus on new products into existing markets, while the same Gucci, if they're selling casual clothing, right? A casual clothing, generally this is luxury clothing, right? Now they're going for casual clothing. So a new product with the existing market, which is called product development. Now, diversification is about introducing new products into new markets. Of the four, this is the most risky. This strategy is risky because it involves venturing into unknown markets. Gucci selling casual clothes in Chinese markets. Casual clothes is new, Chinese markets are new. So new to new, casual clothes in Chinese market. Very hard to find acceptance. If at all you find acceptance, then definitely you will be a winner there. But again, like I said, because it is a new market and it's a new product, we don't know how customers will accept that. Will there be a rapid product acceptance, or will there not be a rapid product acceptance? All that will be the a challenge to understand at that point of time. Okay, so that is the very first strategy, guys, which is talking about uh, Igor and soft product growth matrix. Now, this is wonderful matrix. In my personal opinion, there is no better matrix than the ADL matrix, because it sums up everything great. Now, there might have been challenges for you in the past to understand this. If you have been a student of mine, I don't think you should have that problem anymore, because we discuss ADL matrix in such a way that you have a clear understanding. For all those people listening to this concept for the first time, I will explain this in detail, but I would want you to definitely leave a comment if you, for the first time, are understanding ADL matrix after this. And I would really be glad to see, uh, you know, these kind of comments which bring in the understanding for first time from a marathon kind of a space. So please be honest enough to leave a comment if you've really watched this entire marathon till here, concept by concept, and you're watching this also, and this is the first time you're understanding this. Please do ensure, right, that if you already know it and revision was good, it's always a pleasure to get that. But for somebody for the first time who've never tried to understand the ADL matrix in the past, if you are trying to understand it now, please ensure, because again, like I said, this is not for any other reason but for you to repose confidence to the others, saying that, look, this has been very helpful for me, so you guys also can go ahead and watch it. Now, I'd want you to understand what sense is there in the ADL matrix. Arthur D. Little, the person behind this matrix, ADL, the short form Arthur D. Little, he has very beautifully compiled this matrix by taking two aspects. One is the kind of company, which is nothing but the competitive position. Let me bring this piece here. Yeah. So the competitive position is being taken here. Okay. Which means companies generally enjoy only five competitive positions. Either you are a very dominant company in the market, or you're a very weak company in the market. So between dominant to weak, what are the various types of companies that are there? You can see the first one is dominant in that block. Second one is slightly lesser than dominant, but enough to battle, that is a strong company. Then comes the third one, a favorable company, which is making, I guess, a decent P&L, you can say. They're making decent profits, decent P&L, so favorable. Then manageable kind of break-even companies. Okay, I'm kind of not very weak or dead, but okay, manageable. These are called tenable companies or tenable. And then we have companies which are lacking resources, which are categorized as weak companies. So what did ADL do here in the first place is he categorized companies into five. Okay, see there, 1, 2, 3, 4, 5 number ranging from dominant to weak. Dominant, strong, favorable, tenable, weak. Now, don't bother about the other piece of writings. I will come to each of those. So you now know the understanding of each of these companies. Somebody having a strong presence in the market, would they being able to establish or dictate terms as a dominant company. If the financial resources are strong, HR resources are strong, your aspects are going well, then it's a strong company. Favorable is P&L positive, tenable is break even, weak companies lack resources. So you know the meaning of all these five. Now, I don't have to explain the other one because I've already explained you the other side of the story on the four stages in the product life cycle: embryonic, growth, maturity, and decline. So, which means introduction, growth, maturity, and decline. He has, the stage of industry, same four stages. He has used different words to depict them, but embryonic is the introduction stage, growth and maturity continue to have the same name, and aging means, the decline part is renamed as aging. Now, here comes the interesting aspect. How do these five companies behave across four stages? That is what is the 5 by 4 combination. How do these five companies behave in these four stages? This is the uh, text for us to understand. So five competitive positions, four stages of industry maturity, a mix and match of that is what a 20 box ADL matrix is all about. Now, is there a need for you to buy hard 20 boxes? No. Let's see how this works. Take one company Take one company, any one of those entities, and see how they will navigate through four stages. For example, let's take a dominant company. How will a dominant company go across four stages? Let us see that. It's a dominant company in the name. Why will they go slow? They'll obviously act aggressively, attack, huh? and they will do everything that they can in their capacity to hold the greater part of the market. Is that true or not? They are not somebody who's going to fold their hands and sit and say, okay, let us observe what is happening. These are guys who are going to show the dramatic amount of power, right? They are dominant companies. Now, coming to what dominant companies will do when a product is being introduced. Obviously, see again here, if they ask you this in the exam, and if you have to really draw the matrix and write it, even if you write one keyword, one or two, depending on how much you can remember, one or two keywords in each box, you should be able to get your marks. Okay, so that is why I'm picking up a very easy method to understand that. Choose words that are quite common across these. I'll tell you how. So dominant companies, what do they do across their first three stages? They act offensively. Because they're dominant enough to do that, they'll act offensively in introduction stage, in growth stage, and also in maturity stage. And when it comes to aging, because it's a dominant company, it doesn't want to let go down. It will try to defend its position in the first place. But see, you may be a dominant company, but you should not behave like a foolish company. Correct? There is a difference between being dominant and being foolish. I don't want to be foolish. I want to be dominant. So at some point of time when my resources are getting exhausted, I would like to consider a withdrawal. I'm not saying withdraw tomorrow morning and go home. I'm saying please consider a withdrawal. So even if you're a dominant company, but your product is coming down in the life cycle and it's aging, you consider a withdrawal. No, sir, this product can be of help and it can support the other products. Then you can as well always go for the better part of the story, right? You can still hold on, and someday you really want to go for the withdrawal. Same story. If a strong company is doing it, they are strong because there is something unique in them. That is why when a strong company is introducing a product, they tend to differentiate first. And they continue to differentiate in the growth stage, because only when they are differentiating, they will be holding themselves as a strong company. Attack small firms. That's a good strategy for a strong company to do, that you remain strong by attacking smaller companies, right? So either you differentiate, then you differentiate and continue to differentiate even in maturity stage. But again, in maturity stage, they give you a good option as to grow with the industry. Don't try to do something so much that you try to beat the industry and all that. That's not necessary, no. So keep it cool and grow with the industry. And when your product is reaching an aging stage, find a niche. What do you mean by find a niche? Those people who have come with you from the beginning, liking your differentiation, no, they will be there with you. So this differentiation by the end of the life cycle will become focused differentiation, and you find a niche and stick to them and continue to hold the niche as long as things are going good. Most are things are slightly outside my block, cholo, you can slowly take back your money, and slowly taking back your money is called as harvest. So this is how dominant companies and strong companies navigate across the four stages. Now you take any company, let it be a favorable company, tenable company. See, tenable company, grow with industry because you're tenable. You can't do anything right from day one. Just go with the flow. Go with the flow. Try to turn around. Your product has reached maturity. It's almost the beginning of decline. Try a turnaround because you're not a dominant company to hold the ground. And if as a tenable company your product has reached aging, divest. Same way here, differentiate and focus in the first three stages if you are a favorable company, and then you can harvest probably in the aging stages if you're a favorable company, because again, you have resources, but doesn't mean you will put everything to unproductive use. And at the same time, you'll try and do a turnaround if required. And then if you're a weak company, right from day one, you find niche, uh, catch up, grow with industry, then continue to serve that niche, or maybe in growth stage, they're giving a word withdraw. Oh, what nonsense is this? In growth stage, why do you think anybody should withdraw? Because we companies don't have resources to go by. That's why we say withdraw. And obviously, the other two boxes will be withdraw. But tell me something. This is how each company navigates through four stages. Did you understand this? Now, as I told you, key parts are highlighted so you can remember them. Now, look at the beauty part of the matrix. ADL has designed it in such a beautiful way. This matrix can move vertically, can move till now. What we saw, dominant company, how will they navigate in the four stages? That is a neat horizontal replication. But you please understand, a company which is a weak company, you will start from the bottom. Weak company X Limited started as a weak company in the embryonic stage. It went on to become a tenable company, and then it went on to become a favorable company, and then when it went on to become a strong company, and then when it went on to become a really dominant company. Can that be a growth story? Yeah, of course, not for everybody, but yes, definitely. So in the same line, the matrix can also grow vertical. But the beauty part is not that the matrix also moves diagonally. And all these are not there in the book. 99% of the people ignore this matrix, right? And the 1% of them who focus on the matrix also by heart them. Very few people have the understanding of this logic. If somebody explains, it's great. And I generally tend to take this very seriously and do it because the effort behind this matrix is so huge. I've read the whole story of this matrix as to how it has been crafted, right? That is only out of sheer interest, and also because it was in my syllabus when I was doing my advanced diploma in strategic management from CAMA London. So that time in the sense, this is a story of about close to 14 years now. So before then, before I fully got immersed into teaching, so I do hold an advanced diploma in management alongside being a chartered accountant and a cost accountant. So more than all of that, the interest as to how can somebody put this, because my only thing that sparked this curiosity is when you are telling that somebody will withdraw here, right? How on earth are you giving withdraw in the other two places? Because if somebody withdraws in the second stage, third and fourth box should be dash, no? Like there's nothing that they won't enter only. But if they're giving options, a company which could have withdrawn in the second stage, how will it come to third and fourth stage? That's when the curiosity kicked in and I started finding more. And then I realized that a weak company need not navigate all stages. No, a company that was strong due to a huge disaster or a fire accident, maybe they fell from here to here. Understood? A strong company that was growing with the industry, suddenly because they met a disaster, a strong company became a weak company because of a disaster. And now You have to sudden, and they're already in maturity stage. So instead of looking at this box, you might have to look at this box where the answer is very clear. You withdraw, divest. At least divest that product or then withdraw. So that's when I understood that matrix not only is moving horizontally as shown here, it moves vertically, it moves horizontally, and the best part is it moves diagonally. And to give you a better understanding to close this, you see the weak company's life cycle, not this time horizontally, but the one that I wrote and kept with circles here like this. So the diagonal way. Initially, when I started the weak company. Find niche was my first option. I did that. I caught up with the industry and I grew. You see, diagonally. Hold niche. How can suddenly somebody say hold niche here? Because you found that niche here. And then once you find niche and hold niche, you continue to have those options here also. See, find niche and hold niche. And then focus, differentiate, harvest, grow in the industry, all possible options. A favorable company in maturity is the best example of you being capable of doing any strategy. Now, did you understand the beauty part of the matrix? The matrix gives you a solution as to what strategy to follow in any possible situation, not just in growth stages or not just in maturity stages. You may be any company, you may be in any stage, you will find answer in one of these 20 boxes. Right? Did you understand? Did you find this explanation useful? If so, and exclusively those who have already understood this, and if the revision was good, you guys are free to comment. And at this point of time, we are about to finish anyway uh, the stage of crafting strategy. So anyway, you are going to go and comment stage 3 done. Wherever whoever have done stage 3 and who have been really happy in revising ADL, you say stage 3 done in bracket ADL star, just so that I get that feel when I read some comments that yes, you really are. And first timers who understood this, like I said, it is just only for the encouragement to the others, and also for me to see whether this explanation people are really bothering about it and is it really worthy of doing it. Okay, so if now did you understand? So it moves vertically, it moves horizontally, it moves diagonally. Now there is no way how you can tell I am not part of this matrix. Any business in any stage, you will find yourself in one of these boxes and it has an answer for this. So that is such a beautifully crafted matrix. Take a clearer look of the entire matrix, right? And the summary is also there, but this is the best possible way how you can have a understanding of this matrix. So done. That leaves us with two more stories on what you call as the BCG, right? The Boston Consulting Group matrix. Let me bring that back here for you. So this is how the ADL matrix is there, and of course I've explained the same here. And coming to the Boston Consulting Group matrix and the G model, I think we can do a revision of both these also to wind up this particular analysis on portfolios, and then with that there will be a wind up on stage 3 of crafting a strategy, which will then lead us to the last leg of our marathon, where we'll be talking about chapter number 5 with stages 4 and 5 on implementation and control. One of the most easiest matrix to understand is the Boston Consulting Group matrix. We're going to take two things. One, market growth. The other one is about relative market share. How is the market growth? Is it high or low? And how much is your share in that, high or low? That is how we are going to use the BCG matrix to classify businesses. First, BCG tells you classify the businesses. Then BCG will give you 4 strategic options. First, we will try to classify. If in a high growing market growth that is very high, so capturing the market should be relatively easy. And if you really capture, okay, the market with high market share, such products are termed as stars. So stars are those products which are capturing high market share in a high growing market. But stars require obviously investment because you are entering a market and capturing the market also. And for your product to shine like a star, obviously it is going to cost you. Then comes cash cows. Market growth is not going to remain in a high trajectory all time. So there will be definitely market growth to slow down. When Growth rate slows down in the wrong run. Sir, are you doing anything wrong here? No, we are not doing anything wrong. What was once a star later will become cash cow on its own. Okay, because you are not doing anything wrong. You're continuing to keep the product well, and the product is so good that even in a low growth rate market, it is still holding your high market share. That means you have done so well that people have some response to your product. The terms you understand, right? Stars are used for bright shining products. That's why they call stars. Cow is a metaphor used to describe those products, like how cow gives us milk. These cash cows are those products wherein you can milk in the cash. Like how cow gives you milk, these cash cow products give you the regular flow of money. Even though in low growth markets, their market share is high because they are well trustworthy, established products that people have already liked. So you should not have a problem in, holding that market share. So cash cows are amazing. But see, please understand, for no mistake of yours, that is in the real long run time, real long run, people's tastes and preferences might change, people's income might change, they might jump around to other products, and in the very long run, your market share may slowly decline. So in a low growth market, when your market share declines from high to low, such products are now termed as dogs. Dogs are not bad, guys, ideally. See, again, the metaphor dogs are used to represent that they have been loyal to us. Dogs are very loyal, right? So these products, which are termed as dogs, have remained very loyal. Today, what is a dog was once upon a time star. Star then became a cash cow then became a dog, and it's completed the circle. Dogs, because you don't see them fetching over and above the regular returns, I don't think you have to continue to hold them. Sometimes dogs know they are good enough to suffice themselves. That is also there. Sir, the dog is so good that it is generating enough money to maintain themselves, like it's breaking even. But please tell me, are we in business to make more, like profits and all of that, or just break even and say, okay, shareholders be happy. We put money, we got back that money. Okay, clap, clap, clap. That's not it. So shareholders are always looking for returns, and dogs are not generating those returns, and that is exactly why they have to be sent off from the portfolio list. That is called divesting. We'll again see that. Stars, cash cow, dogs. This story is something that we can see. Now, when you introduce a product, it didn't become a star. Market growth rate is high. Market growth rate is high, but you didn't find market share. Definitely your problem, because not market's problem. If it was market's problem, nobody should have found a share. But some other products are becoming stars. Only your product, some problem is there. Now, that is why those are termed as question marks. To identify what the problems are, you have to find which products are being classified as question marks. Though the market growth rate is high, you are not able to capture market share. No, those products are being called as question marks, also termed as problem children or wildcats. Wildcats, you can't tame them, they won't listen to you. Problem children, I seriously have to debate on this word. Why write two things which are okay? I don't want to blame children here, but yeah, problem children. Children by themselves include a problem, right? Anyway, that again depends on children, right? But okay, I was just joking on that. But wildcats. Are again here, wildcat. They're talking about lion, tiger, and all of those. The cat family, wildcats which live in jungles can't be tamed. Now, don't tell me, sir, some of them are there in circus and all that. Okay, please, come on. These are the analogy is to tell you that there is something that's not in your control. That is the whole point. Stars are bright shining products. Cash cows are well established products which were stars once but are now giving you good returns despite market growth rate being low. Dogs are very loyal products in the very, very long run. These have been something that have been there with you for a long time, so you might want to divest them. Question marks are failed products that fail to rise to become stars during the high growth rate phase. But tell me something, if question marks are attended properly and you do make those changes what the question marks need, do they have the ability to turn into stars or not? So that is the little piece of work that we have to work. But again, one more risk is there here. Blindly going on putting money into question marks will lead you to something called cash traps. What do you lead to? cash traps. All the money in the basket will be done one day, then you will have nothing to work on. So then what should I do? That is exactly why you have to make sure that you invest into question marks to an extent, and you know after a particular time, all you need to do is to take a call saying that okay, I've invested enough, it's not working out, let me pull back. So that is exactly why four options are also given in BCG matrix. The Boston Consulting Group, first what they did is to classify your products in the portfolio into stars, cash cow, question marks, and dogs. Sir, we have 3 stars, 2 cash cows, 1 dog, and 1 question mark. Like that, first you classify all the number of products. Then what to do, sir? Then where to put money, where not to put money? Because if you remember the theme of portfolio analysis, that is the theme of portfolio analysis, right? So, yeah, four options from BCG matrix. If you see properly: build, hold, harvest, and divest. And the meanings of each of this: build means to put money or invest. Build means to put the money or invest. Hold means to remain unchanged. Nothing, don't do anything, just remain unchanged. Harvest is to slowly sell products and generate immediate cash flows. Harvesting, like how we do crop harvesting. Some part, some part, some part we'll keep taking, no, like that. Divest means to sell or liquidate a portion of business. We already know from retrenchment strategy. Now, coming to what we will do in a BCG matrix from based on that, stars we generally tend to build or invest because they need a lot of money to hold it. Without thinking twice, hold a cash cow because it is going to fetch you enough amount of return. Now, question marks. Don't blindly go about saying that you will only build the question marks or you will only have to harvest the question marks. You can do either of it. But doing both blindly will not take you anywhere. Blindly building a question mark one day will lead to cash trap. Simply harvesting of a question mark will also see. Sometimes people are too quick. They'll be like, I waste, sir, not that product, will take it off. The moment you took off all your money from that product became a success thing. Like it happens so many times to all of us in stock markets. I would have sold a stock thinking, hey, waste, sir, nothing. Then from the day I sold, no, from next day it is only going up, only in green. Happened to me also so many times. Because we take an early exit, right? We lose hope quickly. So it's only once that happened to you. No. So then what did you learn from that lesson? Right? I always tend to, that lesson is there, but always, we tend to, stock markets are a place where, your emotions play a big game. So that is why, sometimes we'll think, okay, another bad call, what's a big deal? We'll make, see, we can make money through another stock. That's not the problem there. But the real catch behind that is this one. Early exit, danger. Too much holding, you will not even recover capital. So same thing happens with question mark. Too much of holding or too much quickly coming out are dangerous. So you have to see the situation and do it. Build or harvest. And dogs, they have lived their life. So the only thing that you can do is to say bid a goodbye to them, farewell, by saying divest. But so now I hope you have the four classifications: stars, cash cows, question marks, and dogs. You have the four options: build, hold, harvest, and divest. And this right now on your screen clearly tells you what to do with each of those. If BCG was a very perfect matrix, there wouldn't have been a need for a GE model to come in. But because every good topic has some limitations, BCG also has a couple of problems. You know that number, relative market share. Our share divided by total market share is called relative market share, correct? How easy it is to compute? Our share we can compute divided by total market share. So how will you ascertain the total market share, size, and all that? So that becomes a little unrealistic. Calculation of relative market share is unrealistic. Plus, your current portfolio products are classified into stars, cash cows. What about future products that you bring in? BCG matrix talks very less about future. The second problem. Now, to solve these two problems, and also one more thing, which is a very common problem, BCG has only talked about high or low. These are generally considered the extremes. So what about a normal, moderate, or a medium market situation? If the market growth rate is medium, or if the market growth rate, or if your market share is medium, what about that? That is not very bad, no? Medium to medium, medium to high, medium to low. The discussion is not there only. So BCG has spoken only about extremes, but it has spoken very less about medium situation. So these two problems, market growth is a very unrealistic calculation. Market share also is a very unrealistic calculation. Similarly, talks more only about current classification, less about future. So in order to address all these points, there came the last matrix, which is called as the General Electric model, also titled as a stoplight model, because stoplight in the Western countries is nothing but a traffic light. So now the two things that are you see on the one side of the screen, where market growth and relative market share are there in BCG, they are now being replaced by two better terms: market attractiveness and business attractiveness. So what is so significant about it? In market attractiveness, no, market growth is only one of the factor, not the only factor, right? So market attractiveness is a much broader term, right? They're very broad terms compared to market growth and relative market share. Relative market share is one such term which is included in business attractiveness. There are other 100 reasons as to why you can call a business attractive, or 100 reasons. Show us at least a few, right? Why not? Let me show you the table which talks about the I hope everybody understood BCG matrix. So I'm not really going through the BCG. You know, everything that we have discussed from that picture is only there here. So you can just brush through that. When I come to GE, I want to just show you this. See there: market size, industry profitability, competitive intensity, fierce, strong, moderate, normal, weak, from intensity of competition, from Michael Porter's model, technological availability, pricing trends, risk and demand variability, segments in the market. After considering all these factors, you are determining how attractive is the market. In that, market size and growth, it is 1 point. Similarly, market share and growth, it is only 1 point. Profit margins, distribution efficiency, brand image, competitive abilities, technological capabilities. If I'm a wonderful business with a lot of technological capability, I will rate myself high, no? Huh? So my business strength or business attractiveness will be high. So please go through these two tables also, because they both can also come in the exam. What are the factors taken into consideration? Factors taken into consideration while determining market attractiveness and business attractiveness. You can always run through these two. Now, anyway, the point is, after you do this, the difference between BCG and G, if you see, market attractiveness is replaced by market growth, and obviously, market growth is replaced by market attractiveness, and market share has been replaced by competitive strength, which means, in other words, business strength or business attractiveness. And what we have done in this is to mark green zones, yellow zone, and red zone. While green zone is a zone, same four options what BCG talked about: invest, protect, harvest, and divest. So only thing is, there they use the word hold, right? So build. Build became invest, hold became protect. Same meaning, same aspect, only thing word wise difference. So when both are high, and one is medium and one is high, so here both are high, and here medium to high and medium to high to medium. In all these three cases, we use the green color. They are favorable zone for your investing. Same if you look at the the center line, which is yellow, you have a low attractive business, but which can become stronger in future. But right now the market attractiveness is very high. So hold, wait, because market is good. Only you have to improve your business. Here, market is low. Your business is very strong. Again, have patience. Someday, when the market moves up, you can then start from here to here. If you're moving from here to here, someday you can then start investing. Till then, hold. The middle box is very important, where both are medium. Now, when both are medium, if you are a real risk taker, you can invest also in that box. This also I've explained in very clear terms in our classes, right? If you are an avid risk taker, you can always go and invest in that center box also. But on a conservative note, we don't know, market can move up or down. Our business can be more attractive or less attractive. So that is why when both are medium, okay, that is why when both are medium, a conservative understanding says, okay, protect, hold. And then on the last side of the the 9 box matrix, low business strength companies in medium, on medium to low. When both are low, you don't have any option but to divest. But harvest or divest, when you will do when the situation is bad, when something is medium and something else is low. So they use this matrix to classify them into three zones, which are explained here. The green is an advantageous position where you can expand, invest, and grow. Amber or yellow is where caution is required, so you manage very strategically and carefully. And red is a risky zone, so better have patience, retrench, divest, or liquidate, because that's not something that you usually go for. So this is the same thing I've explained here also. Uh, Invest in the green zone, protect in the yellow zone, and harvest and divest in the red zone. When both are low, without hesitation, you can go about divesting. So it is also called a stop light model because green, amber, and red are used just like in traffic signals, right? In India, we call them traffic signals. In the West, they call them as stop lights. So that is why it's also titled as stop light model. G model came in association with a company called McKinsey, which is a very popular, highly sought after management consulting firm in the world. Okay, so that is the origin of it. I don't think I have missed much. Those of you who heard me thoroughly, I think you should have completely brushed upon all these portfolio topics in the last 45 minutes. I believe, since I did this not to exaggerate, but I believe the last 45 minutes on when we discussed the portfolio analysis has been a great revision, right? So, like I said, with this, we mark stage 3 on crafting the strategy to be complete. Okay. In the next aspect, I have to start with now stage 4, which is you know the talk surrounding strategic implementation, which is bringing us to the last leg of the marathon, which is the last chapter. Stage 4 and 5 both are there in that one chapter only, implementation and control. So go ahead and mark stage 3 done, and in bracket ADL with a star next to it if you have understood it well. And of course, if you have understood all of portfolio analysis well, you also can write whatever you feel like in the bracket. But yeah, stage 3 done is a mandatory comment at this point of time. And I mean, let me bring this screen onto you. What is that up for us? Stage 4 on strategic implementation, talking about structure, leadership, culture, and strategic change with some of the most important topics of the syllabus, and then followed up by stage 5 for a implementation. So I suggest, I mean, depending on your energy levels, if you want to continue or if you want to take a break, absolutely let me here give you that opportunity, and you can take a call for yourself on doing that. And we will return back for the last leg of our strategic management marathon on chapter number 5, which covers stage 4 and 5 right after this. All right, guys, that brings us to the last part wherein we are going to discuss stage 4 and stage 5 of strategic management. Stage 4, as you see, is strategic implementation, while stage 5 is about evaluation and control. Before we discuss this, I would like to show you the beginning of chapter number 5. There are a couple of things that I would want you guys to take care of. So, bringing that to you is the heading strategy implementation. Implementation is all about stage 4, where you can see here putting strategic plans into action. What are you doing? Putting the plans. Till now, what was just on paper, putting those plans into action. While on the other side, we talk about evaluation, measuring and assessing the performance of the implemented strategies to see whether you are getting the desired results or not. Now, in doing this process, there is a topic which talks about the entire strategic management process one more time, using one of the very vibrant concepts in strategic management called as the Fred David model, which is nothing but the same process that we have been seeing right from the beginning thus far, right? You know the strategic management process very well. Stage 1 is about developing strategic intent, where you have vision, objectives. Stage 2 is about doing a deep rooted analysis of the external environment and the organization internal environment, followed by generating and analyzing and selecting strategies, which is called crafting a strategy. Then stage 4 is implement the strategy, and stage 5 evaluation and control. This model is called the Fred David model. Fred R. David, the person who's propounded the strategic management model, and a very neatly going flow. So we did talk about all these 5 stages. They are quite methodical. The development of the organization strategy is a quite methodical process, step by step. You have to go one after the other. Plus, they have a couple of other attributions. The strategic management process is dynamic and continuous. So there is nothing that I newly have to discuss in this strategic management process. So I'm hoping that you guys will be in a position to take care of it, because I have discussed all these 5 stages extensively. Again, before we go to organization structures and other things, I would want you guys to understand another very important point, which is you know the difference between implementation and formulation. There is a small table I would like to take you through. So please ensure that you go through these 5 stages of strategic management. Right? Let me just show you that also. Stage 1 is on vision objectives. Stage 2, which is talked about in chapters 2 and 3, environmental and organizational analysis, and formulating a strategy. Chapter 3, last topic on Michael Porter's forces, and chapter 4, stability, expansion, retrenchment, has been discussed. And 4 and 5 are nothing but the content in this particular discussion, where you develop budget, staffing, which is about putting the right person in the right place. Your strategies should be put up in such a way that they facilitate rather than impede. Impede means stop, facilitate means help, right? So your whatever you establish should help or facilitate rather than stopping your execution. Using best known practices, taking help of IT, putting up the right leaders, because no matter what we speak about, if you remember the management definition, one of the important functions in management is leading or directing. So that activity should be taken care, leading or directing. Then it has to be also followed by a good strategy that fits in. A good strategy execution involves creating a strong fit between organizational capabilities and your internal operating systems and the strategy. So that story is there, very much there, which talks about all of the the implementation process, followed by a stage 5, where we where we have evaluation and control. Where we have what? Evaluation and control. Where, to just see, we have some topic called as SPM, strategic performance measures, wherein we can measure the performance of the organization and see if we are required to make any corrective adjustments, taking corrective actions. That is only called as strategic control. So that also towards the end we can take care of. So this is the layered set of 5 stages. Okay, and I hope you are clear with all the 5 stages here, layer wise. Now all I wanted to do is uh, understand that this topic on strategy formulation, okay, before I discuss about the organization structure, there is a slight understanding about the 2 types of plans that are formulated. This has also been an exam question. So I want all of you to take a real quick view of what this is. Corporate strategy. Can you please look into the 2 branches of the corporate strategy, wherein you will be able to see 2 types of plans. One is called a strategic plan on explaining what to do, while the other one is called as operational plan, which explains about how to do, right? So these are the 2 aspects of what we call as strategic planning: what to do and how to do. While strategic plans are developed by senior management, strategic plans are developed by senior management. Strategic plans are developed by senior management. Operational plans are developed by middle and lower level, middle and lower level management. That is very, very important for you to determine, who goes where and what it stands for. So that is one basic point. Followed by one of the very important points is, while the first step is effectively talking about assessing the strength, weakness, and opportunities and threats, which are more involved in strategic planning, how to do the tasks, how resources will be used effectively, are discussed in the operational plans. A quick difference table: strategic plans, characteristics, if you see, they shape the organization, they assess the impact of environmental variables, assess the impact of environmental variables, and then they take a quite a holistic means a complete view, right? Not just one division or one area. They take a complete view. And strategic planning develops overall objectives. What do they develop? Overall objectives and strategies. And it is concerned with the long-term success of the organization, and likely generally they are senior management people who are involved in this story. Now, on the other side, we have currently right now, how are you deploying the aspects? Huh? What are you actually going to put up, right? Current deployment tactics rather than strategy. Tactics means ways of getting things done, not strategy. Tact is an art of getting things done. So, how quickly can you get these things done? That is what we are actually targeting. So, develop deals with the current deployment of resources, developing tactics, projects the current operations, projects the current operations, everything current if you see. And if at all any work is supposed to be done, makes modifications that, and finally it is a responsibility of functional managers. Here it is senior management, and here it is functional managers. So this very basic but important piece of our discussion is what we have in terms of the corporate strategies breakdown of strategic planning and operational planning. Okay, so this is the story about our understanding with respect to what these two types of plans are. This has been a straight question in the exam, which is why I thought I should again take a minute to do this. Now, I will also want to discuss one more very important point, which is again the concept of strategic uncertainty. I'm coming to that. Strategic uncertainty and how to deal with it. Uncertainty refers to the unpredictability of future events, unpredictability or circumstances that may affect an organization's strategy and goals. So, very important piece is about how to manage uncertainty. If only we can know everything, we will be called as God or astrologer. No? I don't know what can come in further. Okay, so there is a possibility that we may not be able to figure out something. So, therefore, it is very important for one to understand how we will go by this. So, how to manage uncertainty, to manage strategic uncertainty, to manage strategic uncertainty, organizations need concentrate words, flexibility, resilience, which means the strength, and agility means the kind of speed you are agile enough to respond to the changes in the environment, agility and quickly respond to the changes so that you can minimize the impact. Uncertainty can be grouped into logical clusters and then assess them. There is basically how to deal with strategic uncertainty. Answer is very simple. You do what is called as a scenario analysis. What do? You do something called as a scenario analysis. Sir, what do you mean by the scenario analysis? Scenario analysis is nothing but making a list of all possible situations. What is it? Making a list of all possible situations and the effects. If then analysis, that is what it is called as, right? See, I've written it clearly here. It is called the if then analysis. So have flexibility, diversify your business, don't depend on one business, because in times when things get bad, if you are putting all your money into one sort of businesses, they can go for a toss. But if you have diversified and kept, then there are all possibilities that you can get saved with respect to that. And also here, um, like I said, scenario planning, the keyword, if then analysis. Be ready for all possible future scenarios, right? Ask a question, what can go wrong, what all can go wrong. Make sure that you write the list of all those things what can go wrong, and ensure that you do the be ready with the answers. If any of those things happen, you can immediately get the answer. Let me tell you one more danger here. There are so many cases where if then analysis has not covered a particular situation, and that can happen. So that is exactly what uncertainty is. As I just told you, if only you know every situation, you will be God. No? There are so many situations for which you have ready answers. Then came pandemic. What was their answer? Nothing but a lockdown, which was never heard of. Like that, sometimes uncertainties creep in, and if uncertainties become real, there is an impact of uncertainty. The only thing that you can do is to, either collaborate or join hands with somebody, right? Collaboration and partnerships, so that you don't, like it gives you access to new markets. you will suddenly not fall. That's the only idea, right? And then we are also talking about one of the very, very important aspects of the SBU, the how SBU is impacted. Now, you know what is an SBU, right? It is the key business unit. So, the strategic business unit, which is a very key for business, how is uncertainty impacting them? Now, please understand, not every time all SBUs get impacted. But if an SBU gets impacted, what we have to weigh is it a very serious SBU that got impacted? Is it a serious SBU that got impacted? Or any other random SBU that got impacted? What if now a random SBU gets impacted? It is not a real problem for us. All right. Because the kind of profit or the kind of work that SBU does is less. So see here, some SBUs are more important than the others. How do you know that, sir? Based on the factors that I'm talking about, sales, profit, or cost. So depending on that, you determine which SBU is more important and which SBU is less important, and accordingly you can determine this. Okay, this is a small but a very important piece, because these are things that I not used to really deal with in the previous marathons, right? So this time, like I said, we want to go all out and we are doing it. So then moving on to implementation is about putting the freshly chosen ideas into action. The next topic, when we talked about formulation, you saw what formulation means in two types of plans. Now let's talk about implementation, which is a implementation involves putting a freshly chosen idea into action. Freshly chosen idea into action. It focuses on overseeing, right, and making the strategy work. So till now, we talked only about on paper. Right now, we're talking about translating the strategy into action. Translating strategy into action. So implementation involves translating strategic decisions into action. And this assumes that the decision, which is the strategic choice, was made after considering was made after considering its feasibility and acceptability. So after you consider the feasibility and acceptability of a plan, then only you are putting it into action. That is something that you should consider, and then allocate the resources carefully and put the right person in the right place. All I want you guys to understand is that there are two theories that distinction between implementation and formulation. I want all of you to go through the square here. I think you can read the content, but I just want you to explain. Wanted to explain to you these four boxes once. A, B, C, D, four boxes are there, right? You can obviously run through the content, and I'm pretty sure by now many of you know what exactly this is. Every time you do formulation, formulation can either turn out to be a very sound formulation, or formulation can turn out to be a flawed one. Now, if the formulation is a very sound formulation and the implementation also turns out to be excellent, formulation is sound and implementation is excellent, that is square B is the most ideal square, right? Ideal situation that everybody wants to be in. Flawed strategy, very bad strategy with many flaws and weak implementation, the box C, I marked it in red, quite dangerous. C is something that nobody wants to be in because it's a flawed strategy and poor implementation. So very less likely to be is C, unless somebody is doing something really bad, and everybody craves to be in box B. But the bigger question right now is, what about those people who are in A and D? In A, you have a sound plan, but your implementation is weak. But when it comes to D, you are excellent in implementing, but you are having a wrong plan. Now, simple logic. No matter how much correctly you write, a wrong answer in neat handwriting, it will still be wrong. No? Same way in D, no matter how great you are implementing, but if you are implementing a wrong plan, how does it work? So considering all of this, you have to make strategic adjustments. Everybody wants to be in square B. So square B is the ideal situation. Square C is a bad square. Nobody wants to be. Square A is showing implementational problems. So if you can correct those, like you can see the examples also, lack of experience, resources, leadership I give. So you can immediately move from square A to square B. Same in square D. You have excellent implementation, everything is there. Get the right plan and get it done. A contrasting view to this theory is there in the next page generally. Here, they are talking about strategic formulation and operational management. Formulation is again the thing. Operational management is about the implementation. This is another contrasting theory. There they told ABCD. No, here another theory says if you are having an effective and ineffective strategic formulation, effective ineffective versus efficient inefficient, how does this work? This is what the story is. So your operational aspects are implementation, the other side is formulation. Companies in box 1, formulation is effective, implementation is efficient, they thrive, they prosper, they thrive. There are no second thoughts about it, and they'll go absolutely fantastic. There are no problems at all. But when you talk about companies which are in box 4, ineffective formulation and inefficient implementation, those companies will die quickly. The companies will die quickly because both are bad, and you really are not going anywhere. So the company will die quickly. Now the challenge is between fighting 2 and 3. 3 they said survive, 2 they said die slowly. Oh, now say die slowly or die quickly. Someday you will die. That is bad. Sell 3 they're saying you will survive. So sell 3 is better than sell 2. In other words, sell 2 is a worse place than sell 3. How is that? Sell 2 has something called die slowly. Those entities who are having an ineffective formulation but efficient implementation, if not today, if not tomorrow, if somewhere day after, they'll die slowly. Why? Because they don't have clear strategic direction. This is a very important viewpoint. They are saying maybe organization will prosper for some time, but it will not do great. Sir, why? Because no matter what you work on, they don't have a clear strategic direction. But on the other side, it is not like that. You look at box 3, they have an effective strategic formulation, inefficient implementation. Or this inefficiency in implementation, sooner or later by learning things, they will be able to address that inefficiency. Because today maybe you are giving a little more input to get the output, but as things prosper and as things go further, I'm hoping all this will be fine. But the boxes in 2, no matter what you do, you're never having a clear strategic direction, so you will, if not today, tomorrow, die slowly. Understood? These are the 2 very important aspects of formulation and implementation aspects. And now I have a very important table that shows the difference between formulation and implementation. I want you to go through this table. This has a potential to come in the exam. The very definition is a difference in between both. Right? Formulation involves planning, while implementation involves only action related aspects. And formulation focuses before the action, while implementation is during the action. And formulation is an entrepreneurial activity, implementation is an administrative task. Formulation focus on drawing up an effective plan, so it focuses on effectiveness, while this focus on efficiency. And formulation is an aspect that happens in mind, it's an intellectual process, while the last one is an operational process. Physically, you have to put your task and do things. And then just if a few top level people sit and work along, the coordination will be done in terms of a formulation. But a lot of people at the level of factory should work in terms of the operational. And then skills required on formulation, a lot of mental skills are required. Thinking ability, ability to do things well, they are all required. Initiative, logical, conceptual, intuitive, and analytical skills are required. But on this side, you require a lot of motivation and leadership skills. What do you require? Motivation and leadership skills or traits to do things well. Then formulation first and implementation next. So formulation precedes implementation, that is a sequence. Implementation follows the strategy. Implementation follows the strategy. Then talking about strategic formulation tools don't differ greatly between profit oriented, non-profit oriented, small, large, like that. But implementation varies because for a small organization versus a large organization, the whole implementational aspect itself will change. And implementational activities is no direct mention, while here, what are all the activities? They clearly mentioned all those activities. Strategic formulation is a separate phase, implementation is a separate phase. They don't have any overlapping. And generally, formulation first, followed by implementation is called a forward linkage. And based on the implementation, if you take insights and ideas and come back and do something, it is called as backward linkages. Okay, so that is what even we have here, forward and backward linkages. So I hope you could catch up with that particular topic. Generally, this is something that I don't really bother to cover in the marathon, because like anyway we are in the flow and I don't want to break that. After stage 3 I'll directly jump to stage 4, but I thought, because many questions are coming from what we discussed, so the last 20 minutes that we discussed with this topic is a very important piece of discussion. So implementation and formulation, once you're done with it, now let us go back to our understanding of the stage 4, wherein we have some interesting aspects to discuss. Say, for example, talk about organization structures, then leadership, strategy and culture, and strategic change, which is the next best thing that we are going to deal right now. Starting with strategic change, followed by culture, structure, leadership. We'll go one by one, all of those points. But this is the summary of what it is. So, meanwhile, just quick moment of pause. I want you to take and run through the whatever we discussed, all the formulation implementation aspects. Put on pause and run through and come back. We will then discuss straight away what is strategic change and digital transformation overview, and then we will discuss Kurt Lewin change process. We'll go one by one. Then a lot more is there to follow. Come on, quickly have a look at formulation and implementation and get back. Come on. All right, guys, I hope you have gone through that. Let us move on now to the discussion of strategic implementation stage 4, wherein we have 4 branches to talk about the various structures that organizations can implement. After implementing a structure, you have to put the right leader on top of the structure. And within the organization, you have to create a great culture. Strategy and culture blend is very important. So whether culture is an ally or an obstacle, and whether this culture gels well. No, sir, our old culture is not matching and we have to change. Then what to do? Before all that, there is another topic called as strategic change that you're seeing here, which talks about 3 points on recognizing the need for change, creating a shared vision, and institutionalizing the change. Because if you're not necessarily doing a, like you don't need a change, but unnecessarily you bring that change, then it is going to cause trouble. So that is the first step in strategic change. Recognize the need for a change. And if you know what the change is and you keep it to yourself, change is not going to happen. So, sir, what are you suggesting? What am I suggesting? Communicate that change to everybody. Now, how will you communicate that change to everybody? By creating a shared vision, right? Not a vision that only you have. Create a vision and share it across in the organization. Create a shared vision. Now, when you create a shared vision, it goes across to the organization. People will realize what you want, and then more importantly, institutionalize the change. It has to be an organization wide exercise, institutionalizing it. So what are the 3 steps in strategic change? Recognize the need for change, and once you recognize it, communicate it to people by giving a clear sign of it, right? And then let me just show you those 3 points. I'm right there on it. Yeah. So recognize the need for change. That is, diagnose whether you want the change or not. 2, create a shared vision. That means, align all the individual and organizational objectives to avoid conflict. And then, very important point is point number 2. Senior managers must communicate the vision clearly and convincingly. If they don't tell what the vision is, how will you know? And more importantly, more than any of this, actions, whatever actions we take, they should be credible, visible, and more importantly, very serious. Action should be credible, visible, and serious. Then talk about institutionalizing a change. Institutionalizing means putting to implement those. So implement and sustain. Implement and sustain the changed strategy. Build the capacity for a self renewal. Don't wait for others to dictate things and all that. Bring the capacity for self renewal. Self renewal means you have to do something on your own, kind of not wait for others to tell you what to do. Capacity for self renewal to prevent old habits, and monitor and review the change process. Monitor and review the change process and correct any deviations. So these are the 3 steps to initiate strategic change. Meanwhile, one of the best concepts in strategic management by far that I have studied in all my management studies is the Kurt Levin's change model. Generally, when you see here, they told changing old habits. Now, we all know and we have experienced it so many times that we always want to change and we tend to change, but that change will vanish very fast. Is that true? We tend to or want to change and that change will vanish. Sir, from next to Monday I will wake up and study and it'll be killer. Very good. Monday you will wake up, Tuesday, Wednesday you will go back to your old ways and be like, what sir, all that is dumb. Suddenly you'll watch an YouTube video and you'll be like, our full motivation, sir. Huh? We'll have to go and follow that. Nice. How many days? 3 days. After that, what happened? Gone. 3 days also too much. Then second or third day, people are complaining. That fellow will tell sir like that only. On YouTube, they can tell whatever they want. Ask them to practice and show and all. Correct or not? Huh? So, and I think every CA student by default will face this issue. By default, every CA student will face this issue about the fact that that they are uh, somehow losing off the motivation in the pathway, right? So, sir, I don't want something like that to happen. Then what should I do? See, generally, all this what I told you now, YouTube, somebody told this, that all these are called as extrinsic motivation. What is it called? It is called as extrinsic motivation. Extrinsic motivation is short-lived. So, what do you mean by short-lived? Means, like I said, going to gym for 2 days because neighbor went, friends took, so I went to like the health club. Somebody wants to gain weight, lose weight, they'll do that only. Somebody wants to quit smoking, they quit for 2 days. Then third day they're smoking more than what they smoked 2 days back. Why all this? It's because you are first of all not ready for change. You directly brought it. That is the problem. So Kurt Levin's change process, it's told back in the 60s. Some of my old students, they after I taught all these, and then when they went on to read books, I told you I don't generally read books. There is one very uh, well-known book called Atomic Habits. I don't read, but I keep knowledge of what are the very good books and all that. So one of those very good books in the market is Atomic Habits. If you are in management or if you're somebody who works with the concepts of management, you don't need anybody tell you anything, because anybody telling you how to live life, they are going to tell you or teach strategic management. So it's a way of life, as I told you. There, in the 1960s, one of the very popular models is Kurt Lewin. He brought in this and he said this. So there is a reference, Atomic Habits by James Clear, I guess. That is the name of the book. And if any of you have read that, you can as well leave a comment. Right. So Atomic Habits, in that there is a mention of the Kurt Levin's change process and say, change will not come suddenly. Change is always gradual. And sudden changes can be socially destructive, mentally challenging. From tomorrow to change the time, from tomorrow to change your attitude, it's a sudden shock. Everybody will not react so coolly and say, okay, let it happen. That's not how it works, right? So it takes time. And that is exactly how we need to make sure that we are taking care of it, right? So unfreezing is the first step. If you want to quit smoking, don't quit smoking completely. Somebody is smoking 10 cigarettes, they have to make it 8, 6, a part of it slowly. And that is how your body gets used to that kind of. Same way, business also. First, you have to have some unfreezing time. Instead of asking people to change, prepare them for change. It prepares members for change by breaking old attitudes and behaviors, unfreezing the situation. If you want to convert a cube ice into a cone ice, what should you do? Let the cube ice melt back into water, put it into the cone mold, and refreeze it again. Simple logic. So first slowly melt, break free from your old habits, prepare yourself for change. Change should not come as a surprise to the members of the organization. Remember, because sudden unannounced changes here socially destructive. This line is my favorite. Why is it my favorite? Because that's also something very true in personal life. Suddenly, if you have to change something, sudden unannounced changes are socially destructive and morale lowering. If I come and tell you, hey, from tomorrow you have to change, they're socially destructive. They're not right. They're what's morale lowering, very demotivating. That is why gradually bring the change, announce it to people so that people know, acha, change is happening. They're willing and ready to accept the change. Then use announcements, meetings, promotions, and all of that to go with each of this transition. Right? This is the first step. What is the first step? First step is called as unfreezing the situation. Then talk about changing the situation. Slowly you change. So how to change? For this HC Kelman, another management fundamentalist, came with a three-step process. He says, if you like somebody, idealize them, identify them as your role model, right? Compliance, shut your mouth and follow. Compliance is enforcing rewards and punishment, very strictly following. Compliance, identification of role models, and more importantly, what I told you some time back, all this should not come from outside. That is why YouTube motivation will last only for small time, because it comes from outside. In motivation, Noma, there are two types, extrinsic and intrinsic. And here, what we are looking at is called as intrinsic motivation. Why are you changing? Because I want to change. The day you say I and you put yourself ahead, that's all. The game changes totally from there. Okay. There is no need for anybody to tell you anything. You will by yourself do it internally. Then comes the last aspect called refreezing. You know what do you mean by refreezing? Refreezing means now, after changing, you've made something right. Make that the new way of life. Make that the new way of life. Refreezing reinforces a new behavior in the normal way of life. That's it. Unfreezing, changing with three steps, refreezing. Understood? And don't let the new behavior diminish. Don't slip back into old ways. Constantly stay focused. Very useful for you also to bring any kind of change in your life. Right? Simple. Don't, whenever you want to change some habit, all of us have habits. Good habit, bad habit is depending on who calls it. Doctor calls sleeping a very good habit. Correct? You sleep 8 hours, like, which is very hard for me to do personally. Right? I'll be very happy because I've got used to a kind of practice where at a stretch, if I have to sleep 8 to 9 hours, it's extremely rare. I can't even tell you when was the last time something like that happened. Sir, but sleeping less, isn't it a bad practice? Nobody told that. I've discussed this with many people. If you sleep someday for 5 hours, 6 hours, or maybe even 4 hours, that is still fine. It's okay, right? But you cannot make that a regular practice that can sometimes in the long run harm. Right? I possibly don't have evidences to discuss this. That is why I'm not telling. But like I said, that the reason why I'm telling you this is sleeping is a good habit according to doctor. If you're sleeping for 9, 10 hours when you're doing CA, educators will call that a very bad habit. 6 to 8 hours. See, mind has to have rest. That is the point. So, what is good habit? What is bad habit? Somebody says, sir, I'm smoking, but I'm smoking only 2 or 3 cigarettes a day, limited, no problem. It's harmful, but in limit, it seems. Same as somebody drinking. They said, doctor recommended, sir, little alcohol is good for body. Sometimes some doctors do. Good or bad. What is good habit? What is bad habit? I don't really want to. I told you in so many times in the context of ethics, there are no good habits, bad habits. They're habits. Now you want to change a habit for any reason for you to become better. Follow this and see. Lot of chartered accountant students. I'm taking a little liberty because if you have come this far in listening me, right? I think it is close to 8.5 hours now, right? If you have heard me throughout all this, considering myself to be your friend and giving a very friendly advice. A lot of chartered accountant students have an attitude called as resentment, which means to go back and give up easily. Some people have another attitude called not to give up. Both are dangerous. Or what you're talking, never give up is a crazy attitude. Yes, it works well on t-shirts, in my opinion. Sometimes, since strategic management already taught us, retrenching is a good behavior. Yes or no? Never give up, never give up. It is nice to tell all these things. See, I think you should understand the context of when they say never give up. There are so many ways I didn't give up. Like, say, for example, a couple of years back, many of our students already know that I had an ankle fracture, and I was, the leg ankle piece bone was hanging around. It's very risky for me to even walk at that time, and the doctor has advised, a plaster and 6 weeks of complete rest, and then couple of weeks of healing time, and then he said for 3 months not to even drive the car. Everything so serious. All I did was not to defy anybody or not to say I'm. All I'm saying is I took classes online wherever possible, keeping the leg. I didn't say okay, I'll go back to bed rest. I could have done that. It's not about the. It's not about real commitment that in the middle of a batch we can't leave our commitments. So there, people came and said you have a never give up attitude. I wanted to just you know finish what I'm doing. It's not about a never give up attitude or something like that. I gave up so many things after that. If you guys follow me, recently I've put a post on even my Instagram, right, saying that I dropped doing a lot of physical activity that I used to do before. I didn't play sports for a long time, right? I didn't go to gym for a long time, which I went for about 14 years continuously without missing my routine. I used to go properly with proper breaks, everything. So one defined event like that, and that's not a very serious event, right? Vehicle fell on my leg, and it was quite an unfortunate incident that nobody had anything to do with it wrongly. It's just the timing. So it was just an indicator to tell you that hello, stay grounded. So, so all I'm saying is never give up is not a right thing every time. Sometimes when you are seeing that things are going out of your control, let go loose and slightly you can give leave those things and do something better. Same way, some people don't have the attitude of holding on. They go to resentment. Everything is happening to me only. God is punishing me only. CA is not for me. I tried my level best. Which level? Who told you level best? You only decided. So, please understand both these things. No, okay. If I continue to go more, it will become a very philosophical story. And nowadays, when I'm telling any words of wisdom, also I'm being very careful because today people are like, enough. Please do your job and get away. So that is why I stopped giving a lot of free advice. And I tell this after giving the little piece of advice. So ensure, all I'm saying is ensure that you follow the process. So unfreezing is a great thing to do. Like unfreezing, when I say it's about more to do with unwinding, you don't push yourself to do something really hard. So apply it. As a CA student, this process very, very required. Once in every 3 months or 6 months, you have to reassess your situation and keep doing it. Okay. If you like the words of wisdom, do follow it. If you don't, excuse my last 5 minutes and continue to listen to digital transformation now. And if you have something to reach out to, you can always do that on Telegram or Instagram, because sometimes people are very shy in reaching out for any help. Okay, so in this kind of a situation, beyond CA, there is always something that which makes you an individual. Focus on all of that, and if there's anything that you think I can help, you can always reach out to me on Instagram or Telegram, but not solving personal issues or relationship issues, right? But all I'm saying is, right, you have, I can definitely give you some words of encouragement in whatever you're doing, and if you're stuck somewhere in between, we probably can see some line together. I'm not saying that will always work. I'm not a psychologist, right? I'm just another human being like you. But maybe if sometimes, if we just can exchange or talk something, it definitely makes sense. You necessarily need not be with me. you find a confident in anybody, you can go ahead and do that with them. Okay, so that is really a very powerful topic, uh, Kurt Levin's change process. And personally, I like it so much so that I had to tell you all of this. Okay, so on that note, let's come to digital transformation, a very important topic from where questions are coming nowadays. So let us just go to digital transformation. The use of digital technologies in doing our regular routine tasks is now called as digital transformation, wherein it is a fundamental adjustment and very difficult to implement because you're changing the entire basics. Roots are being changed. Sir, then how should we do this? We have to use a wonderful technique. Another great textbook technique, which is wonderful, is change management. Change management is such a wonderful topic where you go stepwise. I want all of you to understand change management is not changing the management. Change management is not changing the management. Change management is managing the change. Change management is not changing the management. Change management is managing the change properly. Many people don't know what is the change that they are looking for. So unnecessarily what they'll do is they'll fight between their head itself, they'll fight. What are we actually working? So when you are bringing a change, you have to manage the change. As you see in textbooks, changes are not that easy. Change in attitude or change in business, anything, not an easy task. No. First, you have to define the goals as to what is the goals and objectives of the digital transformation. Here we are talking about digital transformation change, so we are focusing on that. Same thing applies to us all. Define goals, assess the current state, assess the current state. Where are you now? Create a roadmap where you want to be, current versus targeted, and then implement and manage the change. Okay, so the key elements of strategic, change management. How does it work? If you see, it is a set of tools, best practices, so which are in a very safe and regulated manner. They are implemented so that changes can be done in a very safe and regulated manner without negative aspects. And you can use it for anybody, businesses, government, non-profit, everybody, even families, which is why I highlighted that even families can do that. Understood? So what are the key components? If you see what the key components are in this context, this, all these points that you're seeing now, they're all exam questions. They've already asked the key components of change management. One, have a clear vision. Two, involve all the stakeholders because they have to talk. You can't dump something on somebody's head and say, all of you follow this. Huh? You can't do that. All you can do is to tell people, hey, look, this is how it works. So involve the stakeholders to ensure alignment and support. Develop a structured plan. Develop what? A structured plan. And most importantly, you continuously monitor where you are going and what you're doing, and that continuously you monitor. Okay. So change management is one of the most important things in digital transformation without which you will not be able to do it. Another important question which is already made to the exam is a 5-point answer on what are the benefits of a proper change management strategy. Sir, you told if we have change management strategy, it will work well. So what are the benefits of a change management strategy? First, it will tell you clearly what you are doing. Defining the parameters, clearly specifying the goals and objectives. What are we doing? Clearly specifying the goals and objectives of digital transformation. Two, identifying all the modifications. Identifying the modifications, what changes and things are needed. Three, implementing, that is developing a structured plan, developing a very structured, layered plan to bring those changes effectively. And stakeholder involvement, actively engage all the stakeholders, actively engage all of them, tell them, right, this change is going to come. What is your contribution to that? Please tell us, and all of that, right? Actively engage the stakeholders. Continuously track the progress. If you can do this 5 steps, then a proper change is possible. change management talks about bringing a very positive element of change. Change management strategies are needed because change management is essential for successful transformation and modern firms adopt them. That's fine. Very important point, multiple time asked question from change management. Either they can ask you this one, benefits, or they can as well ask you the key components which they've already asked once. And what they have multiple times asked is the 5 best practices. The 5 best practices for managing the change. First one, change should always start at the top. Top management should show interest in change. It should come from leadership. It should not be like they told so we know. It should not be like that. Change should always start with a united and focused leadership. Leadership should create the culture. Leadership should create the culture that motivates the organization and embraces the change. Ensure there is a necessity and desire. Very important point. Don't do change for the heck of it. Confirm changes necessary. Avoid introducing too much faster changes. It's not going to work. I told you two things, need and desire, both should be there. If there's a need but you don't desire it, result will not come. If you desire a change when it is not needed, that is also not really workable. So therefore, work for it. Ensure change is both necessary and desirable, and do slowly. Reduce disruption. Reduce the disruption. Minimize the impact of change on employee by communicating properly. What are you changing? Provide the knowledge. Create a change friendly environment. If somebody wants to know something about change, let them ask. Empowering the change agents. Ensuring that IT department is ready. Make sure, because they are today, every change involves an IT kind of change. Ensure IT department is ready to adopt the change. Begin at the top. Ensure it is both necessary and desirable. Reduce the level of disruption. Encourage communication. Encourage what? Communication. Develop some channels. Develop channels for workers to share queries and concerns. Promote collaboration, right? Promote collaboration and use communication so that you can deliver. More importantly, recognize the change as a norm, not as something that you, okay, okay, one time event, everybody get joined, not like that. Understand that change is continuous. Change is what? Continuous and not a one time event. Begin at the top. Ensure necessity and desire both are there. Reduce the disruption. Encourage communication. And recognize that change is something which is normal and needed once in a while and not something. The most latest asked question in the exam is navigating change. How to navigate through change. With that, we will end the strategic change and digital transformation topic. Probably it will be I think it's about 50 minutes, 55 minutes by the time we finish this. So I would want you to take a small pause and break and then come back for McKinsey 7S model, the 8 organization structures, leadership, culture, not much, and then the last part called control. So that will leave us with the last 1 hour of discussion to close out the marathon. So before we do that, 5 steps to navigate. If you want to go through the change step properly, first, specify the aims and objectives clearly. Specify aims and objectives clearly. 2, communicate consistently. Communicate consistently. Open and honest communication. Definitely people will oppose. Some people will always be there who will oppose. Be ready for the resistance. Resistance to change is a very common thing. And have a strategy. If at all they resist, what should you do? Maybe communicate, maybe do a meeting, maybe convince them, whatever it needs, do that. Followed by implement the changes gradually. Don't go all out and say we are going for it. Implement it gradually. Offer assistance and training. When you offer assistance and training, people there itself, they will have a very safe and sound aspect like, okay, somebody is there to support us. So that is how you navigate through change. 5, aims and objectives, consistent communication, ready for resistance, gradual implementation, and offering assistance and training. Okay, So that is how we track and take care of digital transformation. I have not, to be honest, done this in this detail in the previous marathons, but this time, like I said, I don't want to leave any loose ends. So you can as well mark digital transformation as done. So we are doing stage 4 right now. Of course, you can stage 3 you marked already, but since it's time, go to the comment box and say between stage 3 and stage 4, you can say digital transformation done. So that we can now move on to McKinsey 7S framework. If you see this, what is the 7S organizational framework from the McKinsey group? And then there are a set of hard elements and soft elements, 4 and 3. What those are? This has been an exam question. So we will discuss this in detail after you take a moment and run through everything that we have discussed thus far in this piece so that we can continue on to the last leg of our marathon. Right? So take a look at organizational framework. You can just do that. And then before we start this, yeah, you can pause me here and go for a look and get back. All right, guys, I hope you are doing what you are supposed to do. And let us now move on to the discussion of the McKinsey 7S model. Now, what does the 7S model talk about? Is about 4 plus 3 split, 4 elements which are defined as a hard elements, which are physical in nature, and soft elements are something which are intangible in nature. What is the McKinsey 7S model? Is this a model which you can effectively have an organizational design for? But it does have some limitations which are also spoken about in the discussion, and which is also one of the reasons why this model is not very popular, in the action aspects, right? So let us see how this works. The McKinsey 7S model is a tool used to analyze a company's organizational design. It aims to show how effective the interactions between these 7 elements are. On a very quick note, what are these 7 elements? You can take a look at those. Hard elements are strategy, structure, and systems. Strategy, that is nothing but what steps the company intend to take, what steps the company intends to take to address current and future challenges. Similarly, we talk about a structure as to how work is divided, how the work is divided, and how different departments work and collaborate. The structure is nothing but the organizational structure, the physical design of the organization in terms of whether it can be. Now we are going to also see the other one, simple structure, divisional, functional, like that. Structure as to how work is divided, and the other S is the systems, which are nothing but the processes that are there in an organization. Hard elements clearly visible, the strategy, structure, and systems. What is not visible clearly, because see again, sir, how will you see structure, how will you see system? Means they are not a physical building. So please understand, strategy also, where will you see it physically? That means hard elements can be seen in their implementation, right? An organization has a strategy. The organization follows a structure. There is a particular system, like government. Government is a system. Can you see government, right? Prime Minister, Chief Minister, they are not the government. No, they are people who are in the government. So government is a system. Education is a system. So like that, you can see, like say people go to school, college, what we are doing now, it's part of the education system. So structure, system, and strategy are visible. Visible in the sense they are hard elements, though not physically tangible, touchable products, they are visible in space. But when it comes to soft elements, staff, skill, staff again here means not the physical people, refers to the employee development aspect. And more importantly, they wanted to give S, that is why they said shared values. But shared values are nothing but the values that you learned in the first chapter. So values, the skill that staff was, they want to, like use 7 S's. So that's why they use the word staff and shared values. Skill and style, I'm still okay. Style depicts the leadership style, and skill depicts competencies. But staff and shared values are purely used to bring the S. So staff doesn't represent a group of people, listener. How the employee development aspects are there, that is being referred to in the staff aspect. And also when you talk about shared values, you talk about what? Shared values, which are nothing but the values that we discussed in the very first chapter that everybody should have. These are called soft elements. They are intangible, they're ingrained with people, and you can't see them physically, right? So those are the 7 S's that are there in the McKinsey 7S model. Four hard element, I mean like 3 hard elements and 4 soft elements. No matter how good the story is, there are a couple of limitations in the McKinsey model, and you can see that they focus only on the internal elements of an organization. All the 7 S's, there's nothing external about it. So that's a challenge. And also, this particular model does not clearly define. What does it do? It does not clearly define what constitutes to organizational effectiveness. So this organization is effective, this is not effective, like that. It doesn't tell. It does not constitute to what is effective. So it's very inflexible and missing the real gap. So 3 solid limitations are there. Maybe they can ask you the 7 elements and then also ask limitations. Only once they've asked limitations in the exam. Okay. So yeah, that's all, guys. That's a small piece of insight on the 7S model as to what those are. Please go through it one more time. Let us move on to the other aspect, which is a very important one. It is called as organization structure. One of the beautiful statements in strategic management is made by Edson Spencer. Edson Spencer's statement about, uh, you know, the ideal organization structure. Sir, what is a great organization structure? Can you tell us? Of course, if I have to tell you what the great organization structure is, a great organization structure is where ideas filter up as well as down. Okay. Merit of the idea carries more weight than the place it comes from. In India, we generally have a culture in demeaning people based on their position. Hey, you are in shop floor level. Why are you talking? What is your role? So all of this. So this is very important to understand that whenever we are talking about organization structures, we have to clearly have some understanding about which is the best suitable structure from our point of view. Okay. So for somebody, it is a, what do you say? Simple structure will be suitable. For somebody, divisional structure will be suitable. So a good structure is not there in just in the lines of authority. Edson Spencer's statement, if you, like I said, if you read it in more detail, he says participation is more important, right? Hey, who are you? Why are you talking? You are not educated. He's a shop floor level employee. He has more practical knowledge than anybody else. So, yeah, definitely there is a very important piece of understanding there. The ideal organization structure is a place where ideas filter up as well as down. Merit of the ideas carry more weight than their source. Participation and shared objectives carry more weight than a executive order. So this is what Edson Spencer has to say about an ideal organization structure. In this context, I would like to give you the 2 reasons as to why changes in structure can be, very important point. Again, Chandler discussed another very important thing, Chandler's insights. He says whenever there is a change in strategy, there might be a change in structure, because your new strategy has to fit in with the culture of the organization, right? So it has to meet the structure. So in that context, 2 important things: structure's role in objectives and policies. Structure's role in objectives and policies. Structure influences how operational objectives and policies are developed, and the format for objective is nothing but performance targets, right? So you can go for a geographic structure. Hyderabad should do this business, Chennai should do this business, Bangalore should do this business, Cochin should do this business. We can split across cities and say geography wise is what you can have a structure geography wise. Structure's role in resource allocation. Structure also largely dictates how resources are allocated, to which level what is given, right? Because again, a customer group based structure allocates resource on that customer group that is fetching the more revenues for the organization. So like that, reason number 1, structure is very important in understanding what should be your objectives and policies. 2, structure plays a very important role even in resource allocation. Okay, now let's go by discussing all the 8 structures here. I would like to take you back quickly to our 8 structure depiction. Yes, Simple, functional, divisional, multi-divisional, and SBU. These 5 structures are known as traditional structures, while they have all follow vertical flows. Matrix, network, and hourglass, these 3 structures, they follow, the new age design. In simple structure, there is one person at the top, and he is the whole and sole responsibility controlling everybody in the organization. Okay, so just to take you through that, I want you to understand the story clearly. I would want to depict and show all the pictures and give you an insight and understanding. And please ensure, because right now I would, it would not be possible for me to dwell back into the each every line detail of this. So I would want you to take a little piece, because I've done the best that I can do for all the other topics. And when it comes to this, I will again do my best to tell you what these are. Insights will be clear, but line by line reading, you do. If you've already done it, amazing, right? If you know what these 8 structures are, this is going to be a great revision. Now, let's see first one, what is called a very simple structure, right? I hope everybody understood the Chandler's logic. I will show you on Chandler's circle. Yeah, whenever a new strategy is formed, new problems emerge. When new strategy is formed, new problems emerge. And whenever new problems emerge, organizational performance will decline. And whenever organizational performance declines, you need to improve the organizational performance by establishing a new structure. A new structure is formed, a new organizational structure is established, and then automatically the organization performance will improve. This is the story of the circle of aspects. Then moving on, what we need to really understand as we go are the 8 structures. Let us start the first one. It's called a simple structure. A simple structure is a owner manager structure. One owner will be there, owner or manager, however you want to call them, and below him everybody will be there, right? One owner, manager, and below him everybody will be there in deciding what they are going to do, how they are going to do, and all of that. So that is what the simple structure looks like. Let me bring that to you. Owner and all the people are there in the simple structure. This owner will take all decisions. The other people at the next level will do all the execution tasks. Then simple structure may not be workable after a particular point of time, because it might not sound that great when you have a lot of products or when you have a lot of understanding to do. So at that point of time, you need to really understand uh, what is the next best thing that you want to do. So that is what functional structure is all about. Functional structure is again a structure where CEOs there on the top, you're not changing them, but only thing what we're doing is, since these executors were there earlier, we are now splitting them into a few set of people at the corporate level. So that is level 1, that is here, where you have corporate finance, marketing, HR, all those people at the corporate level. And below them, what I marked 2 is all the functions at this level, finance, marketing, HR. So we are splitting the organization based on functions, so that the line of authority is very clear, and the CEO and the corporate level people take the decisions, and each functional level people will be there who will take care of this aspect. Now, the only thing that one needs to understand here is, if the organization does well, if the organization does well, they will give all the credit to our CEO and clap for him and say, wow, the CEO did amazingly well. That is what the story is all about. They'll clap nicely. But you should also understand, uh, there is too much accountability on the top. If he fails also, they'll blame him. But people might have not worked well, but why should this fellow take the blame? So that is the negative side of the story of a functional structure. Too much accountability on the top. And again, functional structure is also suitable only for less diversified businesses. Functional structure is not suitable for highly diversified. That many functions can't be split. A simple structure, a better version of that is a functional structure, where as you increase your activity and which you can't control within the bounds of the organization, that is when you will go for a functional structure. One step above the functional structure is what you can see there is the divisional structure. Divisional structure retains the CEO and corporate level people. Now, earlier functions were there in level 2, right? Now they will come to level 3, and in between them, divisions will come here. division 1, division 2, and division 3. Like the divisional levels have come. Now, divisions can be based on geography, dividends can be based on product, divisions can be based on the service that you render, and divisions, sorry, can be again based on the process. So, divisional structure by process, just to mention a point, the divisional structure by process is again very similar to a functional structure. But right now, you have each division will be headed by a divisional general manager. See, this notes is so simple that one day before the exam, if you run through all notes and if you have done decent revision before, you should be able to cover the entire syllabus and go confidently to the exam. Okay, so that is exactly what one has to understand. Then the only difference between divisional and multi-divisional, divisional and multi-divisional will be multi-divisional also called as M form. That is the other name for it. The only division is, only difference is if a division can be plugged off separately, right? Like divisions based on products, product A, product B, and product C. When you can split the product separately as a separate business, that division is called as a multi-divisional, multiple different products. Now, the reason why I have to tell you this is there can be only one product for the entity and it can have a Hyderabad division, Bangalore division, and Chennai division selling the same product across three divisions. But on the other side, you can also see the same company having product A, product B, and product C, where products A, B, C can be distinctly sold separately as a business. That is called a multi-divisional structure. The only difference between divisional and multi-divisional is that multi-divisional are separate businesses in nature, right? And one common point between everything between 1 to 4, the common point is that all the organization structures used in less diversified businesses. Where are they used? They're all used in less diversified businesses. They are not used in widely diversified, because if a business is widely diversified, you cannot generally use this. So therefore, all organization structures are used in less diversified. Sir, then highly diversified, what should we do? Okay, go for this one. For a highly diversified, you have to classify them into SBUs, and that is the birth of SBU structure. Here also we have three levels, but this time the three levels are: level 1 is again the corporate cadre or the C-suite president, and the corporate group of people are there in the level 1. We have rebranded the CEO to a president right now, because generally we have for a group president and vice president are there for a group, right? It is like that. Okay, so at level 2, where earlier divisions were there, now we will break them into SBUs. SBU is either a single business or collection of related businesses. I hope all of you know this definition. SBU is either a single business or collection of related businesses. All related businesses, you group them into SBU 1 and put them up. Okay, 2, SBU2, SBU3, SBU4 can be a single. Now, SBU2, in my example, I've grouped them as 3 products, which are further divided into Division 1, Division 2, and Division 3, where under each division, functions will be there. So, if you see, this is one of the most elaborate, very widely discussed, okay, structure. And people like Hindustan Liver, right? Such somebody having 30-40 products, Patanjali, these guys might go for these type of structures where huge number of products are there in portfolio. Like say HUL has about 10 different soaps. They can group all those soaps into one soap making unit, and then they can project it as a soap unit. So like that, we can always go for the understanding in terms of the SBUs. Related products are grouped into. Sir, if anything falls, if anything does not fall in any of this category, then what to do? If something does not fall in any of this category, it is better to keep it just like that. Don't try and do something. It is just supposedly to be kept as it is. Only when you do, it is a problem. No. So that is the point. And we need to understand as to what the story is. I would like you guys to take a moment of pause and go through all the 5 structures for a minute here, because it seems to be like a very important aspect on for me to let you go through this. Then I will continue with 6, 7, and 8, which are simple structures. Again, matrix, network, and hourglass. I will explain them also. But for a minute, I want all of you to go through the four structures which are vertical in nature for less diversified entities, and the fifth one, which is the SBU structure, wide and clear for everything. Come on, go for it. All right, guys, I hope you have done that. So let us move on. If not, please put me on pause and go for it. That should be something that you can easily deal with. Right now, you can see matrix structure. One of the very important things about matrix structure is the matrix structure can be implemented only if resources are scarce and ideas can be cross fertilized. Okay, resources are scarce and ideas can be cross fertilized. Only if this is possible, we can go for a matrix structure. If abundant resources are there, we'll go for better, bigger structures. You understand what I'm saying? If abundant structures are there, we can go for better ones, we can go for bigger ones. It's not necessary that we have to go for the clumsy kind of a structure like a matrix. A very complex structure. Why? Less people are doing more work. Less people are doing more work. There's a CEO on the top, the same guys who are doing finance for product one. Now all these guys at P1 that you see there, product one, they are all horizontally connected. Okay, plus all the finance guys in this organization, whether they work on product one, product two, product three, whichever product, they're all vertically connected. So two things to take home and understand is, each functional executive who is working in a functional department, he is vertically connected to their functional superior. He is vertically connected to their functional superior and horizontally connected to their product manager, who later becomes who was first the project manager, then becomes a product or brand manager. Okay, so this is how the matrix structures construction is. First you will start with project, because it's not yet a well established idea, it is just a project in your mind. So you established a project. Then what happened? Then if you see what has actually happened, it be the project worked out, and then it turned out to be a product. Product in the long run will turn out to be a brand. So the guy who initially started as a project manager, towards the end, when the structure becomes permanent, is becoming the product or brand manager. Davis and Lawrence are two people who explained, and this is a very possible exam question. So what I would like to do here is to just run through the text, because it has been asked in the exam so many times. I would want you guys to be with me on this one, on the Davis and Lawrence three steps. Okay, let me just bring that on your screen. For development of a matrix structure, Davis and Lawrence have proposed three distinct phases. I don't know if this comes in the exam, thank me later. Cross-functional task forces. So temporary cross-functional means the same guys who are doing work with other products, you can establish them and put it into the other projects. And therefore, very important point, temporary cross-functional task forces means right now it is just in the ideation stage, it is not full. So they're temporary in nature. But once they work out, they'll become permanent. So it is like this, guys: temporary, semi-permanent, and finally fully permanent. A mature matrix will be created. So first use the same, guys. A temporary cross-functional task force is there when a new product is created. A project manager is a key horizontal link. This guy will take care of the product horizontally. He'll link all the finance, marketing, HR guys horizontally and take care of it. Also, this guy is the one who later becomes a product or brand manager when they become more permanent. The project manager transitions into a product or a brand manager. And finally, a true dual authority emerges. What I told you as a dual authority. Guys who are there in every department will report to one functional superior. For example, marketing guy will report to marketing manager. Marketing guy will also report to product manager. So one functional, for every functional guy, one vertical superior, one horizontal superior will be there, right? That is the way how Davis and Lawrence have created three phases in matrix structure. Also, I would like all of you to bother this table, which is the difference between old and new designs. In the previous structure, there's only one large corporation. Now there are mini business units. Earlier only vertical, now horizontal. Previously, it was centralized, top down, but now it's more participative decision making. Previously, only vertical integration moving up or down in the same product or process chain was there, but now we are going for participative decision making like that. Earlier, there was no outsourcing, now we are outsourcing. So, just before going to the exam, check this tool, which talks about the difference table between 5 traditional designs and these 3 new age designs. Just to take you through the next one, network has come in the exam. Network has no specific structure, it's all virtual organization. The headquarters is there in the center and all the activities are outsourced. Network structure is often termed as non-structure or a virtual organization, which is very common in today's time. That too post COVID, this has become a very common norm in almost every country to follow what is called as you know a network structure, right? So now let us talk about what are the major things that these people do. The central headquarters will act as a broker. All the other functions are outsourced, if you see, right? Design is outsourced, designers, accounting is outsourced, chartered accountants, suppliers, manufacturers, customer support will be taken care by some BPO. Basically what you are doing, only acting as a broker in the center, managing all these aspects so that you can make the most of it. This is the logic of a network structure. Geographically, it doesn't matter where they are there scattered across the world. It doesn't matter. All independent firms, they come together to form this idea. Okay. And then the last one is called an hourglass structure, where the idea is to crunch the middle layer, which is seen the top level corporate people, you can't remove them. Bottom level functional people, you can't remove them because they are the ones who actually do the work. So the only people who can be crushed a little piece is the middle layer. And of course, sir, then who will do their work? Nobody will. I mean, we are not snatching away anybody's work. All that we are doing there is to use IT systems in place of that. They are replaced by technology. IT replaces managers. So the structure is wide at the top, very narrow in the middle, and then widest at the bottom, because a lot of functional people are there. So wide at the top, narrow in the middle, and widest at the bottom is called as an hourglass structure. You've seen that hourglass, right? The one which they have sand falls, right? So same thing like that. That is the model here: wide, narrow, widest. But the problem here is, since there are people in the functional level who after a certain time want to be promoted to the middle level, they don't have that many opportunities visible in the middle level. So that brings a piece of monotony. How long will you keep working in the functional level only? Someday you want to see and grow up, no? And that challenge is there here. And also one more thing that you need to understand is, we can fix that. It's not that that problem is pertinent. You can do one thing. You can give them higher salaries, and you can shift them laterally. Instead of moving them from down to up, you can move them within the same functional level with different roles to keep them more active. Couple of challenges: see, few promotion opportunities and monotony will come. Two solutions to address those are assigning them with challengeable tasks and lateral transfers. Horizontally same level but different job role will make it more interesting for them to work around. And also offering rewards for good performance, that will keep them going. Okay, so that is what we have in the hourglass structure. Guys, we are inching to almost the close of the marathon. So I am just wanting to bring this back to you. Network structure and hourglass structure also are there, right? So I think I have done fairly a great piece of marathon. That is what my personal feeling is, because when a class goes with this flow, uh, like sometimes we do it because okay, let's do something, but this was not like that. This is well planned, and slowly executed, so that nowhere I compromise on anything. So I am hoping it is the same with you, right? The previous marathon, I did with this particular handwritten material alone, but this time we have even gone to the main material, and almost every important point we have touched upon all of those. And I'm very glad that we are in this last phase of it, talking about two more topics. Leadership, yeah, this is good enough for you to understand about leadership. Strategic leadership is the other topic in stage 4. 5 roles of a leader, 7 responsibilities, and 2 leadership styles. I think we can wrap it up quickly from here because you can see very clearly as to what it is. So, leadership is not a task that you can go and do. Leadership is not just a role that somebody has to fulfill. Leadership is more to do with it is more about a passionate exercise. Leaders are not, you might hear saying that, become a leader by doing this course. Nowadays they sell leadership on Instagram for 99 rupees. So you can't become a leader by attending leadership seminar, or you can't become leader by wearing white clothes, if you know what I mean. So, on that note, when can we become a leader? Leader is about envisioning things. Leader is about taking responsibility. Leadership is about setting an example. Okay, that's when you become a leader. So, strategic leadership, as such, has 5 roles. Stay on top of what is happening. That means take responsibility, not going and sitting on the top floor. Stay on top of what is happening represents the responsibility. Stay on top of things. Promoting a culture and esprit de corps, which is about a spirit of togetherness and feeling pride for the organization that you are working for. So just imagine if somebody is working for Indian Army. Sir, we are working for our. They won't never have a laid back attitude that you can see somebody working for X Limited say that, what big jobs are X Limited. You can see sometimes employees are very proud about, they're working in Google, they're working in Apple, that come and tell all of that. But it is not like that for everybody. For somebody, organization, like, what, sir, we are doing something. So many people are living, we are also. No motivation. But a spirit the corps is not something like that. A feeling of pride, fellowship, and togetherness. And feeling proud about being associated with a team or an organization. That's what, like if a cricketer is there, it'll be like, I'm proud to play for the Indian cricket team. An Indian army personnel, you'll never see them dejected. So that is what esprit de corps is, and that is the leader's role to promote the feeling of esprit de corps. Environment is dynamic, we know that. So keep the organization responsive to changes in the environment. Don't say, I won't change. Today, if anybody says, I won't change, they are taking a big chance. You should not say that, I won't change. Change is not for me. And only when you are ethical, remember, your followers will also think of ethics. If you as a leader set up a bad example of being a corrupt leader, then it is not going to again really work out. So therefore, it is really important for you to see how the entire activity spans up, like what exactly is the uh, leader's role here. If we exercise ethics leadership, people also will follow. And more importantly, a leader should never be afraid of pushing for corrective actions. What is it? Pushing for corrective action. Take it if something goes wrong, no matter what it is. Take it. It's okay. Same way. Our roles are something that you can fulfill, right? At any point of time. They're not like compulsory. If you don't promote culture or esprit de corps today, do it tomorrow. But responsibility is not like that. That definitely these are something that you are responsible for and you have to do it. That is the difference between role and responsibility. In roles, you can fulfill that role any time. Responsibility is something that you have to assume comfortably. Make strategic decisions, form action plans, uh, formulate action plans, ensure effective communication. One of the toughest tasks to talk is managing human capital. Will think managing people is easy? Definitely not. Managing change, environment changes, and you have to manage the change. Maintaining a culture. And one of the toughest tasks to do is, even once you achieve a high performance, there are so many instances where people can achieve a high performance, but sustaining it over a period of time. What are you saying? Sustaining it over a period of time, that becomes the actual challenge. So, how do you sustain high performance over time is also another challenge of the leader. Okay. So, considering all of these points, one has to understand the responsibilities of a leader. Now, the last part of this discussion talks about the 2 leadership styles, which is again one of the most asked questions of this topic. 2 leadership styles are there. One is called a transformational leadership style. The other one is called a transactional leadership style. Now, transformational leadership style and transactional leadership style, as you see them, right? They basically are the way how you achieve something in leadership. Now, see, if you look at what these are, One goes by speech and one goes by money, ideally. So transformation is by the speech that you want to give and achieve it, while transactional is more like a give and take. So this is less formal, while this is more formal. Exchange of pay, rewards, or status. That is what a transactional. You do this for the organization, we will do this for you. It is like that. But when it comes to transformational, a very charismatic leader will come and give a speech. It's very motivational. It's uplifting the people. And they'll be like, yeah, look, this is what we are doing here. And this is what we want you to do this for the organization. Like that, you're pushing them, you're uplifting them and doing all of that. So when money is not there, no, speech works or philosophy works. That is why transformational leaderships are done when the beginning and end of life cycles, while in a well settled environment, transactional leadership style is performed. Only what I taught you now, if you write in points properly, also, you are going to get marks in the exam for this multiple time asked question. Okay. So, with that, it brings us to the topic on culture. I have only 2 points to discuss in culture, as I have discussed in the past. I'll take you through culture. And culture changing actions is one of the very important things. Now, in an organization, as much as structures are important, culture is also important. So, quickly bringing what culture is: organizational culture. The philosophy and principles and values of an organization are called as the organizational culture. Its history, its rituals, the way it approaches problems, everything about an organization, its embedded patterns, its work style, its beliefs, its thought patterns, anything. Corporate culture is a combination of values, beliefs, principles, traditions, ways of operating, and internal work environment. So basically, it's a very complex combination of several sociological forces. That's what culture is exactly. What is culture? A complex combination of several sociological forces. That's what culture is all about. Now, in this story of culture, where does culture come from? That's not a question that's generally asked, but yeah, still you can run through that. Culture comes from the values, ethical standards, your own relationship with stakeholders, traditions that you practice, attitudes, behavior, peer pressures. What are competitors doing? So we have to copy that one. Your belief, practice, and story. So basically, where does culture come from? Culture can come from many places, the list that I read out now. But the bigger question to answer there is culture an ally or an obstacle? Ally means a support, obstacle means something that breaks. Yeah. Answer is very simple. If your culture is compatible with your strategy, if you have a compatible culture with your strategy, it is matching, then it is a gift. The same culture, if it is conflicting in nature, not matching, then the same culture becomes a obstacle. Okay. So this is exactly what one has to have an understanding about, whether a culture is an ally or an obstacle. Yes, culture promotes good strategy execution. If there's a perfect fit between culture and strategy, support strategy execution. If it does not align, if it there is a little fit not matching, then there is a hindrance. Hindrance means something that stops. So the very same culture can be a pathway for success, and the very same culture can also be a danger spot in it. Okay, so that is exactly what we talk about. Say examples of a strategy supportive culture. Frugality is a culture. If you inbuild frugality into people, frugality means being economical. For every rupee they spend, they are accountable, not stingy. They are thrifty, right? Thrifty means, they're like, yeah, why should we spend? Okay, makes sense, then we'll spend. Not like a miser trying to save. It's not that, you're saying that, this fellow is a very stingy fellow, doesn't spend. Not like that. They are very frugal. Frugal people are very important people for an organization doing cost leadership strategy, correct? Because in cost leadership, everything you want, everything that you do or want is to try and reduce cost. So keeping that in mind, we have discussed that point. And if the culture fits with the environment, it will positively affect the organizational energy. If culture and strategy are misfit, every day will be a working hell in that particular place, right? So that is the problem there. Strategy and culture, if they are in conflict, you should go for this perils of strategy culture conflict. They are not something easy. You can see changing a problem culture is the most important topic of this entire culture aspect. How to change culture? Steps to change culture. You see, one, two, three. This one, diagnose which cultural aspects align and which one don't. Have open discussions about what needs to change and take visible actions to modify culture, policies, rewards, everything. So these three steps speak a lot about what the actions are and how they are supposed to be done. Revise some of your policies, culture changing actions, right? But this will not happen overnight. So revise policies and procedures, adjust some incentives, praise and recognize those who are appreciate them, those who are following the new culture, and recruit new managers with the same values that embrace. One of the big ways to bring in culture is to communicate through change. Remember Kurt Lewin change process? Like that, change should be gradual, it should be done, and culture changing action should start from the top. Chief executives should not sit in air conditioned rooms and pass orders. They should get to the ground and work around this. Charismatic leadership may not be essential, right? Because you don't have to give big speeches. Get down to the level and talk to people face to face. That helps a great deal. Okay, when you talk to people, it helps a great deal, right? So personal engagement is more important than charisma, drawing up people through charm and all that, because charm will vanish. But one-to-one level, personal engagement will definitely be very useful. And lastly, frontline supervisors are functional level people. They are the most important people in driving the cultural change. If you can go through all these points, culture changing actions, this alone has been a question in the past. If it comes back, I don't think there should be any difficulty in dealing with it. Okay, so that is what we have in organizational culture. So quickly, let me come back to our stage 4 picture so that we can just effectively take a look at everything that we have completed here. Organization structure, strategic leadership, culture, and strategic change, everything has been taken care of. So on that note, it is a time for us to move to the last leg of our marathon, wherein we are going to talk about strategic control, which is about taking corrective actions, right? Coming to stage 5, strategic control. My last piece of discussion with you guys is the strategic control aspect. Control is all about taking corrective actions. Now, let me keep this simple and short. Wherein control is normally exercised is a big question. I would want to ask you the very first question that we discussed in strategy. At which level strategy is framed? You know the answer, right? Strategy is framed at all levels. When a strategy can be framed at all levels, can things go wrong at all levels? Of course, things can go wrong at all levels. So, when things can go wrong at all levels, can we take some corrective actions? Yes. At each level, some kind of kind of strategic adjustment or control is necessary. So, we are taking some corrective actions, which is the last stage, evaluation and control. Now, here, listen, I will first discuss with you about control, and then there is a word evaluation, how to evaluate. There is a topic called SPM, strategic performance measures. I will show you that also so that you have an understanding. And questions are coming from SPM, though is the last topic in the book. So, let us take care of this, in totality, and then give a proper closure. Come on. So, operational control, that is, people at the functional level are bothered about efficiency, where efficiency is a measurable relation between input and output. So operational control deals with all those aspects to ensure the input output ratios between things are well managed. The next one, we're talking about managerial control. Managerial control are at middle level. The challenge for the middle level people, is to establish, challenge for the middle level people is to establish proper utilization of resources, an optimal utilization of resources, whether the management is able to achieve the goals in the most effective and efficient manner. That is managerial control. Okay, so operational control deals more with efficiency, While managerial controls deal with more of optimal utilization of resources, and strategic control, which is there at the corporate level, strategic control focuses on four aspects. This alone has been a question in the exam. It the words like premise control and special alert control have been asked in the uh, you know the MCQs to get you enough marks. So premise control means you're focused on your premises as to what is happening in and around you, a focused aspect. While special alert control is a situation where you are talking about special situations like a flood, pandemic, anything which is a special emergency situation. The only difference between premise control and strategic surveillance is premise control is very focused. You are, of course, monitoring your environment, but a focused monitoring. But when it comes to strategic surveillance, it's like a CCTV, unfocused, right? General monitoring of what is happening in the environment is called strategic surveillance. Sir, why are you having that surveillance? To see whether something is happening in the environment which can affect me directly or indirectly, right? So, premise control, special alert control, and strategic surveillance. The fourth aspect of strategic control is very, very important, where we are talking about an implementation control. Implementation control is to see whether everything is implemented as desired or not, which in other words is nothing but whether you stick still to the core area, which means monitoring a strategic thrust. Strategic thrust means the main idea that is there in the business. So, are you still in the main idea? Are you deviated somewhere? So, that is why it's called monitoring the strategic thrust to see whether you are in line with that. And then the last one is called a milestone review. Now, when you're traveling on a highway, you generally get to see milestones. This far we have come and still this much is left. So that is something that you should do in business also. A milestone review to see how far have we come and where do we stand now. What is the next best thing that we can do at this level? That is what is called a milestone review. Okay, so that's all, guys. That is what is there in control. You can give one more round of a detailed reading to this. Now I want to end this marathon by discussing something that I've not discussed in the previous marathon also. Like I said, since we have the intricate aspect, come to the last topic of the book, which is called as SPM, Strategic Performance Measures. I'll give you a simple insight so that you can dive deeper into it. Nobody can operate in isolation. Please remember that. You have to operate in an environment which forces you to do something. So, are you there with the environment? So, you have to use something called as SPM, a method to track progress. How it's like a tool to measure how far have you come, what are you doing. And then importance of the SPM. If you see that, it enhances the understanding of your goals and improves alignment between strategy and organizational objectives. A cause and effect relationship. What is the cause? What is the effect? If you can study this, it is good. So for that, we are using something called the KPI, shortly called KPI, is the key performance indicators in the organization. ROI, ROC, ROE, all these are financial indicators. Then how much is the pollution level, what you're doing are environmental indicators. Like that, for each area, some SPMs are given, which is the first question. But before I go to that, I want you to read the last line. Avoid paralysis by overanalysis. Don't use all this so much that it will put you in a fix later. So therefore, you have to use SPMs to a proper extent. Now, what are the types of SPMs? Financial measures. To measure customer satisfaction, you can use customer retention theory. How many customers are repeat customers? How many people are buying repeatedly? So that is the second SPM. First SPM is very favorite for all of you, finance, right? Because all of you did financial management. Second is customer. Third one is market measures. How much is your market share? Newly, how many customers you acquired? So now Jio and Airtel keep releasing the statistics, right? We acquired these many number of new subscribers, that one. Then market measures are those. Employee measures. How is your employee satisfaction level? And I hope all of you did flux method in costing, which tells you the attrition rate or employee turnover rate. High turnover rate of employees are there in an organization, not a good indicator. So like that, employee measures. Innovation measures. How do you measure innovation? How many new patents you filed? How much money you spent on R&D? What was the best that happened to you because of the R&D? And lastly, environmental measures, which talk about how much energy do you consume? What is your waste reduction plan or pattern? and also how much carbon emissions you have contributed to. All these are the points that you would be focusing on. So this is a possible exam question. And then here, this is a table tell you the three P's were important earlier. People, of course, for a business, profits are important first. People are important. Then later, the planet Earth is to be important. So basically, profits, people, and planet. That's how earlier. Now, a fourth P has come into this dimension, which is more, I think, in spiritual in nature. Like we're asking a question. This point aligns with me very much. People, profits, planet. Let that everything be there. Why? The purpose of, I mean, like, this is like going to the roots of spirituality and questioning why do we even exist. So very high level topic to discuss. That is why I don't want to discuss anything about it right now. Probably I am going to extend a few videos through this channel going forward, where I want to share certain through certain other platforms. I mean, like, in the sense, the same channel, but through certain other videos, and making it more useful for the user. So, all of you have watched this marathon. Should I say that you have to subscribe to the channel? I hope by default you would go and do it, but generally people don't. So, if you have watched the whole marathon, if you're listening me say this, please do so, because it is not like I'm crazy about numbers, something like that. Because I've I've built a channel from zero to a lack of subscribers back then when YouTube was not active, right? So from 2015 to 19, I built a channel, achieved 1 lakh subscribers, called it tuition.in back then in association with them. Then this channel on my name, I've moved it around, and I did hardly any work. Still, I have about 14,500 subscribers. So now, as I mean, like, see, again, I see all the stats sometimes. 70% of the people who view the channel don't subscribe to it. It's quite natural. I can understand that. But again, I am not here for the number of subscriptions or something like that. But if you do, that just says that there are so many people for whom we can make real worthy content. That is the only, it's more like saying that, hello, I'm there. It's like present, right? That's all. Saying that, look, I subscribed to your channel, so I'm looking for some content. That puts us on a spot, saying that, okay, these many people are there, so there's worthy of making some content. So actually, there is a lot planned in the coming days, months, years, you can say. So I will try to keep up this channel way more active than what it was in the past. And then towards to end the story, the 4 points, both these questions have been asked in the exam. What is an importance of an SPM? 4 reasons as to aligning your goals, allocating resources, continuous improvement, and who's accountable for what. Very clearly, you can figure out these 4 points if you understand what the SPMs are. Are you in line with your goals or not? All that. And choosing the right SPM. Because if you take a wrong SPM and measure that, then you will go into depression. You should not do that. Relevance. Is the SPM aligned with your goals? Is data readily available to compute? What is the quality of data and data's timeliness? The 3 points about data are very important. Data availability, quality, and its timeliness. Because if you use very large, old data, it will not work. So that is why these 4 points are very important to choose the right SPM. Okay. So those are the 3 questions in SPM. What are the various kinds of SPM? Importance and choosing the right SPM. All these 3 have been asked in the exam. There are all possibilities they can come back and ask you this. Okay. So that brings us to the end of the marathon. And I hope from my side it was really good, is what my understanding says, because the flow with which I went, I'm very confident that those people who like and follow our flow, they will be best benefited from this close to 10-hour marathon. So, guys, as I said, if you have watched the whole marathon and you've completed strategic management, now say stage 4 completed previously and stage 5 completed, you have to go for that, and then leave a comment on what was your feeling at the end of it. That's all. That is just for me to know, somebody who did the entire marathon, as to how you felt whenever you watch this, because these videos are priceless. The last marathon I made was before a year. Before that, it was even back. These marathons are timeless. You watch it 5 years later, also content will be still relevant and amazing. Strategic management is that beautiful as a subject. So, guys, on that note, I am going to wind up by saying thanks to all those who have held on to watching the marathon from start to end. And also, this platform should be, good enough to communicate back to you. And therefore, I would also want all of you to share this marathon with your friends, because when something good has come to you, you should not keep it for yourself. So do some good by sharing this marathon to the others. Let them also watch, right? And tell them like this is what it is. And if any of you are my students of past, you can and have benefited from our classes. See, I'm telling this after making a 10-hour effort, not telling this in the beginning. So there's a reason why I do that. If you've really liked what we do, then do let others know, and do let them purchase the classes or subscribe to the classes or reach out to us on whatever means, so that we can provide a regular class or a crash course, and depending on what their needs are. Okay. So only after giving you the thorough content, I'm saying that. Then of course, like, I am not again saying that these commercials don't work. Of course, they are a part of our story, so they do work. So on that note, guys, I'm wrapping up this on a very happy note. So wish you all the very best for your exams. I hope you will do really really well in the coming exam. Thank you so much, guys.